Hello viewers, welcome back to our YouTube channel, and today we want to kickstart with our tutorials on advanced financial management. That is a paper on level 3, and it is the advanced of financial management paper that is on level 2. So this is what we are going to start on. So I want us to look at the advanced financial management paper, and I want you to note that as you're doing this paper, get prepared that this paper is going to be 80% quantitative analysis, meaning we are going to be looking at dealing with numbers, and that's why you are always forced most of the times to do the QT paper or the qualitative techniques on level 1. The reason is to actually equip you with the knowledge that you will be using in the advanced papers, like for advanced financial management. And the other thing that you need to note is that this paper is also having some theory. It has some theoretical aspects, and some of the theoretical aspects that we have things to do with ethical and governance, corporate governance. We have things to do with Islamic finance. I know Islamic finance is also on level 2 under the financial management paper, but also here we have an advanced of that Islamic finance where we look at, there are very few things that we look at here which you are supposed to use at the same time when you combine the information that you got on financial management, that's on level 2, then you combine with the information that we are going to be getting from level 3, because it is just an advanced aspect of what we cover under financial management on level 2. So we have ethical and corporate governance. We have Islamic finance. Those are some of the theoretical aspects that we have. So the other thing that I want you to note is the fact that this advanced financial management paper has 2 sections. All the paper is divided into 2. We have section A and then section B. And this section A has 1 question. It has only 1 question that is going to be carrying 50 marks. Section B will be having 2, you will be doing 2 questions. They said 3 questions. You select 2, but each is carrying 25 marks. So that's as per the sections that we have under the advanced financial management paper. So, but just know that the theoretical aspects that we have, they are very easy because they are just small things. They are not all that too much, and that's why I was telling you that it is 80% quantitative analysis, meaning we are going to be dealing with numbers, but at the end of the day we are also going to be looking at the theoretical aspects. And these ethical and corporate governance plus Islamic finance, the question may come taking like 8 to 15 marks maximum, and most of the times these questions, the theoretical aspects, they used to happen, or they used to be set, these 2, Islamic finance and then the corporate governance in question 1. So you find that the question 1 is having some computations, but at the end of at the same time, it has some theoretical aspects, and mostly these two, ethical and corporate governance plus Islamic finance, they always, most of the times, if you look at the past paper numbers, you'll be finding them under the question 1. And the marks I have said, they will be taking up to 15 marks maximum, if at all the examiners wanted maybe people to pass, but expect at least 6, 8 to 15 marks in there. So let's look at the structure of the exam. The structure of the exam, the examination structure. We want to look at the detailed analysis of how we expect this paper to be. Now, this paper, as I said, it has 2 sections. We have section A, and also we have section B. Section A is compulsory, and it is carrying 50 marks, as I said. So if you are used of those questions, if maybe you have just come from your level 2, if you're used of those question 1, whereby they only set 1 question but it's allocated 40 marks, just come to this point on level 3. The fact is, this paper has 1 question in section A, but that 1 question is carrying 50 marks. Now, we want to analyze the 50 marks that we have in section A. You'll find that 60% or 70%, it is computational. Let me first remove this section B. 60% computational. We are analyzing section A question paper. So meaning the other 40% is going to be theory. The 40% theory. So even though the question is actually taking 50 marks, it doesn't necessarily mean that you are just going to find numbers alone. Because 60% of 50 marks, you may find that maybe 30 marks are going to be on computations. Then the other remaining 20 or 23, depending, marks, they are going to be theoretical. Now, that is the composition of section A. Don't think it is just computation alone. We have some theory, and I told you most of the times they put Islamic finance and ethical governance. And how we are going to be going into the tutorials, we are going to first look at those 2 theoretical aspects. At least we first get those easy marks. Now, that is section A. Section B has 3 questions. That's what they said. And in those 3 questions, you are supposed to only select 2 questions. Each question is going to be taking 25 marks. So that is the composition of the question. But even within this, just know here, these 2 questions are going to be also taking 50 marks, meaning it is 50-50. Section A 50, then section B also taking 50 marks. But also, these 50 marks of section B, they are also going to be computational and also theoretical, whereby they can set question, let's say question 2, part A, it is computations. Then part B is going to be theory, or it can be part A, part B, and part C, and these are theory. Maybe this one is taking, let's say, 10 marks, then this one is taking 15. Or this one is taking 8, then the other one is taking 17. So it depends on how they have distributed the marks. But what you have to understand is the fact that even in the section B, you are going to find that at least 70% of each question is going to be computational, and then 30% or 40% will be theoretical. So what does that call for? You need to take the theory seriously, because I know with the theory, that's where you can get the easy marks. Now, that is as per the examination structure. That's how the examination is structured. Therefore, you need to be careful with this paper. And the other thing that I need to note is the fact that these papers, this paper, they always, most of the times, they bring scenarios. They bring scenarios. And a scenario can take up to, let's say, two pages, 2 or 1.5. And most of the times, the theoretical aspect that is within this question is going to be answered basing on the scenario or basing on the case they have highlighted. So it's not going to be 100% computational, because after making computations, you have to at least make some analysis. As I said, we are just analyzing. We can analyze the results based on what we've got. That's why you may find the computation number is taking 10 marks, but there maybe part B says advise the company based on the scenario or based on the results that you have computed. So the scenario cases, if you are that person who doesn't actually want to read the passages, who doesn't want to read the scenarios, just get used to it so that you can be able to equip this information from the start. We get it from the inception until we go through the revision. So those are the two things that I wanted to highlight as far as the introduction, part 1 of our advanced financial management paper is concerned. Now, in part 2 of our introduction, I'm going to talk about the examiner's remarks. Like I try to look at the remarks of the examiners to know what the examiners are saying based on the overall performance for different periods, and what are some of the things that the examiner is actually pointing out that are making students not to actually score what they would have scored. So let's meet in the next video as we are looking at the examiner's remarks, and basically, if time allows, we shall also add in something to do with the relevance. How relevant is this advanced financial management paper to the entire qualification of the CPA? How is it relevant, or why was it included? That if someone is to become a certified public accountant, you must have done advanced financial management. We shall look at some of those things. We talked about the first introduction to advanced financial management, and I promised you that when I come back, we are going to look at the examiner's remarks. I call them examiner's remarks because these are basically the things that you need to know. These are like the expectations. The examiner expects you to have this, but you find students have done this. So basically, I'm going to flip it in a bit, in a sense that we start from the expectation, what the examiner expects you to do as far as advanced financial management is concerned, because that's basically what is going to help us improve, because we will be knowing what exactly we are going to do. So we are going to focus on the examiner's expectation, what the examiner expects the student to do. Of course, we look at, these are some of the things, if they are not achieved, then most of the times they lead to the performance not to be a little bit convincing as they expected. So let's first look at the things that we expect, or the examiner expects us to do. So you need one to be a little bit, you need to be able to compute and analyze results. This is very important. You don't just compute. You compute, then you analyze the results that you've gotten from your computations. So by computing and then analyzing, you end up trying to recommend some strategies. You can recommend strategies. Remember, I told you the question is basically going to be a little bit on a scenario basis. So you'll find yourself have to explain what the organization can be able to do to embark on the given aspect or the given scenarios that are within the given case that they have presented in the question. So they may give you a case, maybe they may give you a scenario. Let's say they may talk about maybe NSSF. They may not just necessarily call it NSSF. They may bring it in a sense of these schemes, retirement scheme. They give it a different name, but if you look at it, the examples they use in exams, they are supposed to be fictitious, because you are not supposed to present the actual companies, given the fact that you are going to be talking about some of the different aspects that may not be as good as the organization expects you to behave. So in exams, the scenario can be fictitious, but in actual sense, you can actually relate to what the examiner is saying. If let's say they are saying KC retirement fund, of course you can relate it with the NSSF, National Social Security Fund. So that's basically how you will be able to analyze. Don't expect that you are going to have direct examples of the companies that you know, because that's not allowed. Because just imagine I'm talking about a company, let's say I'm talking about Stanbic, and I bring issues to do with money laundering, yet the companies themselves, they are not doing it. So they try to bring fictitious examples, but they are relatable to what is prevailing. So the case maybe it may be about NSSF, and at the end of the day, they want you to recommend a strategy. What can they do to improve whichever scenario they have provided in the question? Or you analyze based on the performance, and you say based on the results that you've got, you recommend ABCD based on the computations that you've done. So you don't simply compute and leave these aspects there. So you have to compute, analyze those results, and then be able to recommend strategies. So here computations, they don't just work. You have to defend your point. The only way you defend your computation is by analyzing. If it is all about ratios, put some comment to analyze what you have computed. Is the company doing well in terms of whatever you have been computing? So those are some of the things that you are going to look at. But most of the times, these questions, they will require you to prepare a report. Most of the, even if it is about ratios, they may tell you to prepare a report on the performance of the company. But they have given you, you are going to compute using ratios. Of course, you compute the ratios, but you state the format. The format is actually taking like 2 marks. It can take 2 depending on the marks that have been allocated there. So the format, but we've seen from our financial management, we know that a report can actually take the memo format as per the exam. But in reality, those 2 aspects are different. But we shall learn more how to prepare a report when you go to the advanced financial. It is more in the integration of knowledge. That's where most of the times you will be preparing reports and they will be in a given format. But here we can take a report as a memo format. So if they ask you to prepare a report and you present it in a memo format, it will be fine. As per the exam, they will mark you right. But it's always good to know those formats, and you'll be able to know what you're supposed to do. So, because most of the times they may ask you to prepare a report, but for you remember only the memo and you don't remember the format of the report. So instead of writing wrong things, you just go by writing the memo format. But when you're doing that integration of knowledge, that's when you'll be learning how to prepare those reports, proper reports. But it's always good to practice and you be able to work into exactly what they have asked. If it is a report, do as, especially when you are practicing. Because these numbers, as I said, it 80% quantitative, so you need to be doing the numbers. The examiner also expects you, the examiner expects you to evaluate investment decisions. Investment decisions that you can invest in. In other words, of course, this is the question that you can't run away from. Because here we look at most of the question 1 is on that investment decision, as it is on the level 2 financial management. So the things that we studied in financial management, they are actually applicable here, especially things to do with investment decision. They are really important as part of the computations as we are going to be looking at them. So you can't avoid this number because it is within the question 1, and we said the question 1 is compulsory, taking 50 marks. So for you to be able to do this number, you have to be knowing all the things that we looked at under the financial management, because the financing options that you are going to be having, you are going to have the money. This money is going to be scarce, so you need to make a decision as the finance manager or the CFO of the organization. You need to make a decision to see which investment opportunities or ideas are viable, so that you can pick them and use the resources that are available to invest in those business ideas that are viable, that are going to add value to the wealth of the organization. So some of those good financing options, you may, for example, if you look at what happened to local construction companies, Oracle had, of course, we know it is a very powerful company, and it has been in that industry of construction for very many years. But we saw recently it was going through financial distress, and the government had to give them money. Of course, they were preferring shares, but you may look at these organizations, but they have investments that they want to make, and those investments, they need a lot of money, of which some of those amounts are not going to be available in the organization itself. So by default, when they look at the investment and they get the money from outside, you have to select which investment you are going to undertake, so that you can be able to maximize the objectives or the wealth of the people, or to be able to pay off, if at all you've gotten a debt finance. So you saw what happened to local. They went through a financial distress, and actually they went to parliament, and the government gave them money. So the examiner may be looking at, if these guys have gotten the money, the question is, which investment activities are they going to be undertaking? Of course, by undertaking those investment ideas, you have to first evaluate them, and that's basically what the examiner expects us to be knowing, that by the time you go for a paper, you must be able to understand how I can evaluate an investment idea, basing on all the methods that we shall look at, plus the new methods that we shall be seeing, which we are not maybe on level 2. So the examiner will be looking at how you can be able to finance some of those investments, because you are not going to be having a lot of resources. The resources are going to be scarce. So we need to see how are you going to evaluate the investment ideas that you are going to invest in with the limited resources that we have at our disposal. So as a finance manager or as a finance analyst, you are going to be advising. One, you may be advising on things to do with financing options, because we, as I said, local went to parliament, but it had an option of going in for debt, like go and borrow loans instead of coming in for preferential shares. I also know that preferential shares are debt, but at least the other one, it depends on the circumstances that were there. If you may find that maybe the company was, maybe it had too much debt in its capital structure, so it couldn't be able to get any other funding from the debt component. And that's why they look at those different financing options and it will be you, the finance analyst or the CFO, to advise on which approach to go with, so that you can be able to raise the finance that are going to help you undertake these investment ideas. So the aspect here is to advise whether you are going to be going in for debt or you are going to go in for equity. And also, you know that by the time you bring in the things to do with the financing, you have also to be careful on whether you are going to be paying dividends. Of course, interest is supposed to be paid. If it is not paid, then it's going to be accruing every period. So the other decision that you are going to be making as a finance manager is to look at, are you going to be able to pay dividend this year based on the different investments? Because you may be having an investment project of, let's say, 10 billion, but you have made profit after tax of, let's say, 5 billion. So the decision will be, the CFO will advise on whether they should pay, because if you are to pay the dividends, then it means you are going to distribute the 5 billion that you've made in profit after tax, and you have to go in for debt to borrow money to finance the investment ideas. So you have to be able to advise, if at all you can be able to come up and tell them that instead of giving these people paying dividends, maybe we just increase their shareholding, bonus shares or rights issue. There are so many ways that you can be able to increase the number of shares these people are holding, but they are also going to remain happy, and the organization is also going to have the money that you are going to use to invest in the different ideas. So this idea of dividends on level 2, it wasn't all that much as we are going to look at it under advanced financial management. It's a very short topic, just small computations. If I understand it, it's a number that you can score 100%, but it has some small computations as we shall look at. So paying dividend is not something that we looked at more in detail as far as level 2 financial management is concerned. But here we talk about dividends, and we go into more details of looking at the Modigliani and Miller and other aspects as we shall look at them. So what I want you to understand is the fact that you are going to, as a CFO, you are going to look at whether you are going to be paying dividends or you are not going to be paying dividends. So as a finance manager, that's a very key thing that you are supposed to look at. So sometimes here the examiner is going to be referring to you as a finance manager or CFO, or sometimes they call them head of finance, depending on the organization. Head of finance, director of finance. But the examiner most of the times can refer to you as a CFO or as a finance manager or a senior finance manager. So it depends on how the examiner, because on level 2, they call you finance managers. But here, you are supposed to be a senior finance manager or a CFO. So that's how we are going to be looking at that that's how the examiner is going to be looking at you. And you have to make decisions on whether you are going to be paying dividends or you are not going to be paying dividends. So, but as I said, dividends is not a big issue here. It is just small, You just need to understand because the computations are very small and it is very easy to understand. And the approach I use to teach the dividend policy or the dividend topic, it is very easy for you to be able to understand. So just to know that that's a number that you can rely on if at all the examiner brings it, because it is very easy, small computations. We shall be talking about things to do with Modigiran and Miller, the professor of economics. So we shall be focusing on what they published in 1958 and their argument. So their arguments for paying dividends or not paying dividends. Those are the ones that the examiner is going to be interested in. You look at those small computations on how dividends can be paid. Then we look at the arguments or the advantages of paying dividends and the disadvantages of not paying dividends. But as they were advanced by the Modigiran and Miller. So the other issue is on ethics and corporate governance, because this is where we are going to be talking about things to do with fraud, things to do with conflict of interest. We are going to be talking about money laundering and other company policies. So you have to note that the examiner expects a professional presentation. A professional presentation calls for very many things. If you are to present the information in a professional way, we expect to have maybe a proper handwriting, presentation, and others. And also, you're supposed to attempting the required numbers. Like the questions that are required. They may tell you are supposed to do, in total, there are supposed to be 3 questions. But I said section A has 1 question, section B has 2 questions. You may find a student he doesn't understand maybe section A. You do all the 3 questions in section B. They will not mark them. They will just mark the 2. Because the more papers you mark, the more money you get. So you can't waste on doing numbers that are not required. In total, you will be doing, you will find yourself that you have done 3 numbers, but you are supposed to pick 2 in section B, then the other one is compulsory. So you do the required numbers. And maybe to add on my own thinking is you also present the working. Sometimes you may do the things in your head and you have to make sure that every working is part of how you're going to present your working. That is the presentation, professional presentation. So if they tell you prepare a report, they expect to first have a report first, then the computations, they come last. Sometimes they may not penalize you for starting with the computations, then you end with the report. But professionally, you're supposed to start with the report, then you bring the other computations or workings on the second page. So that's basically some of the key things that you may look at under the presentation of your work. So, attempting the required questions, because when you attempt the required questions, then you are spreading the risk of failing, Because if you do very many numbers as they are required, if the other number you are not able to maximize the marks that are there, then you can be able to spread the risk by having very many numbers that were attempted as required. So that's one way of you easing your passing. You do the required numbers. Sometimes we look at question papers. Maybe part A, you know it very well, part B, you don't know, but you spend more time on part B where you have no idea or you are just writing wrong things. Just do part A, part B, leave a space, go to another number so that you can maximize time. By the time the other, because after all these numbers, you don't actually know them. By the time you are skipping a gap, you will come back maybe when you have done these other numbers for you to be able to manage time. 2, you need to start with the numbers that you are very sure that at least you can maximize. If I'm starting to attempt, we shall look at what are the things, but I gave you guidelines in our financial management paper on how you will be able to make sure that you balance your numbers very well. You start with what you know, and you are sure that at least I can get 15 or 20 or 25 before you look at other numbers. Now, the last part that I want to talk about as far as the examiner's expectations are concerned, you are also required to report on modern issues. Report on modern issues in financial management. And that's why you are seeing every time they keep on changing the syllabus, because they are bringing in new things. So the new things that we have, they are things to do with Islamic finance. Is something new. It has been here, but it is something new. Practicability in Uganda, something new. They have also introduced, as per the paper, they have also brought in these other things of international concern. So those are some of the things that are going to be of international concern. So most of the times these theoretical aspects, they bring things that you can relate to what is really happening in the space. So the numbers are not going to be straightforward. So if at all you don't, these are the things that the examiner expects you to, at least by the time you go to see the paper, you must have attained those. So by the time you don't find yourself, you can't be able to look at tackling new things that were introduced in financial management. You can't be able to do investment decision. You can't be able to advise on financing options, on paying dividends, and other aspects. You can't be able to compute and analyze the results. So those are some of the things. And even when you look at the examiner's remarks, those are some of the things that you are going to find. You may find that the examiner is talking about people not managing their time well, not presenting their work professionally. So I never wanted to go into the examiner's comments as per the different settings, but at least I'm giving you the expectations, because they set these exams based on the expectations that they expect the students to. By the time they really say that we are going to see the paper, they must have attained this. So I don't want to make this video too long, so we are going to look at the relevance relevances of this advanced financial management paper. How important is this advanced financial management paper to the whole CPA course? That will be able to give you a highlight on what are the things that we expect. So the question that we want to understand is how important is this paper? Because we don't just want to have things on the syllabus when we don't actually know their impact on the overall CPA paper. So there are things that we are going to be looking at as far as advanced financial management is concerned that are currently or that are prevailing. We are looking at things that are actually happening in the real life. So we are basically going to be, it's relevant because of those real life scenarios or real life cases that actually exist, and that calls for the student doing a CPA to be able to understand those aspects. Now, when it comes to these issues of corporate restructuring, the topic has been revised slightly, but because we also have corporate restructuring on level 2, that is financial management. So here it has been revised a little bit, but what they are leaving here is there are things that they are leaving out, things to do with mergers and takeover, mergers, acquisitions and takeover, mergers and acquisitions, then takeovers. So those are the things that they are leaving out. So these are some of the things that we are going to be focusing on, and these are some of the things that we see. So these are the things that they have included, and these are things that are actually happening. If we shall look at things to do with, because if you talk about mergers, acquisition and takeover, we shall look at things to do with NC Bank, what happened to NC Bank and the Bank of Africa. We saw they formed the NCBA, but there were two banks, NC Bank and the Bank of Africa. When they joined, they formed the NCBA Bank. We also looked at this Orient Bank was also, it was maybe a takeover because it was totally changed from Orient to something else. So we can also look at issues to do with UTL, Uganda Telecom. There are cases, even though the company was not sold, but it has gone into some restructuring. They are changing from the normal way they used to do things to doing other things. But the UTL, because it had issues, but they are trying now to they are trying to revise the things that they are supposed to be providing, and they are trying to transform it into something. So they are even trying to change most of the things that they are doing from there. So that's one way we could talk about the corporate restructuring, because even the management itself has to be restructured if at all you are trying to bring in something new, if you are trying to change, if at all, if let's say you look at NC Bank and the Bank of Africa, you don't think that they are going to retain all the people, or they retained all the people that were in the NC Bank and the Bank of Africa, because one reason as why you could come together is to be able to enjoy benefits, maybe to cut down costs and others. So some of these costs are not going to be incurred by people coming together. So synergies and other reasons may force companies to actually join hands. Even the other case that could highlight the restructuring was when, of course, you remember when the former CEO of NSSF, Mr. Byalugaba, he did some restructuring whereby he sold some vehicles, company vehicles that were in different branches. They were all sold off because most of the times you find that some of these assets, they are there, but they are not actually generating money. So it was seen that most of these branches, the upcountry branches, had vehicles. And when you have a vehicle, it means they leave alone the cost of the vehicle, but their cost of the drivers, their cost of the fuel, their cost of maintenance, and other servicing costs that you are going to be incurring. So all these costs, when you come up with a strategy of restructuring or of selling off some of the assets, like what the CEO did, to sell off the company assets, the vehicles, those that were in those branches, they were sold off. It's one way of cutting down costs. Because when he came in, he found it unnecessary, of course, to have company vehicles taking people's, being allocated money for servicing, fuel, driver, and other aspects that were not, in his opinion, they were not required. So he sold off these assets, all the cars, all the vehicles that were there, and these different branches, and that's one way. That's some of the kind of restructuring that we may talk about. So we need to understand restructuring, because we will find a question. The question may not be directly on restructuring. The question may be bringing in scenarios that are related to the companies that we know, and they are going through the same process. Maybe they are merging, maybe they are buying them out, or they are selling their shares. So that's one way how this paper is relevant, because we need to understand these aspects because they are practically existing in the economy. Then the other reason as to why this paper is relevant is the fact that the need to finance huge investments, or we can call them big ticket projects, forcing companies into debt. Of course, when you look at things to do with analyzing the debt finance, you will also be in position to get knowledge on on things to do with gearing and the cost of debt. So it will be a little bit harder for you if at all you don't have the financial aspects of how we can be able to get the cost of debt, the cost of equity, depending on how the organization is going to be financing these big ticket investments. So these are going to be basis, or they are going to be key. And normally students, they always confuse themselves with things to do with ungearing and gearing. And we shall see some of these aspects we will be able to understand, because the question will also be there. So you have to understand how to ungear or how to regear, because these are some of the things that are not going to miss out. And sometimes they bring it as part of any question, maybe as part A, then maybe it can also come in section A. It comes as part A, then maybe another question that can come in. Like if you look at the December 2022, we had issues to do with corporate restructuring, where you had to get the cost of capital by trying to gear and regear, or gearing and ungearing. So we shall look at some of those different aspects. So the need to finance those big investments, they call for the knowledge of financial management. Then the other concern is basically with the current shift. The current shift to international trade. So you see, even the coffee we produce here, we can be able to export it. So the need for international trade, or the current shift in the operations or in the economic way of life. So the moment you get into the aspects of international trade, there are other things that you are going to be looking at. One of the things that you may look at, as far as an economy being looking at the international trade aspect, you'll find things to do with foreign exchange risks. So we shall talk about hedging of risks, hedging of interest rate. We also have interest rate risks, because we find that most of these companies that are coming in our country, you find most of them, they are South African companies. They bring the capital from outside and they bring and invest it in our economy. If they are banks, those like Stanbic, they are part of Standard Group, South Africa. So these companies, they need to manage. At the end of the day, when they are operating here, they need to manage the money they got from their head offices. And we need to be looking at how they are going to be doing the kind of reporting, the kind of risk in terms of foreign exchange losses and gains, in terms of the interest rates and other aspects. Because if these companies, they are coming as branches or as subsidiaries of the group that is overseas, then it means they are going to be sending money or goods, whichever item they are dealing in, from their head office to the branch. So that will call for different risk, or there are different activities that are going to be involved. Then we also have things to do with the political risk, and it also has become critical. So the examiner is heavily pronouncing in the syllabus these aspects. So we need to focus mainly on things to do with hedging of forex or foreign exchange, and also hedging against interest rate risks. We saw it in December 2022. There was 2 questions that had those 2 elements. And these items, they are mainly used in foreign exchange or forex businesses. But of course, we know that hedging is a little bit different, and it's a bit easy under financial management, since it has both the theory and then the computations. And that's why we want to look at specifically how we can be able to hedge the interest rate risks and other aspects to do with forex or foreign exchange. So, as I said, we have the theory and also we have the computations. So there is no way you are going to ignore these computations, because most of the businesses, they are importing products, they are importing raw materials, they are exporting their produces. And by so doing, we are going to have things to do with foreign exchange issues. And we need to understand how we can be able to tackle that. So that's another relevance of us understanding this, because the things that we are going to be doing here, they are applicable in the real life situations. So, and most of these things you find them in section B. Then the other that we can maybe conclude with is studying corporate governance. Corporate governance is just how things are managed, how the business is managed, basically. And it is important because corporate governance is cited in the collapse of different companies. If businesses are not going to be managed well, we've seen some banks collapsing. And we shall look at some of the businesses that collapse. We have things like Enron. These were companies. Greenland Bank. These were Ugandan banks that collapsed. Then we have also international companies that also collapsed, like Barings Bank. It's one of UK, Britain. So it is an issue it's an international concern, whereby if organizations are not managed well, if the activities within the organization are not managed well, then it can lead to the collapse of different companies. And we've seen this happening. So we want also to look at the reasons as to why students fail this paper. Why students fail paper 15, CPA paper 15, that is advanced financial management. We want to cite out some of the things that have been communicated from the examiner's point of view, but also from the comments, because we have, as you know, that we have these comments. You can download them from the Institute of Certified Public Accountants website. As you are downloading question papers, you can also download comments of what the examiners have seen from the different students that they have marked. They also give the overall performance, and they also look at what happened. They try to explain if the pass rate has been poor, why are we having so, or what brought this pass rate to actually be a bit lower. So we want to cite out some of the things that are going to help us understand from the start that at least these are the things that are making people to fail, as from the examiner's point of view, on why students fail. And also we try to give out a detailed, a summarized overview of what we are going to be covering as far as advanced financial management is concerned. So it is going to be like an overview of the syllabus. We know we have the syllabus, we have the detailed syllabus as provided for by the Institute of Certified Public Accountants of Uganda, but we want to give a breakdown of how we are going to be talking about some of these aspects. We are going to start with which topic, and we are going to end with which topic. So there is a strategy that we want to, there is a pattern that we want to look at, basing on what the remarks of the examiners are, or what causes the students to fail. At least we start by resolving the things that make students fail, then we'll be able to maneuver through our syllabus. We need to understand why students fail this paper. These are some of the things that the examiners highlighted that make students fail this paper. One is failure to read and effectively understand the requirements of the question. So if you can't interpret, because as I said, 80% of these questions are going to be calling for your analysis, quantitative analysis. So if you can't read the question and you understand what the examiner wants you to do, automatically you are going to actually fail, because you are going to be answering in your own way. So if you don't understand, or if you don't evaluate to see what the question requires you to do, it will be one of the ways that you'll find yourself not passing the paper. Two, poor time management. Because most of the times you find the student is going to be focusing on, let's say, the student is going to be focusing on some questions or some section. Someone is spending most of his time in section A, which is one question carrying 50 marks. And you know the pass mark is 50. So by all means, if you concentrate in one section, there are very, very minimal chances of you passing that section, passing everything. You know, computations, even if you are good at computations and at the same time you are good at theory, sometimes these arithmetical errors, instead of adding this, you subtracted, maybe you wrote. So some of those arithmetic errors that can cause someone not to score. So if you try to focus in one area, thinking that you can maximize everything, if you manage to maximize the marks, you will be getting 50%. So you will be marking yourself out of 50. So that's one way of wasting time, or where poor time management can be seen. The other is the fact that someone does poor question selection. You do one, you know part A, part B you don't know, but you spend more time analyzing part B. By the time you reach to the other parts that you know of different questions, you have already exhausted. You are tired because you over-concentrated your effort on the things that you actually don't know. So you better start with the questions that you know. These I can spend the least time possible, and at the same time I can be able to get the maximum points. So if you try to over-concentrate on few questions and also attempting less than the required, balance off the questions that are required. If they want you to attempt 3 questions in total, make sure you have done all the 3 questions in total. The other is the examiner has also complained about inadequate preparations. Inadequate preparations of students. Inadequate preparations in the sense that, because they expect at least someone should complete 80% of the syllabus. So you have not completed 80% of the syllabus, and you've not even been attempting numbers, because we say these numbers are quantitative analysis. They require you to be doing some computations on your own, leave alone what you have gotten from the lectures that you have attended to. But you also have to practice on your own to be able to judge yourself that you have actually understood what the lecturers have covered. So make sure that you at least get 80% of the syllabus, and not getting the notes alone, but also trying it on your own. When you finish a topic like this, make sure you go through the topic to see whether you have actually grasped the concept. Because if you walk through, if we take maybe a simulation, we walk through the question, I will be the one to, or the tutor will be the one to analyze the required. So by the time you go through these past paper numbers, you will be able to analyze the questions on your own, and that will help you to assess yourself whether you have understood that particular topic or not. So preparation, it shouldn't be at looking at completing all the student. Like 80% or 70% of the syllabus, but you know at least 65% of what you have studied. So adequate preparation. So those are some of the things that you can tell that if this person has actually, based on what the pattern of the pass rates have been, because these are as per the remarks, what made this percentage of those who have passed and differ from those who have failed. Why maybe this sitting we have registered very many people who have passed. This sitting maybe we have not got more people as we expected. So these are some of the general aspects related maybe to finance. Others, they are personal, but the general aspects, these are some of the things that we can talk about. So let's now look at the detailed, of course, the detailed syllabus. We have the detailed syllabus from the institute. You can download that from our Telegram channel, and the link is on the same channel. So we have the link here. You can go to the about section of the Telegram channel, you download whichever source you need, past papers, solutions, syllabuses, and other different courses that are related to accounting and finance. So let's see how we are going to be attempting these numbers, the syllabus. So overview of the syllabus, how we plan to handle the syllabus. Syllabus overview. So we are going to look at corporate governance. Corporate governance. Of course, corporate governance and ethics. When we are done with that, we shall also do some review on ratios. Ratios cut across. On level 2 is the same way we are going to learn the same ratios here. So we shall have to do some review on ratios. We start with the things that we know. Review on ratios, then Islamic finance also. Then we shall have things to do with financial markets, financial market theories and financial securities. We shall also look at capital budgeting decision. This is the investment decision. We shall also look at the dividend policy. We shall go to portfolio theory. This one is a bit detailed. On level 2, we looked at something that was basic, but here it's going to be a little bit detailed, portfolio theory. Then we shall also look at the CAPM, capital asset pricing model. The CAPM, or what we call the capital asset pricing model. We shall also look at corporate restructuring, business valuation. Of course, this business valuation has been removed. This one was removed. So the business valuation part of it will remain the other side. This was removed. So we shall just look at the corporate restructuring. So we shall also look at derivatives. Derivatives, where basically we shall focus on hedging method. We have also multinational and international trade. Multinational and international trade. Then we have international markets. Can conclude maybe with the international markets. So they seem to be a little bit small, but they are very detailed. Like for capital budgeting decision, we shall understand what a national NPV and an international NPV. Like the NPV for a local company is totally different from the NPV of an international company. So we shall look at how we'll be able to compute those different investment decisions, as we shall see. So that's basically for the learning outcomes and things to do with the course syllabus. You can actually look at the detailed syllabus. If you get the detailed syllabus from our Telegram channel, the link is in the about section of this same YouTube materials, and also be able to access the different information that we share on a daily basis from that point of view. So the next is going to be a kickstart for the different tutorials, and we shall basically start by looking at the ratios, financial performance of the firm. We look at these ratios. We are basically going to be focusing on the revision, because we have gone through the different aspects to do with ratio analysis. And if you want maybe to go through the quick, we have some or different tutorials that are on the previous financial management on level 2. So you can check out this same channel, CPA Cafe Charles. This is the channel that has lecture videos over 2 hours, 3 hours, 4 hours, 5 hours. These are lectures, full lectures on all level 2 and level. Welcome back to our YouTube channel, and today we want to continue with our tutorials. And today basically we want to look at the performance of the firm, the financial performance of the firm, because I told you we are going to start by first analyzing the ratios, then we go to corporate restructuring, we go to Islamic finance, we first handle the ISM marks, and then we proceed to the following topics as we highlighted in our overview of the course of the paper in the previous lecture. But before we look at the financial performance of a firm, I want us to finalize with the introductory part. We first look at what do we need for this paper, or what are the things should we equip ourselves with when we are going for this paper. So let's try to look at the tools to be used in the paper. In other words, in this whole tutorials, what do you need to have as the basic things that you should be having for you to be able to excel or to pass this paper with good marks? So I expect that every student at least should have latest past papers, and the past papers you should have, they should be ranging from, I think, November 2018 to date. Just have the listen, because given the fact that the syllabus was revised. And the other thing that you need to note is that you are supposed to have the listen past papers. These are going to be past papers, but you also make sure you also get and their marking guides or solutions, at least from November or May 2018 to date. So if you get those past papers with their respective solutions or marking guides, I know some marking guides have some errors, but we shall be able to highlight some of these aspects as we go on, but have those with you. And that's one. Then the other thing that you need to note on these past papers is the fact that we have a new examiner. The previous past papers we had a different examiner. So the old examiner started those papers that from November 2018 to So I think August 2019. These were for previous examiner. So the new examiner is starting from November 2019 to date. So we want to utilize this. The reason that's why we are picking some more, at least we are picking some more past papers from the previous examiner to see how this person was actually setting these aspects. But if you try to compare and contrast, you'll be seeing some small difference in how the old examiner used to examine the paper and based on how the new examiner is doing it. So this November 2018 to 2019 to date will give you some challenge. It will make you understand, because previously things were a little bit direct, but they were not all that direct, but they were somehow direct. But here the things are not all that straightforward, but they are easy to understand as long as you understand the concept. So the older past papers below November 2018 were not all that hard. So even if you try to compare, if let's say you compare numbers of 2018, let's say June 2018, and you compare them with the numbers of, let's say, September 2022, you will see that they are totally different questions. I know that given the fact that the syllabus was about to change, but there are some slight differences as we shall be able to look at. So we want now to focus on the financial performance of a firm, financial performance of an organization. So financial performance, it's a topic that it remains a little bit silent in this new syllabus. It's there, but it's hidden. It remains a little bit silent in this new syllabus. And this new syllabus, it talks about it very briefly, where under the financial markets, if you look at that detailed syllabus, financial markets, that's where it was brought. And it is a little bit silent. And the way they brought it, it's as if you're just going to be using what we call the use of market ratio, use of market ratios. So when you try to look at that detailed analysis, under the financial markets, you'll be seeing use of market ratios in financial decisions. So it is a concern that we can see, but it is a bit hidden. In other words, the examiner is only talking about the market, these market ratios, because we know that is only talking about the market ratios and is ignoring other ratios. Is talking about market ratios in a sense that these other ratios, we did them on our level 2 financial management, but on the advanced, because the market ratios on level 2, we don't look at it in detail. We always focus on the detailed analysis of these other ratios, but we give out the we talk less on the market ratios, and that's why the examiner is bringing them here, only market ratios. But that doesn't mean that he can't examine other ratios, and that's why we can't trust the examiner to say that we are not going to revise the market ratios, because we have some numbers that happened, especially in the previous syllabus. So they are talking about market ratios because the examiner expects us to be knowing the other ratios, because those other ratios, we talked about them in our financial management. That is a paper on level 2. But that doesn't conclude that the examiner can't bring a number on ratios. In the old syllabus, we saw the examiner examined the ratios September 2022, question 2. That's when we started to seeing those numbers coming up. And this number, actually, majority of the students didn't do it. because it came as a surprise to them because they never expected it to appear. They thought it is a paper that is, it's a number that is supposed to appear in the financial management paper on level 2. So when we are doing these ratios, we make sure that we analyze the performance of the firm. We look at all the ratios. So I'm going to try to teach it in my own perspective, but just nothing much I'm going to communicate, because these are some of the things that you already know. We are just going to have a recap on what should be done. But what you have to understand is that we want to start with financial performance of the firm, and I'm going to teach it in my own perspective. And after this, then we shall look at corporate governance. So I want you to kindly note that, because it's something that is going to be of more important. So let's look at, we know that those financial ratios, the ratios, they are within the topic of financial analysis. So when you are told to do financial performance of the firm, to evaluate the financial performance, you're supposed to use ratios. So when you want to analyze the performance of any company, we shall use, it is always, we use ratios. Even though there are other methods that we can use to analyze, there are other methods. The other methods that we have that analyze the financial performance, we have the short analysis. These ones can also analyze. We have the Pastel, we have the Boston Consulting Group, BCG, we have Porter's 5 Forces. These are things that you will have in your business strategy paper, that paper about leadership. That's where some of these things will be in. So we don't use, even if you can analyze the business using these tools, we always analyze ratios. The reason why we are analyzing using ratios is because here we are basically looking at the financial aspect. So we use ratios to analyze. But now, when you are dealing with ratios, ratios are divided into 5 categories. 5 categories of ratios. We have 5 categories of ratios where we can analyze the profitability of the company, where you can analyze the liquidity, where you can also analyze the gearing of the company. The fourth one is the investor ratio, or what we call the investment ratios. And these investor ratios, or the investment ratios, these are the ones the examiner is calling the market ratios. And this is where the syllabus is focusing on these ones, the market ratio. But the last one, or the last category that we have, is what we call the efficiency ratios. And this looks at how efficient are we managing our working capital. So this one is basically more on working capital management. And we know that on level 3, of course, we don't go so much into the aspects of working capital management. Those are done on level 2, financial management. But here, the working capital, we don't talk about much about it. But that doesn't explain the fact that the examiner can't ask them, because he knows you studied these things on level 2. That's why these papers are interlinking. They also have exemptions that you can't do financial management and at the same time you do advanced financial management at the same time. It is impossible. They don't allow it. Just like the same way you can't do taxation on level 2 and at the same time you are doing advanced taxation, because most of the times the papers may be set at the same, or they may be done on the same day. These people on level 1, on level 2, they are doing taxation, and also at that same time the one is on level 3, they are doing advanced taxation. So you can't be here and at the same time you be the other side. Just like the way you can't do financial accounting at the same time you are doing financial reporting, or doing financial reporting and at the same time you are doing advanced financial reporting. So those are some of the things that you have to be careful with. Even though it's not all that in the syllabus is only talking about these market ratios. And the reason why they are not talking about these other ratios is because we looked at all these profitability ratios, we looked at liquidity ratios, we looked at gearing, we looked at efficiency ratios on level 2. Even these ones, we mentioned them, the market ratios, but we didn't go much into details. So here, the syllabus wants us to have a detailed analysis on those marketing ratios. So that's basically what the examiner will be targeting. And most of the times here, they may not tell you to compute, they may not specify that you compute such and such ratios. They may just tell you, evaluate the performance of the business, write a report based on the information given above, trying to evaluate the performance of that business in the question. And it will be upon you to look for the ratios that are falling into these 5 categories that we have. Maybe you give like 3 here, 2 here, 2 here. Let's say even here you give 2, even here you compute like 3, and you make a decision. You don't just compute. You have to defend your answers. You remember, we said for ratios you must explain your results. So, what do we need to do when we are handling any number on ratios? So, we want to look at when we are analyzing resources, when we are analyzing ratios, what do we focus on? We don't simply compute ratios. When we are analyzing ratios, we compute, and at the same time we do what we call either a trend analysis, or we can look at the performance, how maybe the performance is based on the industrial average, based on whichever information that they have provided for us. So we don't simply compute ratios. You compute, then we also do what we call trend analysis. So we compute the ratios, then you go ahead and do a trend analysis, and by trend analysis, because of course you compute, let me just be methodical. You compute the ratio, then you also come and do trend analysis, basically. And when someone talks about trend analysis, you look at the performance of the company. You compare the performance of the company, maybe for a given year, maybe for this year 1, let's say this is 2020 to 2023, or 2021. Then this one is 2019. So you keep comparing the performance of 2019 with that of the preceding year. If this one we had 20 million and this one we have 25, it means there has been an increase of 5 million. That's what we call a trend analysis. There has been some improvement. If this has been maybe 15, but this one is 10, then it means there was a decrease in the performance of the company. So when someone talks about a trend, you look at the performance of the company, maybe this year, in line with the different years. If this one, maybe this one came to 22, maybe this one went back maybe to 30 million. So you'll be seeing that this one, they performed better, they reduced, but again, they rose up. But here they performed, increased, but here they went down. So that's what we are trying to look at. What is the general picture of the performance of the business? Has it increased or has it reduced? So we look at either there is a growth or there is a decline. So basically, when you're trying to look at trend analysis, you are looking at a growth or a decline. And this is how you will be explaining. You base on either the decline or the growth to make sure that you make a conclusion. So that's one aspect. That's one way of how we can analyze ratios. The other way, the second approach that you can do analysis of the performance of the business or analyzing ratios is we can look at the performance. We can look at the performance of other companies in the similar industry, in the same industry, and then we make a comparison, and then we make our comparison. So for example, we look at the businesses that are within the same sector. Let's say maybe we are trying to analyze the performance of, let's say, communication sector, media houses. Maybe we have, let's say we are in communication industry and we pick out two companies. We can look at MTN Group, and then Airtel company or group. So we try to look at the industrial averages. We look at the industrial average. If you are the accountant in MTN, you try to look at what is the industrial average of the whole sector for communication. You compare that with how you are performing to see your performance vis-a-vis the industry. If it is a manufacturing company, you look at maybe Kakira Sugar, you also compare it to maybe with Rugazi to see how that sugar manufacturing is moving. So we may have these industrial averages as our benchmarks. We have those as benchmarks for us to be able to analyze our performance. So just like the wife said, you can look at MTN Uganda, you can compare yourself with the industrial or the sector average. The sector averages will be, of course, given to you if at all they want you to look at the performance based on the industrial averages. And most of the times these companies, they compare. If at all you are to make a comparison between two companies, they must be at the same, at least almost the same level, but they must be in the same industry. You can't compare a manufacturing company with the communication media house. It will not make sense because they will be having different risks. But the reason that's why we are looking at the industry is because we expect that all companies that are within that sector, they are facing the same business risks and other kind of risks. So the third way that we can analyze ratios The third way could be, we may find ourselves that we are not comparing. You don't compare industrial average. You don't compare industrial, or what we call the sector averages. You don't compare the industrial or sector averages. And you'll find yourself, maybe you could look at a company in the same industry, a company in a similar industry. It's different from the one where you are using the industrial average, because here you'll be going by MTN, Airtel, and MTN. You compare the performance of Airtel vis-a-vis the performance of MTN. But with industrial averages, you just compare. You have one company, let's say Airtel, then here you have the industrial averages that you are comparing against. So you are comparing your performance with the industrial averages. But here we compare company with company, and these companies are supposed to be in the same industry. And these companies, the other thing is the fact that they are supposed to be of relatively equal size. If I'm comparing Rugazi Sugar Company and I'm comparing it with Kakira, but you can't compare a startup company with a company that has been there in existence for so many years, especially when this company has just started and it hasn't accumulated anything. Now, at the end of the day, these are the three ways that we can analyze ratios. But at the end of the day, the examiner wants us to write a report. As I said, we basically look at a report. At the end of the day, the examiner will require us to write a report explaining maybe the performance of the business. So you will start with the report. You will write the report based on the computations. Of course, you will bring the computation after writing the report. Now, someone is going to be wondering, what should I be doing, or what should I put in the report? Of course, in the report, you will put the computations. You will just bring in the results. You will put the computations as your workings, as attachments. Of course, we know that attachments, they are going to be in the appendices. We explained how we'll be able to do a report and a memo in our videos. So, but what you should know is the fact that if you are going to be writing a report and you are going to be dealing with ratios, the first step is to do the workings. And these workings, because you need workings that you are going to reference your results to, the report will be a brief aspect. But when you're analyzing your workings, these workings are going to be in three ways. You follow these modules or these three steps. Number one, you state the ratio and its formula. Number two, you compute the ratio. Number three, you interpret or you comment on the results. You don't just compute. So whenever you are talking about ratios, you are supposed to do them using these three steps. So some students, they just compute and they don't comment. So if you end on computing, you will be not it doesn't mean that you are going to be marked wrong if you stop here, but you will not get this one extra mark for commenting. Even if they don't tell you that you comment, for ratios we comment. Commenting carries at least 1 mark. And we've said that when you are commenting, you are just trying to do a trend analysis, just explaining whether there has been a growth or a decline. And that's all that you need to understand from the financial analysis or ratio analysis. And that's the recap I wanted us to get. I'm not going to go into giving the formulas. We shall just do numbers because I expect that you'll be knowing the formulas. But get the other aspect that here, the examiner will not specify which ratios to compute. Most of the times, the examiner just tells you, assess the performance of the business or assess the financial performance of the business based on the information given above. So you'll find yourself you have to group these ratios into those 5 categories, and then you make computations. So that's basically what I wanted you to understand. The rest is just all about doing numbers. The same way we've been doing numbers is the same way that we are going to do them here. But that's some small analysis I wanted you to have. So the other topic that we are going to look at is going to be the Islamic finance, but this is going to be in the next video. Islamic finance. It's a new area on level 2, but here we've been having this Islamic finance even in the old syllabus. So Islamic finance, we are going to focus on how we can be able to get the easy marks, because we said with Islamic finance, that's one way of how we can be able to get the easy marks. Now, Islamic finance, as we said in the previous video, that the easy marks are here, and it's what we are going to put in context today, so that you can be able to understand what is involved within the Islamic finance, based on the fact that this is an advancement of what we covered on level 2. So most tutors or most lecturers, they teach Islamic finance as one of the last topics or towards the end of the syllabus among those last topics. But my approach is to bring these theoretical aspects that have a higher potential of appearing in question 1 first, so that we first get those easy marks. So my approach is to bring these ideas, these aspects, things of international concern first in this early period, so that we understand this theory before we go into the computations, because I also know that the computations are going to, by the time we reach on computations, we are going to find ourselves busy. So if we get this first, it will be one way of saving time as far as managing passing is concerned. So this is a new area, especially in Uganda, and it's a new area that we need to clearly first understand before we get busy into these computations. And as I said, it is an international concern, so we have to put it in context early. I hope to finish this Islamic finance, then I go back to corporate governance, because we said that corporate governance and Islamic finance, those are the 2 topics that have a higher potential of appearing in question 1, section A, question 1. So I want us to first understand those 2, then before we get into the computation, so that we can first maximize those easy marks. And that's why that's the approach I'm using as to why I'm starting with them. So want to understand the theory behind this Islamic finance. But one thing that you need to appreciate is the fact that in this paper 15, Islamic finance is examined in question 1, and it is always there. If at all you look at the past paper numbers, it's always there. It is always there because it is an international concern. Remember, we saw the examiner's expectations. They expect us to be knowing things that the modern developments that are coming in the area, that are coming in the area of finance. And this is one of the things. So it's an international concern, and we need to capture this is a marks. And you can find a question, it can take up to 10 marks. You can find that question and it is taking up to 10 marks. Just like the way if you look at question 1, part C, June 2022, where the examiner tells us to discuss the benefits that a company would derive in using Islamic finance. So such questions, it was asking the benefits that a company would derive in using Islamic finance and the likely drawbacks it would face, and they gave it 8 marks. So if you see Islamic finance is carrying 8 marks, so it means it's an area that you need to look at in detail. So here, specifically in this question, he just wanted us to look at the advantages and the disadvantages of Islamic finance, which are not hard to answer, and anyone can actually be able to score those 3 marks. We have some other questions that we can reference on. Questions we can look at, I've already talked about this question 1, June 2022. We have even March, also March 2022, it was there. Question 1, part G. This was 6 marks. We also have December 2021, question 1, part E. That was part E. It was also carrying 6 marks. If you look at also December 2020, question 1, part E, it had 8 marks. The other, you can also look at August 2018, question 1, part D. It also had 8 marks. If you look at November 2018, question 1, part B, Roman numeral 2, it also had 6 marks. Even if you look at May 2019, question 1, part E, it had 8 marks. August 2019, question 1, part E, had 9 marks. Also, November 2019, question 1, part C, this was 4 marks. And the highest when they brought it as a standalone question was in August 2016, question 3. It was carrying 25 marks. So such a number or such a topic is really something that we can predict and say that we should understand it. So we are sure, even if we just take it at the bare minimum of getting 6 marks, bare minimum of looking for 6 marks, that you are sure if I understand Islamic finance, I've got my 6 marks as a benchmark. You will be looking for only 44 minus doing any computation. So if it happens that we have also corporate governance in the same paper, then it will be something that you need to focus on and put some emphasis. So let's try to understand what Islamic finance is all about. That was just like to get ourselves started to what we are looking at. We look at the likelihood of this to happen. One thing that you need to note is the fact that not all Muslims actually understand Islamic finance. Don't say that these are things for Muslims. No. These products, they are a bit new, especially in our country. I've seen Salam Bank, I think. At least I've seen so many branches of it. They are coming up. So let's now try maybe to look at the introductory part. So introduction to Islamic finance. We first shared some background of how it came into play. Introduction to Islamic finance. Now, Islamic finance rests or bases on the application. It bases on the application of Islamic or Sharia laws. Application of Islamic laws or Sharia laws. That's where it gets all its powers. And when we say Sharia laws or Islamic laws, basically Sharia laws, we have two things. We have, if we talk about the Sharia law, we have two things. One, we have the Holy Quran. I don't know whether that's the correct spelling. Quran. Then we also have the sayings of Prophet Muhammad. The sayings of Prophet Muhammad. And these sayings, they are the ones that are backing up. These sayings of Prophet Muhammad, they are the ones that are backing up the Sharia law. They are actually the ones that are backing up this Sharia law. So, all these sayings of Prophet Muhammad that are backing up the Sharia law were merged into what we call the Holy Quran. So they are the ones that are giving us the scope of things that are supposed to be included and those that are not supposed to be included. Then if we try to maybe to look at how it came into existence, how Islamic finance became operational. In other words, looking at the history of Islamic finance. So the issues Prophet Muhammad used to talk about in those years, they are the ones that started this process. They are the ones that are going to guide us on what is supposed to be included. Of course, those sayings came about as, from the time Islam came into existence, or the process of Islamic faith started. So, the other point that you need to take, or that you need to understand, is the history, how it came into existence, but not necessarily how it came into existence, but what are the recent developments, because we can't be living in the past, but we are using the past to see what is happening. So We now need to look at the history of Islamic finance. We just want to look at the origin, how it started to operate. We've known that it came from the aspect of the Sharia law, that the law that was basing on the sayings of Prophet Muhammad that were organized into what we call the Holy Quran. So our interest is not to go deep into what the Quran is talking about, but we want to pick out the basic principles that are going to help us navigate through this aspect. So we need to know how it came about, the recent history that we have. Of course, based on the books we have from 70s, 1970s. That's basically how we can document what we are doing. 70s. This is when we started to see Islamic banks internationally. Islamic banks, actually these were in Saudi Arabia, UAE, United Arab Emirates. That's when those banks were launched. And it's now, to date, of course, it's now estimated to be worldwide to be around $2 trillion in assets. $1 trillion of assets. In other words, it has developed over years, because we've tried to see very many countries have started having the both. Of course, like here in Uganda, we have both the commercial and also we have the Islamic point of view. But we shall see what differentiates Islamic banks from the conventional banks that we know. But all the aspects, all the formation of these Islamic banks is as a result of these banks following what we call the Islamic laws. So all these, we've seen that over $2 trillion US dollars of assets, they are following that pattern of Islamic finance. The rules, of course, they are rules of Islamic that are governing Islamic finance. So Islamic finance is now a global thing. And that's why, even being that CPA is also an international stuff, it is something that you can't avoid. So Islamic finance is becoming widely recognized. I've told you that even in Uganda we have some banks. Of course, in the past we had issues on how they can operate alongside with these other conventional banks, but at least we are seeing some, but the industry is just developing. So it's something that we need to understand. And of course, the examiner will not ask you anything on the definition that you define what an Islamic finance is. There is also no need for you to read the whole Quran to know what Prophet Muhammad was talking about, in order for you to understand, to be able to get the concepts that are going to help you pass. No, some of these things we just pick out few things, especially the rules that are governing the applicability or the application of Islamic finance and its Sharia laws. So you don't need to read the whole Quran to be able to understand Islamic finance, but you need to have just a brief background. If you are given a question, you can just give a brief background about what it's all about. So the examiner will examine you on the principles. These are some of the things the examiner will ask you on. The examiner will ask you on the principles of Islamic finance, principles of Islamic finance, and therefore you need to understand what they are. There are more than 10, but for us we shall talk about like 6 or 5. We analyze them in detail because these principles, they are the ones that are going to guide us on what is supposed to be done, what's not supposed to be done. Principles of Islamic finance. So we can maybe mention some of them, then we come into the next video and we give a detailed analysis of what these are. One of them, we have paying or charging interest. Because we know from the banking perspective, the business operations are supposed to be earning interest. From the banking perspective, we know that. So we want to know, how is Islamic banking or Islamic finance affecting or reacting on the issue of paying or charging interest? What are the principles? What are they saying about charging interest? Those are the things that we are going to analyze. 2, we have investing in business. Investing in business involved in prohibited activities. Businesses involved in prohibited activities. There are some prohibited activities that they don't want to say that we've got an Islamic finance or an Islamic bond and you are investing in such kind of business. There are those that are prohibited, as we shall look at them. But we need to understand, because if you are giving finance, if it's a source of finance, then you are supposed to be funding operations of the business. But where you are supposed to put money, there are restrictions that you shouldn't put money in such and such activities. And those are the ones that we shall look at. So we want to look at what those activities that are going to be allowed as per the Sharia law. 3, we shall talk about speculation. Speculations. How is Islamic finance handling the issues or businesses to do with the speculation, like gambling, holding products so that you can overcharge customers, things to do with, let's say, betting companies, things to do with other businesses that derivatives, like those who are dealing in forex and other kind of business. We shall be seeing how we can be able to navigate through those. What are they saying, or what is the Sharia law talks about in regards to speculation? Then we shall also look at how you deal with uncertainties and risk. How does it deals with, because in banking we know risk and uncertainty, it is there. You give people money, you are sure some of them will not pay. How are they tackling that aspect? So how to deal with risks and uncertainties. The other, we shall also look at the fact that risks are supposed to be shared. Risks should be shared, and we shall be seeing shared among which people. They are also saying that wealth must be generated from legitimate trade and asset-based business. They are saying for them, you don't just give out cash, but the the physical asset you should actually have a physical asset that you are giving the money against. If someone wants to borrow money, the person should tell you what he's going to do with the money that they are borrowing. So they are looking at legitimate business. In other words, you don't have things to do with man on money kind of transaction. They are not existing there. So these that we have highlighted, there are very many others, but as I said, we can't just read the whole Quran to understand what we just pick the few things that we need. So these that we have highlighted, they are just an outline, but we need to understand them one by one in detail and what they mean. Because if you understand these principles, they are the ones that are going to enable you on anything you are going to be doing. If you are explaining the types of Islamic finances, if you are explaining the benefits, you should be knowing the scope that if I'm to apply finance, Islamic finance, if I'm borrowing money, if I'm getting money from an Islamic bank, I'm supposed to do that money for such and such activities. There are these activities that I'm not supposed to put the money that I've got from that idea. Then we shall also look at the advisory. How are they advised? Who supervises the activities? Because you can't, like for commercial banks, we know that commercial banks are regulated by the central bank. For Uganda, it is the Bank of Uganda that is regulating all commercial banks. So who is going to be regulating the Islamic finance? Of course, they will have their supervisory council. We need to know what are the functions of the Islamic council and what are they going to be, which kind of compliances do they need. Of course, they are complying to the needs of the Sharia law. That's where they are complying. They have to see that these banks, they are being given licenses, but they are operating in a sense that these are actually being regulated. Because someone can lie that we are providing Islamic finance, but they are not actually following the principles behind the Islamic products. So those are some of the things that we are going to look at. Detailed analysis of the principles. Then we shall also look at the advisory council, what its makeup should be, and what are the things that are supposed, what are they mandated to do. We are going to give a detailed analysis of those principles of finance, principles of Islamic finance. Now, one of the principles of Islamic finance is paying interest, paying or charging interest. Paying or charging interest is prohibited. Is prohibited. So the reason as to why it is prohibited or it's not allowed to charge interest is the fact that Islam considers lending with interest payment as an exploitative practice. Lending with interest payment as an exploitative practice. So given the fact that these people, they don't charge interest, it doesn't mean that these people are actually giving out money for free. No, their argument, we shall see how they treat these, some of the excesses that you pay and how it's determined. So for them, they are saying that lending with interest payment is treated as an exploitative practice that favors the lenders. Effective practice that favors the lenders or the banks, that favors the lenders at the expense of the borrower. They favor the lenders at the expense of the borrowers. It's like they cheat the borrowers. That's how they look at interest. So here in Islam, interest is treated as riba. So for them, they treat interest as a riba. For example, if let's say a bank that has, because most of the times what happens in these banks, especially in developing countries where Islamic banks have just started emerging, what happens is that we always have a commercial bank or a conventional bank. That commercial bank, like we can use, let's say, Standard Chartered Bank, because I heard they have some window for Islamic finance. So if what happens is that the bank is going to have two windows, the Islamic window, then the normal business window. So this window is only going to be looking at Islamic products alone, and they are going to be lending out money not to Muslims alone. No, the principle operates even to those that are not Muslims. But the application of these principles, they are the ones that keeps the Islamic finance different from the conventional banking products. So what happens is that this side, they don't charge no interest payment, because they call the interest as riba. So this side we charge interest. The normal commercial banks, they charge interest on whatever amount that you've borrowed. But what these guys are saying, if you are that bank, because Standard Chartered Bank has two windows, the window for this Islamic finance and the normal retail and business, trading business. Now, what happens is that you are going to have Islamic products, and you are also going to be having these other non-Islamic products. We shall look at the products. And those non-Islamic or those other products that you are going to be selling to your customers, you are going to be charging interest. They are going to be charging interest. But now, what happens is the fact that if it can happen that maybe you have established your bank, let's say we are going to go with the recent example, that is Salam Bank. Now, it's going to happen, there are situations where you may be tempted to have two windows, where you have the Islamic window and also the other side. I don't know much about the operation of this, but I know they are giving out Islamic products. They are Islamic products. I'm not sure whether they are actually providing two. But for a scenario whereby you are providing two items, it's going to be problematic in a sense that the board, if let's say you're a business and you want to go and borrow money, these people, the bankers, shareholders, they may be saying that for them, they may be interested in just giving out Islamic products, but you are going to find that the kind of operation, it may not be sustainable for you to sustain the business. So that's why sometimes if the Islamic products, if a bank is running two products, It means the shareholders may be interested in having the Islamic products, but at the same time, they are also having the other point of view. So this Islamic side is also going to be governed, or they are going to be using Sharia law to regulate its operation, that Windows operation. But now, if the shareholders entirely recommend that let the bank use Sharia law, even if you have two windows, but we go by Sharia law, what is going to happen is that the interest that you have made from this normal trade, which are not in the Islamic products, you are going to be forced to actually give out that money of the interest you charge, because they call it riba. It's not allowed. So if you charge interest, then the treatment, the regulators, we shall look at the regulators, they will make sure that you don't charge interest. So if you charge interest, that money you have charged in interest will be removed, or you will be forced to donate that money to charitable organization and other kind of people, depending on how. Most of the times they donate that money to the charitable organizations. So you may be having two windows, the Islamic window and the other window. The other window, you may be charging interest, purely charging pure interest, the same way that these other conventional banks are doing. But what is going to happen if the shareholders of that bank are totally in agreement, recommending Sharia law for their bank? Even if you have two windows, the interest you are earning from the other non-Islamic products, they are going to be sent out or donated to charitable organization, because of the fact that interest is 100% prohibited. So that's what we refer to as the principle of charging interest being prohibited from the Islamic products. The other is just like how interest is prohibited under Islamic finance, we also have prohibited activities. Prohibited activities that even if they give you money, maybe you have received a bond from an Islamic bank, we have an equivalent for the bond. There is what they call it. We shall look at those types. If you borrow money from an Islamic bank and their regulation is actually using the Sharia law, then that money shouldn't be invested in these prohibited activities. So when they give you money to go and invest, then you are not supposed to invest in those prohibited activities. So what are some of those prohibited activities? One, we have alcohol. Maybe you're a brewing company, they can't give you money. Drugs, of course, drugs like narcotics, and others. We have also gambling activities. These people who operate betting companies. We have also pork, those that are involved in piggery, things to do with pornography, and others. These are some of the activities that are prohibited, that even if they give you the money, you are not supposed to invest the money they have given to you in those activities. So if you borrow money in any of those Islamic banks, you are not supposed to invest that money in prohibited activities. But you have to be careful. It could be an Islamic bank, but it is operating a conventional business, meaning they are not issuing Islamic finance products. So as long as you confirm that this business is actually separately providing products of Islamic finance and they are being regulated by Sharia law, then we can say that that money shouldn't be invested in those activities. So those Islamic banks, most of the times, those companies, most of the times they are in those Arab countries, Saudi Arabia, UAE, most of the times, because those banks, they are very big that side. And banks in those areas, they mainly provide Islamic products. But it's unfortunate in Uganda we have very few which have just started because of different aspects. And the reason is not because we don't want them to exist, but even the regulation itself. Of course, we are going to look at the regulatory authorities, but Islamic products, they are supposed to be supervised by a Sharia law council, of which we may not necessarily, like for a given country, they may not necessarily be having those people that can spearhead those kind of supervision. They can, if you don't have those people, of course, we are going to be looking at what are the members, what are they supposed to be having. So if those people are not there, then you don't actually expect those businesses to run. And maybe that's the reason as why it took long to kick off in Uganda. But at least we have seen some coming up. So that's one way. And these prohibited activities, for them, they call them haram. That money came from drug, money came from gambling, money came from operating pork joints, pornography, alcohol. So they call that money, it's haram, because it came from the prohibited activities. So this haram is just an Islamic word, and I think even those who speak Swahili, this one must be, it has some meaning some in those that speak Swahili. If you know the meaning in Swahili, please just put the meaning in the comment section. But just know these are activities that are prohibited, and you can't use Islamic finance products to finance the activities of those businesses. So the same way maybe we deal with the interest is the same way they deal with these prohibited activities. They are not supposed to be involved in those activities. Now, the other is no speculation. So Sharia law is strictly prohibiting any form of speculation, whether it is gambling, whether it's betting, with whichever, as long as something that involves speculating, you are not sure of the outcome, but you are doing it as a business. So they call it maisir. I don't know the pronunciation, but I think maisir, M-A-I-S-I-R, maisir. These are just words, but just get the meaning from the English perspective. So some of these, like I've said, for the betting companies, of course, they don't qualify, given the fact that their kind of work is more of speculations. There are chances, there are probabilities, you are not sure of the occurrence. So gambling and other kind of stuff. So There are also there is also a kind of speculation whereby the wholesalers, they buy products in large quantities and they hold those products. They don't sell them to the people, hoping that these prices will actually go up. So that kind of involvement is not allowed, because that's one way of speculating, because you are keeping the products so that you create scarcity and you'll be able to sell as far as the price has gone up. So that kind of speculation, where the thing of trading, forex trading, you anticipate maybe the dollar will move up, you buy, then you keep selling. Those kind of business, those are speculative businesses. So speculation is not allowed. They call it mycel. So what is going to happen is that most of the time we say, remember, these are going to be cases. They may mention these words, mycel, in the case, haram, riba. So you just have to know what they mean in English. Then you'll be able to explain. You are not supposed to explain in Arabic. But as long as you understand what it means, then you can be able to explain based on the scenario that they have given you, because you may find this in a scenario or in a case study. So you have to just know what it means and you explain, and that's all. Therefore, these Islamic financial institutions cannot be involved in contracts where the ownership of goods depends on uncertain event in the future. Just like these things we do in accounting, because we account for option contracts. Those, when you're dealing with the futures, those things, they are not allowed. We shall look at these option contracts and futures maybe when we go to the other side of hedging interest rate, hedging some. That's where we shall look at some of those different aspects, because those that are going to be involving predicting, because you can have a contract and they are telling you maybe you are buying goods from outside, overseas, maybe from Japan, raw materials, and you are not supposed to pay in Ugandan currency. Maybe you are supposed to pay in the dollar currency. You can fix the dollar, that I'm signing an agreement. By the time you ship these products and they come to me maybe in 4 months, I will be paying you at this fixed rate of the dollar rate, the currency rate. Because if you don't do that, the dollar may keep on changing. You get an order and they tell you the dollar, you are going to pay maybe 20 million. But due to exchange rate, you find that by the time the goods come to your side, currencies have increased and you are going to be paying more money than what you should have paid if at all you had to pay at the time when you made an order. So those kind of hedging, those kind of risks in forex, those are more of speculation. So these kind of things you are hearing me talking about, hedging, things to do with the option contract, they may give you a scenario and it is just talking about those. Then they explain, they tell you to identify the principles, but they are just giving you examples of these. So the case is going to be rotating on some of these aspects. So the things to do with the hedging, we shall learn more about it. We shall do hedging and we shall see how we hedge against some of these risks. And some of the tools that we use, those are the ones that we call futures. We have what we call the swaps. We have traded options. We shall look at some of those and others. So therefore, these are more like speculations, and we are not, because you just keep on fixing and you are not sure of what will be the outcome. So those kind of scenarios, they are not allowed, because you are not going to be sure of what is going to happen by that time. So you are just hoping by that time, maybe if I come up with this contract, then this is how we shall manage the risk, etc. So such aspects or such activities are not allowed in Islam. Then we look at the other. We have uncertainties and risks is also another principle. And the rule of Islamic finance banned participation in contracts where the terms and the subject matter are uncertain. They tell you we sign a contract, maybe we expect that maybe we are going to win. You bet. So when the terms of the contract and also the subject matter, there's something that you are putting your money against is not sure. You are going to borrow money, but you are not sure whether you are going to make a profit or you are going to make a loss. The subject matter is not clear. So if it is uncertain and it has excessive risks, then this is also going to be prohibited. This aspect of uncertainty and risk includes prohibition on selling something that's like you try to sell something that you don't own. You are selling something and you don't actually own the thing. Like those things we do, like the things that we do in accounting, these derivatives, which are more like gambling, where you are involved in trading something even when you don't own it. Even there are these brokers who actually advertise that they are selling land when they actually don't even have the land, but they are just connecting people. I know the other one is selling, so let me get the buyer. That kind of activity, and you tell the buyer that the property is actually yours when it is not actually yours. Those kind of transactions, they are the ones that because you are not sure of the event that is going to come out. So the other principle of Islamic finance is that risk should be shared. Risk should be shared. Of course, we are aware that in business, even the Islamic banks, they are aware that in business there are risks that are involved. Therefore, in Islamic finance, the partners will share the profits, and at the same time they will share the losses according to the part they played in the business. If we come together and we do business, we make a loss, we share that loss in the way that we became part of that. What, like you share what you contributed according to how you contributed to that loss. But we are not supposed to say that we are going to be sharing these losses equally. No, we share according to our participation, if at all that is a business. So it's according to how you are in the business. If I bring in capital, if I'm the bank, I'm the Islamic bank, and I give you money, you make a loss, there is no way you can tell me that we are not going to share losses, because I didn't borrow your money to actually go and make losses. The intention wasn't to make loss, but I made a loss. It's different from the conversion. The other side, the commercial banks, if you make a loss, it's your loss. For us, we gave you our money, return the money. But now these ones, they also add in something that they don't have guarantee on returns. If you come together to do business, then there are possibilities that you may actually not get the profit. So there is no guarantee that you are going to earn a profit. So no guarantee on the returns. Therefore, there are risks, but of course they recognize the fact that there are risks that are going to be in the business, and they are going to be shared between the lender and the borrower. For example, if let's say I have lent to you, if the bank lends me, let's say 20 million, if they have given me 20 million, and maybe for me to go and invest in, let's say, a bookshop, but before the bookshop starts, the money is stolen. Before I start even doing anything, the money is stolen. So what will happen according to Islam? The risk must be shared, because I never intended to actually let this money be stolen. So the money, the loss will be shared. And at the same time, if we start a business, if at all money is not stolen, I've started a business and I've made a loss, then that loss is also supposed to be shared, because my intention for me to join business wasn't to make losses. So you shouldn't penalize me because I've made a loss. So that's why they are sharing these losses. And if you make a profit, then it's also going to be shared. It's more of a partnership. So the logic here is that when money is stolen or the company has made a loss, the loss must be shared, because no one expected it to happen. And that's why they were restricting us from investing money in those uncertain activities, so that we invest in legitimate trade, something you are sure you are not just throwing money, and that's why you can be able to benefit. But there are scenarios that I can give you money and you invest in those prohibited activities, and you expect us to share the loss. That won't happen. So that's why they are saying you share the loss based on how you involved. If you're the one who actually made that loss, or maybe you are the one who stole the money by yourself, and you start saying that the money was stolen, then it will be upon you. Now, the last one that I want to look at is the other principle is wealth must be generated from legitimate trade, and it's supposed to be asset backed. It's supposed to be backed by an asset. So they are saying that wealth must be generated from legitimate trade, and it must be asset based. It must be asset based investment. In other words, we don't have money on money transactions like what happens with the lenders. They give you money and you go and do any business you want, then you bring back their money. No, these people, they tell you, if you want to buy, if I'm borrowing money to buy a car, it will be the bank to go and pay the bond owner, the car owner. Then they give me the car. Of course, they pay the other car, they buy for me the car, and they give me the car, then I start paying money. But I'm going to be paying the amount that they have spent to buy that car. Secondly, we may agree to add in some extra amount just to take care of the the administration costs that are going to be incurred, but that is going to be on agreement that I'm buying for you a car of worth, let's say 50 million, but in return for you will be paying 55 million for a given period of time. So you will be paying that knowing you have agreed and you have accepted that the other 5 million is coming in to just necessitate the operations of this business. But it doesn't necessarily mean that these guys are going to give you 50 million and you give them 50 million back. No, that's not how it works. But that's how it seems to be. Because the other cost that they are going to charge you is like a nominal cost. They add in that just to cater for these extra expenses that may occur, because they can pay a motor vehicle for 50 million. But remember, there are other paperwork, transferring the logbook and other costs. So you'll find yourself on top of the 50 that they have paid the car owner, you will be ending up paying more, but that amount is supposed to be agreed between the two of you. So therefore, those are some of the principles that we are going to see here. So I want us to look at the regulatory framework for Islamic finance. We look at how it's going to be regulated. What are the parties that are involved? The regulatory bodies for Islamic finance. So this has never been examined, but at least we need to have it in mind. We need to make sure that at least we can be able to understand what we are doing. But you have to take note. As I said, I'm presenting it in the same way it is supposed to be taught as of level 2 financial management paper, because they revised what was on level 3 and they took it to level 2. But the examiner has a right to pick from the concept that we studied from the financial management paper that's on level 2. That's why I'm taking it from the very basic point of view. So, but I'm going to highlight the things that we were supposed to cover as far as Islamic finance for advanced financial management is concerned, because there are very few basic things that we are supposed to pick, with the assumption that most of the things you studied them in the financial management. In other words, we have got two regulatory bodies that regulate Islamic banking. One of them is the accounting and auditing organization. Accounting and auditing organization for Islamic financial institutions. That is abbreviated AAOIFI. And this was established in 1991. Of course, as I said, this Islamic finance is more in the other side, the Arab countries. So it was established in 1991 in the Kingdom of Bahrain. And it is the one that prepares. Its role is actually, the role of this is to prepare. It prepares accounting, it prepares auditing, it does governance, it does also providing the ethical and Sharia standards. That's what it does. So this body, the AAOIAI, that is Accounting and Auditing Organization for Islamic Financial Institutions, has issued, so far it has issued over 56 standards, and it has membership spanning to 28 countries. Of course, as I said, this keeps on changing. So members keep on coming with over, of course, it has over 110 institutions. And in Uganda, as I said, we have, of course, even these, they keep on increasing over time. Because just like in Uganda, we had no Islamic bank, but now we have that Salam Bank. So you can see they keep on evolving. So that's the first body, or first regulatory body, that prepares the accounting, auditing, governance, ethical, and Sharia standards. So the second one, of course, now we are looking at the international one. The second one, the other body that is regulating Islamic finance is the Islamic Finance Services Board, IFSB, Islamic Finance Services Board. So now this one is setting, it is the body that helps to set standards. This is a standard setting body, and it is based in Malaysia. The place is, that is the place. I don't know how you pronounce that, but what I know, it is in Malaysia. And you've said it has over 110 members. And these 110 members, they include regulatory, some of the regulatory bodies, like of course the IMF, International Monetary Fund. Of course, IMF will not miss, World Bank will not miss. Of course, even the Islamic Development Bank. So most of those are the key international bodies that are responsible for regulating the operations. So even these banks, they are supposed to be compliant on those standards. They have standards on how they prepare their own staffs. So we want now to look at regional basis, regional regulators. We look at, depending on where the bank is. If the bank is in Uganda, if the bank is in Nigeria, what are the regulations that are there? Now I want to look at other regulations, but these other regulations, they are local regulations, or that are on a country level. These are international regulators. So let's look at other regulators, other regulatory framework. Now we are going to base on what is happening in Uganda. What are some of the things? Now, the new syllabus, it's talking about regulatory framework, and it points out the following. But what it points out, you'll find that it's taking most of the financial institutions. So let's look at what the syllabus is talking about. These are locally, or they are countrywide. So we have the Financial Institutions Act of 2016. Of course, this is for all financial institutions. Financial Institutions Act 2016. This one, its role is it governs all financial institutions in Uganda. And it is the one that is providing regulations of Islamic finance. Number two, we have, of course, when there is an act, expect there to be a regulation. You know, the act is always brief, but the regulations are always detailed. These regulations, they are the ones that stipulates, or they are the ones that give detailed analysis of what the act is actually meaning. So we shall also have the Financial Institutions Regulation 2018. But this is basically Islamic banking. Then we have also the Insurance Act of 2017. Insurance Act of 2017. We also have TACFUL regulations. So these are some of the regulations that are available locally. So you can check out some of these things, like the Financial Institutions Act. That one you can download and look at it. But it is governing entire financial institutions in the country. So you can download whichever you can download and have access. You see what they talk about. And this is what they are doing. Of course, in the for examination purpose, they are not going to ask you so many things. They're just going to, if the question happens to be on these regulatory bodies, it's going to be asking which regulation and what does it do. It does what as far as Islamic finance is concerned. But just know, as I said, that Islamic finance is not all that something that it has been there for long in Uganda. But that doesn't scare the examiner from examining it. So you just need to know what it is and what it talks about. Just a brief statement of like 2 lines of what it talks about in regards to Islamic finance. Just like the way we said that the Financial Institutions Act of 2016, it governs all financial institutions. So whether you are going to be an Islamic bank, you are also a financial institution. So you are going to be regulated by that act. So that's what we are basically going to be talking about. So it's, as I said, it's a new area and the examiner is talking about it. So we need now to see if there is anything to do with corporate governance. Now we need to look at the corporate governance. Corporate governance in or under Islamic finance. Under Islamic finance. We haven't started the topic for corporate governance and ethics, but we want to look at how the institutions are going to be managed. Because corporate governance is all about managing the organization, and that's it. How the organization is managed. So since it is an institution, it's supposed to have corporate governance is supposed to be there. For any institution, if you don't manage it well, you'll find the organization is going to be collapsing. So we are going to look at some of the things that we are going to be looking at. We are going to be looking at the Sharia Supervisory Board. So want to understand because it will be the organization that is going to be looking at how the organization is supposed to be. It's the one that's supposed to guide on the entire operations of the business. So the Sharia Supervisory Board is what we are going to be basically focusing on. We see its roles, and we see the roles, and also we see the members. What are some of the members that are supposed to be part of that Sharia Supervisory Board or Sharia Supervisory Council, whichever they call it. So when we talk about corporate governance, it's all about how the institutions are directed or managed. So in Islamic banking, how do we provide guidance? And that's basically what we are trying to look at. How do we provide guidance? So there are different bodies, but I'm going to focus. There is what we call the Sharia Supervisory Board, abbreviated as SSB, Sharia Supervisory Board. And the examiner will ask you, what are the functions of the supervisory board? So before we look at the composition, let's first understand what it is meant to achieve. Because the functions, they may be in terms of the roles that they. So let's first look at the roles of the Sharia Supervisory Board, that is SSB. Now, one of the laws or the functions, it it does the review and certify the permissibility of all contracts. It's the one that does the certification of those different contracts. They may be contracts or documents, and even the products to see whether they comply to the Sharia law. So they do the compliance check to see whether those are actually complying. Number two, they confirm the existence and compliance level of the practices to Sharia laws. In other words, they look at what these banks are doing, the Islamic banks. What are they doing? Are they in line with the things that are supposed to be done? Are they doing the right thing? That's what we look at in terms of confirming that if, let's say, they have given out money, are they following up to the people that they have given money to confirm that they are not investing that money in, let's say, prohibited activities? Are those banks not charging interest? Because we say the interest is not allowed. So they do the compliance, but they are complying upon the principles that we stated earlier. 3, they also advise So they do advising and monitoring the manner of disposing the non-Sharia compliant, compliant earnings. I told you that you may be having a business, but the bank is having both the interest loans and also the Islamic products. So if the shareholders, they are relying on the Sharia law to look at the operation of the business, then the interest that they are earning from the non-Islamic finance products, they are supposed to be disposed of. How they dispose of it will be the supervisory council to look at, are they done the right thing? Because you may say we are disposing of the interest you've earned through extending loans by keeping the money somewhere in your secret deposit accounts. But they have to confirm that if you are saying you need to send the money to a charitable organization, the fact is, are those guys receiving the money? That's what we are calling advising and monitoring, because they tell you that maybe basing on the need that is available in the given location, you maybe try to donate that money maybe to the elderly, maybe you try to construct hospital, to buy Qurans for different mosques and others. So those are some of the kind of ways, but they don't just, even when they are earning that interest, but it all depends from the fact that the shareholders of that bank are willing to actually declare that they are following the Sharia law than the normal conventional banks, what they do. The other is also issuing a Sharia compliance report. Of course, after they are advising, they are monitoring of the activities that are done by several institutions that are following the Sharia law, they have to give a report that based on what we found out, maybe we found maybe such and such organizations are compliant. In terms of, they are like more in terms of auditing. You audit based on the activities that these businesses are doing, whether they are compliant with the Sharia law. So they issue out those reports based on the company's operations. Of course, the compliance reports, these reports are going to be certifying that all the transactions comply with the Sharia law. Certifying that all transactions comply to the Sharia law. Then the other, we can also look at, they can conduct and arrange trainings with different, maybe with the management of these banks, to actually equip the employees with the relevant knowledge as far as the products are concerned. Conduct and arrange for training. They conduct trainings and others. So let's now try to look at what are some of the forms. Let's focus on the forms, all the types. No, those were, but before we look at the types, let's first finish off with the composition, because we have not yet looked at the composition of the Sharia Supervisory Board. Composition of the Sharia Supervisory Board, SSB. Now, the composition is basically what are the kind of people that are supposed to be in that board. the composition, it's in terms of the membership. We look at the qualifications of these people, because you can't just take anyone. We are supposed to have certain people with the relevant information. Of course, there are those that are mandatory that are supposed to be there, like lawyers. Of course, those are obvious people, but at least the lawyers should be in understanding of the Sharia laws. So, Islamic banking requires establishment of Sharia supervisory board. In other words, if, for example, if let's say one of these banks, these commercial banks, let's say Centenary, they want to introduce maybe Islamic finance banking, then there must be an Islamic supervisory board to make sure that the flow of the information, like they keep on following up on what is done by these banks. They follow up on the business to ensure that these businesses are carried out in line with the Sharia principles or the Islamic banking principles. And those principles, they are the ones that we talked about generally. Because, as I said, you may, as a business, you may pretend that we are actually giving out Islamic products, but yet in actual sense, you are not following any of the Sharia principles or the Islamic banking principles, like not charging interest, maybe engaging in prohibited activities, and others, which is not the case from the other side of the conventional banks. So they have to make sure that they comply with the Islamic principles. Now, the examiner has ever asked the composition of the Sharia Supervisory Board. And one of the people that's supposed to be there, we must have religious scholars. Religious scholars. We must have lawyers. And these lawyers must understand the Sharia laws. They must understand the Sharia laws. We should also have economists. Of course, there is no way you're going to miss an economist, because it's going to be an area where you'll expect to have something, to have an economic benefit. So you need economists and others. And the roles of these people is actually to direct. Their roles are to direct. They are going to direct, review. They are going to be directing, reviewing, and also supervising the activities. The activities to ensure that compliance with the Sharia laws and principle is achieved. So, you may find that you are introducing an Islamic product, but people are taking the money into prohibited activities. Remember, with Islamic products, we say that those they are not supposed to be invested. The money that you have gotten is not supposed to be invested in those prohibited activities. And the other thing that you need to note is the fact that these Islamic products, they are not going to be for only Muslims. No. As long as these people, they are not going to invest money in prohibited activities, as long as their investments and all the activities are going to be following the principles of Sharia laws, they take the money. It's not basically that it is there for only the Muslim people. It's not for that community alone, as long as there is compliance. So these are some of the people, the religious scholars, the lawyers. Of course, we can have accountants, auditors, economists, and others. But the religious scholars, they are the ones that are very important because they will be the ones to do more of the interpretation. But even the lawyers themselves, they must also be equipped with an understanding of the Islamic principles and Sharia laws. Even the accountants, because we said that they have an accounting body, they have even their accounting standards. So if you want to be in that kind of past business, you have to be able to understand how they operate, even when you are doing their audit. So one of the things they do, they are directing, reviewing, and supervising the activities of the entities to ensure compliance with Sharia laws and principles. The other thing that they do, they also undertake Sharia audits. Of course, here we have also accountants, but they are supposed to be in line with the audit, and any income that is not Sharia compliant is supposed to be given to the charity organization. It's not that they are not going to be having those kind of activities, but if money comes out, it's supposed to be given out to the charity organization, or it's supposed to be donated for charity events. So if they discover that these products generated revenue, or they generated income that is not Sharia compliant, they insist and actually verify that they give it out to the charity organization, whichever advice that they have provided. So the board also is supposed to have, so these are the religious scholars, the lawyers, and then the economics. For them, they are more in the reviewing and the supervision for compliance, and even doing the audit. Then the body should also have, they should have at least, they should have a minimum of 3 Sharia scholars. Now we are looking at the breakdown. Sharia scholars, at least a minimum of 3. And that's one of the reasons as to why these products are not taking place in most of these parts of Africa, because the people to get these Sharia scholars, most of the times you find maybe the qualifications can't be met by those who want actually to be. So that's why sometimes it takes long for them to adopt such kind of businesses. But the good thing we are seeing that in Uganda, we have gotten some few banks that have started operating the Islamic financing or Islamic banking. So this question was also examined in December 2020. Question 1, part E. So as I said, these questions, they are there. Once you get this, you get the key roles and also the composition, then we can look at, maybe we can focus on the forms or the types of contracts in Islamic finance. In other words, these are the Islamic products. The forms, stroke types of contracts. They may be contracts or products. They are contracts, but we also have some contracts in Islamic finance. They may call them Islamic contracts, or sometimes they may call them Islamic, let me use a different color. They may call them Islamic financing structures. financing structures. So we have also a reference question for this. It was in March 2022, question 1G. So we have some, I'm just going to outline them, then we shall look at one by one in detail in the next video. So number one, we have Mudaraba. These are partnerships. They are more of partnerships. We have Musharaka, and Musharaka is more of equity partnership. We have Sukuk. Sukuk means it's just a bond, Islamic bond. We have Ijara. That's a form of a lease. It's a lease arrangement. Then what we have Murabaha. That's just a form of credit sale. Then we have some other contracts like salam contracts. We have Wakala, they are called Wakala plus H, I think plus H. Wakala. There are very many. Or there is even institutional contracts. There are also what we call it Twalik. Let me use a different color. Twalik. So we are going to look at each of these in detail, but we are going to find that in the next video. Hello viewers, welcome back to our episode on advanced financial management, and today we want to look at the different forms of contracts or the Islamic financing structures, and we want to look at some of those that we had previously outlined in our last video, and we make sure that we give a detailed analysis of each of these different products that we have under Islamic finance. So the forms. So one of the forms, we have what we call, can start with Musharaka, and we said the Musharaka is a form of equity. It's more of equity partnership. Now, I want to understand what this is all about. Now, this is more of a joint enterprise or a partnership structure where at least two or more parties bring in capital and skills. One person is to bring capital and the other is bringing the skills, and they want to trade in non-prohibited activities. So we have two or more people, one person here and another person this side. This one is going to be bringing capital, and this one maybe is going to be bringing skills. In terms of skills, we are talking about managing the business. These people, they can come together, they form a group. Maybe this is Charles and maybe this is Ivan. So they can form a partnership group, maybe CI partners. Then this one can be the one to manage the business when this person has just brought in the capital. So one brings in capital and the other is supposed to bring in the skills. Because most of the times you may find that some people have the knowledge of how to do certain things, but they don't have the money to begin the business. Others have the money, but they don't have the skill that they can use to be able to do the work themselves. So what they do, you come together and then they start doing the business as two people, but one has brought in capital, the other has brought in just skills. Even the way they are going to be sharing the profits is going to be a little bit different. But the bottom line is the fact that we have one or two or more people coming together. One must be bringing capital and the other is bringing skill. That's the differentiating feature. They come together and they do business. So in this case, finance is provided by, at some point it may also happen that this person who is providing skill, maybe he has some small amount. He can also bring in some small money. Let's say he's going to be bringing in something like 20 million, maybe the other one is going to be bringing 50 million. So the whole lump sum capital is going to be 70 million. But on top, this person is actually bringing in, on top of the 20 million he has brought, is actually bringing in some skills. So they can come together and they start operating. So in this arrangement, if you find that everyone is going to be bringing in money, you find that both of them are going to be bringing in money, and at the same time, both of them are going to be involved in the management of the business, then we call that mushariki. These terminologies, mushariki, because everyone is bringing in cash and everyone is going to be engaged in the management of the business. Now, we want to look at the situation. How are they going to be sharing the profits, or the profits or losses, whatever they have achieved at the end of the period? So profits is going to be shared in a pre-decided ratio, and losses is also shared in the capital ratios. In other words, you look at the ratio. If this one, maybe this person has brought in, this one has brought in 20 million, the other has brought in 50. So the ratio is going to be 20 to 50. And that will be 2 to 5. That will be the ratio for sharing losses. Losses are going to be shared in profit contribution ratios. But when they are sharing the profits are going to be shared in a pre-decided ratio, or a predetermined ratio. So they determine based on whatever basis they have used. But what is key is for the loss. The loss should be shared in their capital contribution. So, whereas it is a joint partnership, even when you are providing management skills, you can bring in some money, because you may totally say that me, I'm not going to be having money, I'm only going to be contributing in terms of bringing in the skills. So if you are bringing in the skills, the argument is that you will not be sharing the losses, because losses are supposed to be shared in the capital contribution. If you contributed nothing in terms of capital, you are not sharing profit, you are not sharing losses, you are only there to share profits. Because there is no way we would say that we are going to penalize you for not managing the business well so that you can be able to make profit, because you sacrificed your skills to be able to make a profit, but you didn't make it. So if at all we have a loss, why are we charging you? At the end of the day, you had nothing. So that's their thinking. and it's a little bit, it's in that perspective as you can see it. So you are partners, but the losses are going to be shared in the capital you have contributed. So if you have brought in maybe 20 million, the other has brought in maybe 200 million, whichever the amount. But on top of the 20 million that you have added in, you are also bringing in the management skills. Then the other person may only bring in capital, because the other person can only say, I'm not going to be available. He brings in the cash, he says you manage the business. You bring in some cash, he brings in cash, but it's you who manages the business. So once you make a loss, you share in the profit. You share the profit in a given ratio that you have agreed. But when it comes to a loss, you share in the capital ratio. So this is a little bit different from what happens from the conversion, these commercial banks that we know. Of course, for the commercial banks, as long as they have given you their money, whether you have made a loss, you have to pay. You have to pay them. Whether you have made profit, whether you have made losses, you have to come and pay their money. But for Islamic finance, they are saying, as long as you brought in skills, even if you have not brought in capital, when you make a loss, you are not supposed to share to be part of that loss, because otherwise you committed yourself by providing the skills that is needed to actually come up with business ideas that you can do with the intention of making more profit, because you had nothing. So there is no way that you could be deducting money that you don't actually have, because in the first place you joined minus any money, which is a bit different. So that's what we have as musharaka. So I want to go to the next one. We look at what we call the mudaraba. Mudaraba is also partnership. It's also a partnership arrangement. But we want to understand how is it different from musharaka. Now, it's also a partnership transaction where one party supplies money. Now, this person is only going to be bringing in, we can have two people. We have two people. This one is bringing in 100% capital. Is the one who brings in capital. This one is bringing in 100% labor. This is just bringing in skills. Doesn't have any money. Now, what happens is that the person who is going to be bringing in money, the supplier of money, is what we call the Rab Arma. That is the person who supplies money. And the other person is what we call the Mudalib, the one who supplies labor, Mudalib. So this person is only bringing in labor. So now what's going to happen is the fact that these two people, this one is bringing 100% capital, then this one 100%. The Mudalib is bringing 100% managerial skills. And now the partnership is mainly between two people, and it's called a Mudalaba contract. Now, when these two people make profits are going to be shared in a predetermined ratio. Predetermined. In case of profits, once they have made profits, they are going to share in a predetermined ratio. They can agree on whichever ratio that they are going to use to share the profits that they have made. But now, in case of a loss, the loss is supposed to be 100% on the person who brought in the capital. The loss is supposed to be bared by this person, the Rab Arma, the person who brought in the capital is the one to suffer all the loss, because this person brought in nothing, because he had nothing. He sacrificed his skills and he put in the business. And the business, he didn't get any money, because when you don't make any profit, you don't expect this person to have anything, because at the end of the day, he brought in nothing. He just brought in his own skills. So if he has tried his best and he has not been able to be successful, there is no way you are going to say that the loss that I've suffered, because this person is going to be managing 100% of your capital. They will only be liable if at all they are the ones who led to that loss. Maybe they stole the money themselves, then they will be liable to pay. But if they have done everything in their powers to actually be profitable, but it never came out as a profit, then they are not supposed to be penalized for the loss that they have made. So we need now to get the difference between Mudaraba and Musharaka, because Musharaka is also a joint venture, but Mudaraba is specifically for two people. One is bringing in capital, the other is bringing in labor. Two people. The other one can be two or more people. But one, the two of them, each of them has to bring in some capital. This one can bring in like 20, the other one brings in the more, maybe 500 million, this one brings in 20. But on top of the 20, he provides skills. So I hope you are seeing the difference. So the other one is committing. In Mudaraba, one person is committing 100%, providing managerial skills with no money. But the other one is also providing 100%. He is not supposed to interfere into the operations of the business, because he's the one who has provided a capital. It's like the bank giving you the money and you go and start operating. When you make a loss, because the bank wasn't there when you made a loss, but if they go through into the causes of the loss and you are part of the reason as to why the business made a loss, then you find yourself paying. But if they find that it is 100% clear, you did the right thing, but things never came up, then you're not supposed to make any payment for the losses that are incurred by the business. And even this person is not supposed to, of course, pay you any contribution, because you didn't make any profit. So that's the difference between those two items. Let's look at the third one, which is skook. Skook. We said skook is a lease arrangement. Skook, we said, is a lease arrangement. Skook. Sorry, skook we said is a bond. The lease is the other one called ijara. This one is a bond. Sorry about that. So these are Islamic bonds, and these bonds are structured in such a way that they generate return to the investors without infringing the Islamic laws. Of course, these are bonds but these bonds have no interest. In other words, you will not include any interest in these bonds. Remember, in the normal conversion banks, those commercial banks, they charge interest on these bonds. But for the skook, it will be structured in such a way that there is no interest. So the bottom line stuff here is no interest charged. on the bond. No interest is charged on the bond. Now, what is the aim? Because if you are not going to have any interest, so what's the aim? So it aims at profit sharing by offering the investor or the owner, the person who is investing the money, is getting ownership into the business. The profit sharing is in the sense that I can give you the asset, only that you are going to allow me to be part of your business. You can be, maybe you are looking for, you want to construct your production factory, but you don't actually have the money. I can construct for you the factory, then I will be part of the business. I become part of, like we'll be owning the business together. And when we are owning the business together, it means we are going to be sharing the profits that we've made from using the manufacturing plant that I constructed. So the motive is just to share profits. In other words, you include the investor in your business or in your asset, because it could be a bank. I don't have the money to construct the factory plant. Then I go to the bank. The bank buys for me a building. Now the building is going to be mine. But since those people, they are not going to be earning interest, what they are going to do, they are going to make sure that they are part of the business, that the profits we've made in the business, we are going to be sharing them. If it is just an asset, if you are not in business, and maybe it's me, I just want to go and buy land for myself, they can pay for you the land, but they are part of that land. Meaning whichever benefit you derive from that asset, you are going to share. Whether you buy the land and you leave it there for capital appreciation, it's not a problem. But the moment you want to say that you are selling it, just know they are part of that asset. So when they are buying, the asset is going to be like it is for two people. That's what we call the sukuk, the bond. It is structured in a sense that we don't actually pay interest. So whoever provides the money or whoever provides the bond, remember, for you, you provide a contract, and the owner of the money will give you the right to own shares in your company or in that asset. But what happens in the other commercial banks is that what they do is a bit different from what they do here. In these sukuk bonds, these are going to be linked to underlying tangible asset. These are basically on tangible assets. You are supposed to have a physical asset that you want to acquire. The asset is supposed to be there. So that's why for them they were saying that wealth is built on asset-based investments. So for example, it could be a bond that you are either, maybe you are going to buy land or build a school. Therefore, the provider of the money must own. So, as you know that a bond is just a promissory note or a document which you can give out, or that the one they provide so that they can be able to receive money. And once money is received, then the provider of the money will wait for you to pay with the interest from the other commercial banks. But with the Sukuk bonds, if the Sukuk bond is say 50 million, then the next question that you are going to be asking is, what is it for? You want this money for what? Either buying land, building, machine, as long as there is a physical, tangible asset, then the money will be paid directly to the owner of that land. What is going to happen? The money is not going to be given to you, because when they say there must be a tangible asset, the implication is that I want 50 million, but you want it. What do you want that money for? I want to buy land. They don't give you the money. They just buy for you the land. In other words, there must be a physical asset that you are acquiring. If you want money to construct a school, then the bank will just construct for you the school. You just tell it where you want to construct the school, and they analyze everything to see how much is needed. They do the construction, or they pay the contractor who is going to be, so that there is an underlying asset. And that's why they are saying the money is backed by assets. So once they buy for you this asset, just know that asset is going to be owned by two people. And that's how it's going to be. No one is going to take it back. No, but you will be sharing profits that you are making from the use of that asset. So let's look at the other ijara. Ijara, we said, is a lease contract. An ijara transaction is the Islamic equivalent of a lease, where one party, which is the leaser, we have the leaser, is going to allow the other party, who is the leasee, to use the asset against payment of what we call the rental fees. You'll be making either monthly or annual payments, and it's a mode of payment. But the bottom line is the sense that without interest, you will be paying rental fees, but without interest. And if you include interest, then the principal would have been killed. Then it wouldn't be an Islamic property. So when they are designing these rental fees, because someone is going to be asking, how do we benefit as a business, or how do businesses benefit, those banks benefit from these kind of transactions? Now, what happens is the fact that they may tell you that you are going to be paying maybe 20 million. That's the amount that you are going to be paying. But you agree that the two of you agree that instead of me paying maybe 20 million, I'm going to be paying 22. And you agree. Meaning the difference will be the income that the bank will have earned, so that they can keep operating. Of course, that 2 million will be, in a normal sense, it is an interest. But they don't call it an interest because it's not an effective interest, because it's in agreement. The two parties come together and they agree. But remember, the interest is always provided for. The central bank provides the interest rate. So that's why they are not calling it interest. But they sit and they agree and they see which amount this person is going to actually add in to cater maybe the monthly monitoring fees. So they will just call it maybe monthly monitoring costs that are not basically the actual interest. Then we look at the other one, murabaha. Murabaha, we said it is a credit sale. So here, they sell to you goods on credit and you pay later. So a murabaha transaction is basically a deferred payment scale, or it's an installment payment, either hire purchase, something like that. So as long as they give you the goods on credit and you are going to pay later, that's murabaha, and is mostly used in purchase of goods for immediate delivery on deferred payment basis. So in other words, you buy the goods, they give you the goods, but you don't pay the money there and then. It's different from where you order a car, then you wait for it to first reach, then you make payment. No. This one, they deliver, immediate delivery is supposed to be made. You buy the goods, they have delivered to you, you sell, then you pay back. Or you buy, then you keep paying in installments. In other words, if let's say I'm a construction company, it will come through maybe from the construction companies, and I need maybe 100 bags of cement to construct a building. Because you're a construction company, you have contracted a building, but maybe the owner has not actually paid you the money. You can pick cement from a factory, you use the cement, then after the building has been constructed, this person pays you, and you also go and pay the other person that supplied to you goods on credit. It's the same that even the manufacturing process, whereby you get the raw materials on credit, then you pay when you have gotten money. So we can also look at what we call the salam contracts. Sometimes they write salam as this. So just understand what they are, and you base what they have given you in the exam. But that's what we are looking at. These are just contracts which are similar, like those forward contracts. Shall look at what forward contracts are. But just know these are also similar, like to those of forward contracts. Forward contracts. Now, we shall learn more about the forward contracts. But these forward contracts, most of the times we use them to manage foreign currency issues. In other words, if you realize that the exchange rate is fixed today, let's assume that maybe the dollar is 36, the dollar rate to UJX 36 shillings. If you realize that this dollar is fixed today, and you expect that the dollar might keep on changing or it might increase, then you can sign an agreement that you will be making payments at this dollar rate, fixed dollar rate. Because I may be demanding you maybe 15,000 US dollars. By the time you will come to pay me, the dollar rate, I was demanding 15,000 and the dollar rate was 36. By the time you are coming to pay me, the dollar rate has moved maybe to 3.8. Are you not seeing that you are going to be paying a lot of money? So you better sign a contract saying, I will pay you at this dollar rate of 3.6, such that when you multiply this times this, you will be paying that equivalent. But if you don't sign any contract, meaning you will be paying at this rate, where you will be making a loss, because you will be paying more than what you would have paid. So those are the forward contracts. We shall look at how we do some of those and how we can be able to manage losses, because this one would be good for the business that is receiving money. But just take, for instance, if you have people you have supplied on credit and they are paying you when the dollar rate has reduced, you gave them goods when the dollar rate is 3.8, now they are paying you when the dollar rate is 3.6. I don't think that you are making a loss. So that those are the forward contracts. We also have what we call the wakala, the istisna. These istisnas, for them, they are just long-term. They are long-term in nature. Those large-scale construction, the wakala. So there are very many aspects as you can look at. So the mulabaha is just, and today we want to look at a new topic. We finished our Islamic finance, and as I had promised you, we are going to start on ethics and corporate governance. So the new topic that we are going to look at is ethics and corporate governance. Corporate governance. Ethics and corporate governance. Now, we are now going to go into the details of what ethics is. Of course, we are going to understand what ethics is. But anything you know from the basic point of view, ethics, we just take it as anything that you know you are doing, but it's not morally, it's not morally right. So anything you do, but you know it's not morally right. You know something can be legally right, but it's not morally right. Like, for instance, we may be having loopholes within the laws, and someone is going to use those loopholes to either deny a service. Like, for instance, someone can use the loopholes within the laws to actually avoid paying taxes. Someone can use the loopholes within the laws to actually commit something that is not moral right. So ethics or ethical issues are those issues that you see. They are they are the normal behaviors. They are things that are believed to be true, even though legally they may not be right. Like something that is morally right. Now, when we are studying ethics, we take it from the unethical issues or the unethical behaviors, because those are the ones we don't want. Ethics is good. We saw the reasons in level 2. We saw the reasons at why companies should operate ethically. They should, one of them, they can attract employees to come and work for them. They don't have legal fees that are going to be paid when they are committing crimes and all that kind of stuff. So they are going to be, if you operate ethically, you are going to reduce the chances of you finding yourself in court cases every time. So we want to understand ethics. But ethics, if you want to get it, just get it from the basic point of view that anything that you do that is not morally right, then it will be regarded as unethical behavior. Unethical behavior. We always look at it from the unethical point of view because that's what we don't want. We don't want people to be doing. Now, when it comes to corporate governance, corporate governance, here we shall be interested in seeing how the company is directed or how the company is run. In other words, when we talk about corporate governance, we are just looking at how the company is directed or run. In other words, how are the operations within the business? So this will be referring to corporate governance. But the ethics, I said ethics is good. If the company is operating ethically, it's good. But what we condemn is the unethical issues that we shall look at. Now, let's look at the key concerns of corporate governance. But one key thing I need you to note is that here we are not studying the entire corporate governance because you do corporate governance under your auditing and risks, audit and assurance paper. But here we are just picking out key things because as the manager of the business, as a finance manager, you need to know at least how the organization is going to be managed. Now, let's first understand the key. Let's look at the key concerns that we need to talk about as far as corporate governance is concerned. Key concerns of corporate governance. Key concerns of corporate governance. Now, as I said, here we are not going to be teaching the whole of corporate governance, but we are trying, or we are creating a highlight to pick out the key concerns. And those key concerns, if you don't take into consideration, if you don't look at them, then you will have problems with your organization. And one of the problems, the company may close down because it has not been managed well or directed well. So we have seen over the years, we have seen very many companies failing. And these companies, they are failing as a result of failure in corporate governance. So as long as the company is not managed well, this organization has very high chances of it failing. Very high chances. So over the years, we have seen very many companies. They come and they close, but their downfall, the main reason for their downfall is part of failure in corporate governance. A popular case, some of these are international companies, others, of course, we shall have some few cases from here in Uganda. We have a company called Enron. Enron, it was actually a very powerful company. And this company was being audited by was being audited by Arthur Anderson. Arthur Anderson. If you try to Google Arthur Anderson, they will get for you the details of who that auditing company was. And by then, it was this Arthur Anderson was the #1 auditing firm in the whole world. But right now, it's no more. It's no longer there because it was liquidated. And the reason as why this Arthur Anderson was liquidated, it was because of the fact that this company had issues. Enron had issues, and these were the auditors. Now, whereas these Arthur Anderson were the auditors, but at the same time, they were the auditors to Enron, but at the same time, they were also providing consultancy services to the same company, Enron. They were the auditors. Of course, when I'm talking about the auditors, I'm not meaning the internal, they were the external auditors. But at the same time, they were providing two services, auditing, and at the same time, they were providing consultancy services. And what happened, since Arthur Anderson was providing consultants, at the same time, it was also providing the auditing, the managers and the public were relying on their information. They were relying on their information in terms of the reports they have prepared. So the public was relying to the reports, and even the company was relying to the reports that have been submitted by this Arthur Anderson, the auditing firm. Now, what Arthur Anderson was doing, the auditing firm, what it was doing, it could manipulate. They could manipulate all doctor accounts. They could forge. So, what this auditing firm did was to manipulate the records, and they ended up publishing financial information that was wrong. And remember, the public was basing on their information to make their own decision. Even investors, these guys, they published wrong information, and they brought investors to come and invest in Enron because they published wrong information. In a sense that they attracted more investors. In other words, the accounts were overstated. Even the profit was overstated, even the dividend per share was also overstated. So they looked at the Enron as a company as being a very profitable company for any investor. So investors relied on the information that was prepared by the Arthur Anderson, the auditing firm, to make sure that they invest in this company, Enron. But of course, you know, as long as you lie, people, when they bring in their money and they don't see the return, companies collapse. The problem would have been maybe this Enron wouldn't give. You can't be the same person. You are the auditor, but at the same time you are the one who is providing the consultant services. Consultants may be in terms of looking at what the organization can do. Remember, the whole organization was relying on the information that is manipulated, but they don't know. So that's how the organization collapsed. Even Arthur Anderson also, it was liquidated because it turned out, of course, when you go through the other corporate governance under auditing and assurance paper, you will get the detailed analysis of some of these companies. The other that we can talk about, please take note that these examples we are highlighting and the scenarios that we are bringing, they are the same scenarios that are going to appear in your exam. They may just bring a case and it is just rotating around. They are bringing things that maybe we had ABCD, it was doubling as the auditing firm, and at the same time it was providing consultancy. It attracted, such kind of story. So those kind of narration is where we will be able to pick the points and be able to analyze what they are talking about. That's why I'm giving more examples. The other that we can talk about is Barings Bank. Barings. This Barings Bank in Britain, this is UK. Now, this one also had the same issue. You can read about, even if you just go and search about this same company, they will give you what happened and what was the result of its downfall. The other, now if we talk about the Ugandan kind of stuff, we had what we call the International Credit Bank. They used to call it ICB, International Credit Bank. It was owned by, I think, Kato, Mr. Kato. It's called Kato, something like that. But this company also collapsed. We also had the Greenland. These banks were there. Greenland Bank in Uganda. Then we also had the known one, the one that was for the government, the cooperative bank. The cooperative bank. This cooperative bank is now the one that we call Stanbic, because it is Stanbic which bought off. It is the present day called Stanbic. Stanbic which bought off the assets of the cooperative bank, but it was a government entity. So Stanbic bought it off. So all these, they declined because of corporate governance and ethics. As if you go through one by one, you look at what happened, what were the things that these guys were doing, you will see that it actually collapsed because of corporate governance and ethics. Of course, currently we have things to do with the Crane Bank, also Crane Bank. The Crane Bank that was sold to the FCU. Crane Bank. So, Crane Bank, and also even Uganda Telecom. You see, Uganda Telecom has issues, even though they haven't sold it. Uganda Telecom. Just imagine if because all government employees, before the government could employ you, you are supposed to first have a UTL line. UTL, Uganda Telecom. Just imagine if at all they had very many products. Remember, it was compulsory for all government workers to actually have these numbers. Just know how many civil servants are there. Those who were there, those who are now being recruited. If it had so many products, and it also goes to the private sector, would be having more, UTL would be like the likes of MTN, because it was the first one. It was there for long. And it had some monopoly over, because every employee of the government was supposed at least to have a line before they give you the job. So we also have things to do. There is this Nakumat, I think. Nakumat. Not sure about what happened to ShopRite, but it could be. So most of these companies, they nearly collapsed. Like the Uganda Telecom, of course, it collapsed because of. If you look at what happened to Crane Bank, there were very many staffs. The stories the stories of the fact that we shall look at some of these. The chairman board of director was a non-executive, was not related to the business, but the assistant chairman board of director was the owner of the business. So what do you expect? Do you expect the chairman to override the decision of the owner, even though the chairman was a non-executive executive director, which is what is recommended. But the assistant chairperson or chairman of the board of directors was actually the owner. So what do you expect? It's like the owner coming in just to see who should I fire and who should I attain based on the decisions they have made. Because there is no way you are going to overrule what the owner has said, even though you are the chairperson board of director. So they just put you there just to fulfill the requirement that actually the chairperson in a good way is supposed to be a non-executive director. So you have a non-executive director as the chairman, but the assistant is executive director. What do you expect? Especially now, given the fact that he's the real owner. So like he just puts you there, you just hold the position, but the powers are not with you. So those are some of the things that, because now if this happens, then you just know this person is not good. The chairperson is not going to exercise his or her independence. Remember, the reason as why they are bringing in non-executive directors to be the chairpersons is because they want them to bring in that kind of independence. Because when they are voting, you need to be having someone who doesn't care, but he's just doing the right thing. But here, it's like there is already an influence if the assistant is the real owner. So, under corporate governance, when you look at the principles under corporate governance principles, for instance, as I said, for the principles for corporate governance, one of the principles is the fact that the chairperson board of directors, for you to understand this, you must be well equipped with the agency relationship. Where we said for agency relationship, we know that we have the shareholders. These are the owners of the business. But now, since the owners can't run the business, even though they have money, they can't run the business on their own. So what they do, they appoint the board of directors. When they appoint the board of directors, these board of directors, they are also not employees, meaning they are not going to engage themselves in the day-to-day running of the business. So what is going to happen is the fact that these board of directors, they will choose what we call the CEO, the Chief Executive Officer, or the Managing Director, the MD. These ones are going to these ones employ, or they can also appoint. But remember when we said we looked at agency relationship and in our financial management on level 2, we said there is that first relationship of the shareholder and the board of directors. Here you appoint. The right word is they appoint. So once they appoint you, it means the board of directors are going to be the agent and the shareholders are going to be the principal. Remember, I told you when you're explaining the agency relationship, you make sure you show the agents the agent and the principal. That's the principle for you to actually get the correct mark for explaining this. Then also, when it comes to this, the board of directors and the CEO, these ones, they can also employ or appoint. But this one is going to be the agent, and this one is going to be the principal. So this is what is going to happen. I don't want to explain more about what is done, but I just want you to understand the fact that under the board of directors, we have two types of board of directors. We have what we call the executive directors. Executive directors, those are like the people who have real connection to the business. If the business is failing, they are panicking. In other words, they have a higher interest in the business. They have some interest. It could be maybe these are relatives of the owner. These are maybe brothers and sisters of the owner. It could be other family members and other people, or the spouse. Those are the ones that where the owners pick what we call the executive directors. But the non-executive directors, those are the people who have no interest. They are not connected to the business at all. So what happens is that the reason why we are supposed to have the principle for corporate governance is that you should be having more non-executive directors on the board of directors than the executive. Reason being, these non-executive directors are going to bring in what we call the independence. Because here in the board of directors, communication is always done under the board meetings. And when they are in board meetings, they are supposed to vote. You vote against or you vote in favor. So if you don't have more non-executive directors, the implication would be these people will just influence the decision that is going to be made, even if it is not right. So one of the principles for corporate governance, it says that you should have more non-executive directors than the executive directors. Two, they are also saying that the chairman board of directors must be a non-executive director so that he brings in that independence. Now, look what happened to some of these companies that collapsed. I've explained to you what happened to Crane Bank. The chairperson, board of directors, was a non-executive director, which was okay. But below, the assistant was actually the real owner. So it was contradicting, because there is no way the chairperson would vote against his assistant, who is actually the person who employed him or her. So even if these shareholders are going to be choosing, you need to, if they don't follow the corporate governance, then it means the company is going to fail, because no one is going to be voting against the bosses or the executive directors. I will explain something like for what happened to the Ugandan banks, like for the International Credit Bank. International Credit Bank was owned by, I think was called Kato. Now, was the owner. This was the owner of that ICB bank. Now, what happened in this bank? The owner, which is Mr. Kato, was actually the chairperson, the chairman, board of directors. And to make matters worse, his children were executive directors, meaning no one could vote against. So his children were executive directors. So there is no kind of independence here. You don't expect a son to vote against the father, and you don't expect the father to vote against their son. So what is going to happen? They will just accept even if it doesn't actually help. That's why when they are choosing some of these, especially the non-executive directors, they choose people who have experience in managing companies that are relatively of the same size, like what they are appointing them for, so that they bring in the exposure and the kind of independence. And that's why we want to have more non-executive directors than the executive directors. And that's the reason, to make sure that someone can stand firmly and say that is not going to help the organization. I explained what happened to Crane Bank. The chairperson was a non-executive director, which was a tick, but the assistant was actually the owner. It doesn't make sense. So we have these kind of, I'm just bringing in just the key concepts that I need us to deal with. And these are some of the things that they are going to quote in the case, and then they tell you to advise. So now, want to look at the international. Remember, here we are basically looking at the entire. This is an area of international concern, corporate governance. So we want to look at what happened in different, or how can we be able to manage the organization well. Of course, in the UK, in London, they had a committee. A committee was formed to come up with standards on how a corporation or on how a company can be run. And the person who was like spearheading was called Chadley. Chadbally. He came up with a report on corporate governance and made very many recommendations. Even in South Africa, this was in London. Then also we had some recommendation from South Africa. Now, for South African case, it's most of the times what we are basically using. And I will tell you why. In South Africa, at the highest peak of apartheid, that apartheid period, there was a judge, a high court judge was called King. And what happened was, when the whites lost on apartheid, they said that they tried to focus on companies. They decided to transform companies, and they become a more organized place. That's why we are seeing most of the times, most of the companies, they are coming from South Africa. It was as a result of apartheid, where they sat and they concentrated, they tried to transform companies. So by transforming companies, this judge, they wrote reports and they made numerous recommendations on how companies can be managed, because most of the companies were destroyed. So they wanted to try to find a way how they can come back together. So they had to do to get those recommendations. So we have that high court judge called the king made some recommendations, and the first recommendations, they are the ones that were in the report, which they call the King 1. King 1. It was also then modified to King 2. And finally, this King 2 was also transformed to King 3. And it is this King 3 that is still relevant, or that is recently used. But also, when we talk about the Ugandan aspect, we also have things to do with corporate governance. In Uganda, we have the Institute of Corporate Governance, and they have also made some recommendations. And we also have the Commonwealth. Also, the Commonwealth made some recommendations, but the recommendations of Commonwealth were more like the ones that were recommended by Chadibale. So the Commonwealth reports and the Chadibale reports were taking almost the same side. So they tend to follow, the Chadibale report tended to follow the Commonwealth report or recommendations. But as you go into your auditing, you'll learn more about that King report. Even if you try to Google, it is a very big document, but you pick out, you go into the table of contents and you pick out the recommendations that were made. But as I told you, before we go to ethics, I told you that there are key elements that you should note from the other side. We said that the non-executive director is supposed to be made the chairperson or the chairman, board of director. 2, we should be having very many non-executive directors as opposed to executive directors, so that they can be able to bring in that kind of balance when they are doing their voting. We also spoke about the key people that pray or that made their recommendations. We spoke about the king, who was the high court judge in South Africa. After the apartheid, they looked at ways how they can be able to transform companies, and they made that judge made some recommendations from from King 1, that was the first report, to King 2, that was the second report. They kept on modifying those reports until they went up to King 3, which means report 3. We also talked about the fact that in Uganda we have the Institute of Corporate Governance that also provides some recommendations on how a company can be managed. We also spoke about the Commonwealth reports. We also talked about that we had the Chadibale report, but we concluded that the Chadibale report is taking the form of the Commonwealth report. So those are some of the highlights that we looked at in the previous video that are very basic and you need at least to understand. So now let's look at ethics. Now here the examiner may throw like 4 or 5-mark question, especially under the question 1, because I told you ethics and corporate governance plus Islamic finance, they are more seen in the question 1, section A. And these questions keep on coming. Most of the times the examiner doesn't examine a full question on corporate governance because it is more of theoretical. It is more theoretical than computational. So it's not going to be a full question. So you can't have a full question on ethics. But as a finance manager or as the CFO of the organization, you must be ethical when you're executing your duties. So the way we study it, or the way we analyze it, will come from the unethical behavior, unethical point of view, because these are the things that we don't want the CFO to promote. The CFO, the finance manager, shouldn't promote these. So those are the things that they shouldn't promote. So we want to look at what are the ethical, unethical issues. These issues, we are not going to explain or to over explain more on them, but just know they may appear. I made a video on financial management that is detailing some of these things. Like one, we have what we call money laundering. Money laundering. So here you are just expected to know what, you are just expected to know briefly about money laundering, whether you should promote it or you shouldn't promote. But this is just illegal money. Money came from unknown sources. So they may bring scenarios that maybe like what happened to FDC. They were complaining that money came in and they were not aware. Where they didn't know the source of the money. So that's money laundering. But most of the times it is done internationally, that people get money from unknown sources and they bring it in the country. So it is very dangerous. So we have other things like corruption. This one, self-explanatory, but most of the times when you are giving points, at least make sure every time that you make corruption the last point. Because some of these other aspects, they are more related to corruption. Like I can talk about insider dealing. Insider dealing is when you use the information that is private to you for your personal benefit. For example, I may be the CFO, but I see that the company maybe is trying to sell shares. And I know in 5 years' time, the company will be making very big profit, because I'm the one who's looking at the financial statements. I know. And because I have access to that information, then I tell maybe my sister or my brother to actually come and buy shares. So I'm using the information that to enrich myself, because the information is just only private to me. Otherwise, no one would know that in 5 years' time the company would be more profitable. The other that we can talk about, conflict of interest. This one is more evident. Most of the times, if you see that you can't handle a case, it's like auditors are not allowed to audit companies that they have shares in. It's like you have almost 10% of the company's shares, 10% of the assets of the business, and you want to become the auditor. You can't, because you have already an interest in the business, meaning you will do whatever it takes for the business to be profitable. It's just like the same way I can be having a business, and then maybe my wife is an auditor, and I tell my wife to come and audit my business. What do you expect? Remember, you are supposed to be seen. You must be independent, but you must also be seen to be independent. There is no way someone is going to say, even if actually you exercise your whole independence, and no one will believe, because they will say, after all, the other one is the husband. The other, we may talk about like bribery. Of course, if you see bribery, corruption, they look to be the same. Bribery. But I told you that we can also talk about fraud. We can talk about doctoring accounts, manipulation of accounts. There are very many issues, but The key point is the fact that most of the times they bring these items in the case. It's you to identify that this was unethical, this was this, because they may just give you a story. Then in that story is when you'll be able to advise. Remember, we told you, even if it is not all about knowing these points. You may be knowing these points, but they are not applicable to the case. So if they have not mentioned the corruption, please don't bring it. You bring in pollution. Of course, we know pollution is, you are not allowed to pollute the environment. But don't bring it if it is not there in the case. So you can try to look at the exam past papers. As I said, you follow for the new examiner 2019 to date. Then you look at how the examiner has been examining these numbers, because they are there in that question 1. Most of the times they are there. So you look at how the examiner has been examining the things to do with ethics. But we always, and the other thing is the fact that most of the times they may just give you signs. They may not just give you these direct points, but they may give you symptoms that they may give you a case. Maybe I'm an accountant and I'm delaying payment of the supplier, yet there is no justifiable reason for me to delay the payment. Of course, when I look at that, it can call for bribery, that maybe I'm looking for someone to give me something so that I can approve the payment. It can also lead to corruption. So they may give you any case. Depending on the case, you analyze the case and based on that to make decision. So thank you for watching. Let's meet in the next video, as we are going to be looking at securities and the financial markets as our new topic. We try to look at, I know we looked at securities and financial markets and our financial management, but here we are just taking something. We take something to be a little bit advanced. We pick out something small and we talk about it, but that doesn't mean that they can't examine that number in full. That's why it is more advisable that if you have the notes for level 2, keep them. Read it through as you keep on advancing, because it is the other one that is going to prepare you for this advanced paper. So let's meet as we talk about securities and financial markets in the next video. Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. And today we want to look at a new topic, and we are going to focus on what we call the securities and financial markets. So we are going to look at securities and financial markets as our new topic. Securities and financial markets. Securities and financial markets as our new topic. So today we are going to look at securities, and when I say securities, I'm referring to what we call the financial instruments. Financial instruments. So when I talk about securities, I'm basically referring to financial instruments. And the financial instruments, they are the ones that are traded in the financial markets. So the topic is financial instruments and financial markets. We want to look at the instruments or the items, the financial items, and where they are sold. So financial instruments and financial markets. So the way you were taught financial markets at your level 2 is the same way we are looking at them even here at level 3. And there is nothing that I'm going to add on that is new to what you know. So, because it is going to be the same thing and we are going to be basically using the same knowledge, so we are going to pick out the things that I see they are very important as far as this paper is concerned. But basically, you can also use the same knowledge that you got on level 2. It will be the one that will help you to understand most of these things. So we shall look at, after looking at that, we shall also look at the finance decision. We shall look at the finance decision. And now, securities actually link to, these securities, they link to the finance decision, because that's where we are getting the money from. So the securities that we are talking about here, they are the ones that will lead us to the financing decision or the finance decision. So these securities, they are the ones that are going to help us to finance our activities. In other words, it's the source of money that we are going to use to finance our investments. Now, the financing instruments that we are going to mainly focus on, they are the ones that are of long-term. They are long-term in nature, long-term finance instruments. So we are basically going to focus on the long-term finance instruments because they are the ones that are going to help us to finance our long-term investment ideas. So these are the sources of finance, or the sources of funds that we are going to use in our investment projects. Now, when we do what we call the investment decision, or what we call the capital expenditure, the capital expenditure, they put it in a form as capex. It is put as capex in our, abbreviated as capex to mean a capital expenditure. So this is what we do under capital budgeting decision, or what we call the investment decision. So when we are looking at capital budgeting decision as the investment decision, then you need to look at the different sources, or you have to look for the money to be able to finance these decisions. Because you have made a decision, maybe you are going to invest in real estate, but you have to look for finance that is going to help you in that kind of investment that you have selected. So ideally, this topic should have come at actually after when you have completed capital budgeting decision, because it's until when we are done with that capital budgeting decision that we can know which investment ideas that we are going to basically look at, that we are going to look for their finances to fund those different projects. So, but either way, we need to get this straight, that the sources of finance that we are looking for, first of all, they are long-term in nature. Two, these sources of finance, they are the ones that we are basically going to look at where they are traded. Either they are stock market, or they are capital markets, or money markets, as we shall be able to see. So after looking at the finance decision, we shall finalize with what we call the financial markets, because we need to first look at the sources of finance themselves, then we see where can we find the sources of finance, and those are the financial markets. So we want to see what are some of the areas where the examiners examined some of these numbers. So I want to give you a reference numbers for the questions that are rotating around securities and financial markets, or what we call the financial instruments and then the financial markets. So let's look at the reference questions, or what we call the trial numbers. Let me just use trial numbers that are basically on this. So we have question 4, part A, May 2019. We have question 3, part B, November 2019. We have question 3, part C, November 2019. We have question 5, part C, August 2019. We also have question 5, June 2022. We also have question 2, part B, August 2018. We also have question 2, part B, November 2019. 2019, no, this is 2017. Can also look at 2017. Then the one for 2019, the other question is question 5, part D. Then this is June 2019. You can also look at question 3, December 2021. There are very many questions. Then finally, if you want to look at more, then you can also look at maybe question 5. Question 5, November 2011. There are very many questions that you can look at. Some of the questions that I'm not providing here, some of them we are going to do them in our revision. So don't say that we are not seeing 2023, 2022. Some of the questions we are going to have the revision sessions that where we are going to be analyzing some of those different aspects. But I want you to start from, because I told you at least you should get past papers that are 2018 to date. This was November, I think, November or August, because the new examiner started in November 2019. November 2019 for this paper. So let's now look at the finance decision. So I want you to see that some of these things that we are going to be talking about, they are really examinable questions, and I want you to pay attention to them. I bring some of these in the very beginning because I want you to get them first before we go to the computations that will take some of our time. So the earlier you do it, the better. So we are going to look at the finance decision. We talk about a little bit, we are not going to go into deeper into what we covered on level 2, but we are going to pick out some of the key things that we think may be important for this very paper, basing on these different questions that have been set. So let's meet in the next video as we are talking about the finance decision. Hello viewers, welcome back to our next episode of our YouTube channel. And right now I want to proceed from where we stopped. In the previous video we had started looking at securities or financial instruments and financial markets. So I had promised you that we are going to kickstart with finance decision. So let's go ahead, the finance decision. So we said as a finance manager or as a CFO of any organization, you are supposed to make decisions. And these decisions, they include investment decisions, or what we call the capital budgeting decision. Capital budgeting. 2, Of course, for capital budgeting decision or the investment decision, it's where decisions that are involving things to do with long-term assets, the firm can invest in or the firm can invest into, and when you're done investing in those assets, then you'll be able to see the different other decisions that you can make as a finance manager. So the other investment decision that the other decision that you are supposed to make as the CFO, you are supposed to do what you call the finance decision, where you have to look for the money to finance those investment decisions that you have analyzed in part one, or investment in this first decision of investment decision. So you have to be able to look for the finance or the different sources of finance that are cheap at the business, but they can also be used to generate more wealth to the organization by investing in these investment projects that we have evaluated under the capital budgeting decision. So the second decision is to look for finance to finance these investment decisions. The other, you are supposed to do what you call working capital management. And we know that working capital management requires you to manage of course, as you make investments, as you decide on which investment ideas to put your money into, as you look for the money to finance those investment ideas, you are supposed to make sure that you have some capital that you can use to run the day-to-day operations. And these day-to-day operations, they're the ones that you will need what we call the working capital sources. They are the ones that we need to make sure that we manage our day-to-day operations. So we do what we call working capital management. And finally, the other decision is to make decision about dividend decision. So these are the four main finance decisions that any CFO or finance manager can undertake. But when you look at this working capital management, for working capital management decision, it's not on our syllabus here for advanced financial management, but it's something that we looked at on level 2 under financial management. And our focus is going to be on these other decisions: the dividend decision, the finance decision, and then the capital budgeting decision, or what we call the investment decision. So all our emphasis is going to be on these three decisions as per the syllabus. So we shall see how we deal with these three decisions. Now, when we talk about investment decision, this first one, we are trying to look at the sources of finance that we can use as a business. Now, first, we need to understand the sources, the different sources, because it is these sources of finance that we are going to use to finance our investment decision. So we need to first understand the fact that these sources of finance, they are divided into what we call different categories. They are divided into two. We have what we call the long-term sources, and then what we call the short-term sources. We have the long-term sources and then the short-term sources. That is the first two divisions of these sources of finance. However, when you are looking at finances, when you are looking for finances, in other words, when you are looking at at the financing decision here, we are basically looking for finances to finance our investment ideas or investment decisions. And the investment decisions, they are always long term. So that's why we are taking only those sources that are going to finance our investment ideas. And those sources must be long-term sources of finance. So these short-term sources, they are the ones that we use to finance our working capital sources or working capital management. But when you are looking for finances to finance investment decisions, as we say that these investment decisions, they are long-term in nature, and that means that our focus is going to be 99% on these long-term sources. Otherwise, the examiner will basically, maybe if the examiner prompts us to have a look at maybe the short-term sources, but as our concern is to look at the long-term sources, maybe if the examiner points it out, but we are going to basically look at the long-term sources of finance. However, the sources of finance, these different sources, we've said they are divided into long-term sources and then the short-term sources. But I also want you to understand that these sources are further subdivided into different groups or categories. So they are also further subdivided into two. So when we look at, if we are basically focusing on long-term sources of finance, these you should know that they are further subdivided into two. We have what we call the debt finance and then the equity finance. But get my point that I'm only focusing on the long-term sources of finance. But as I said, they are further divided into the debt finance and then the equity finance. Therefore, the examiner will expect you to know that we have a debt finance and at the same time we have an equity finance. So we need to know the different options that we have that are going to be categorized as debt finance and those that are going to be categorized as equity finance. So we can mention some of them. If we start from maybe the equity component, if we start from the equity component, we can start with the retained earnings. I know retained earnings can be short-term or long-term. Retained earnings, we can go by common stock or ordinary shares. This is basically how what MTN did recently and Airtel. They went to issuing shares to the public. Those are ordinary shares. We also have, but we know from the retained earnings, it is the one that is very key, because if you do what you call the dividend policy, then you may decide to retain all the profits that you have made, or you may decide to give out dividends depending on the dividend policy that you have. The other that we can talk about, we can look at maybe venture capital and others. There are very many. I'm just highlighting few for us to remember ourselves. But whereas for the debt finance, if you look at the debt finance, on the side of the debt, we have what we call the term loans. These are long-term loans. or bank loans. We call them term loans. And here we are referring to long-term finance sources. We have what we call debentures or bonds. You can call them debentures or bonds. Sometimes if they don't call them bonds or debentures, they can call them loan notes. Loan notes. But the examiner prefers to call it either debt or either bonds or debentures. But both of them, you may actually find both of them in the capital structure. You may find when you have a bond and at the same time you have a debenture, because it's like having loan 1, loan 2, loan 3, but they are all related to debt. Then the other, we have what we call the preference shares. We said preference shares is debt because we go by the legal definition of what a preference share is. Because preference shares, they are assumed to be repayable at the end of the useful life. In other words, they have a redemption period where when we are supposed to make payments. We don't look at that. I know from your financial reporting or financial accounting, you know it can either be redeemable or irredeemable, but the general thinking here is that we go by the legal definition. Although if you bring in the other aspect of financial accounting and financial reporting to classify whether preference share is redeemable or irredeemable, it can be either debt or equity. But here we generally take it as debt. So when it is redeemable, it's supposed to be debt. When it is irredeemable, then it will be equity. That's another kind of argument. But here we are basically looking at these different aspects. Now, the examiner will bring a question. We've seen the different items that we have in all of this. Now, the examiner is going to bring a question. And the examiner might ask you to discuss the different sources, just like the way we've highlighted them. And then he may tell you that you provide the merits. They can give you to give the advantages of debt finance over equity, or advantages of equity over debt. Or it can be very straightforward. What are the advantages of debt finance, or what are the disadvantages or the advantages of either debt finance or equity finance? But my argument is to look at a scenario where they have told you what are the advantages of debt over equity. In other words, you don't just look at the advantages, but you look at the advantages and you look at the advantages and then the disadvantages. You compare and be able to compare and contrast. So that's what I'm going to put in context. So if we want to know the advantages of debt finance over equity finance. In other words, the examiner will be trying to ask you, like, is it more important for someone to use more debt in their capital structure than using equity? Is it more advantageous to use debt finance than equity finance? That's the kind of question that I want to look at. One point we can give, it's cheap. It's cheaper compared to equity finance. Now, you don't just, this answer is correct, but if you just give it and you leave it like that, it will not make any sense. You have to go ahead and explain. Now, if you look at the equity finance in general, those issues to do with issuing shares, you know, you have to advertise for people to come and buy shares. You have to hire specialists, lawyers, brokers, and you have to get through different licenses, getting listed on the stock exchange for you to be able to issue out shares to the public. There are very many costs that you are going to incur in relation to raising equity finance. But if I want debt, I can just go to the bank, we sign up an agreement. The costs, they are not all that high as compared to equity, because with the loan they may tell you are going to pay application fee of, let's say, 10,000 shillings or 5,000. It may actually be even free. Then they may tell you that we have some processing fee of, let's say, 1% of the loan amount, and you find those are the only costs that you are going to be incurring, and they will process the money faster. But going in for equity is a bit long term. Like you have to first get listed on the stock exchange, you advertise. You are not going to sell the shares yourself. You are going to hire experts, stock brokers, who are going to actually help you go through that process. So it is very costly. Now, it is going to be very costly as compared to debt finance. The other that we can talk about is the fact that interest expense is a tax deductible. Interest expense is tax deductible under debt finance. In other words, when you borrow money, the taxman is going to allow you to expense interest to expense interest before you pay taxes. Remember, when you look at when you're preparing your income statement, you first get the earnings before tax. For you to be able to get the earnings after tax, or even earnings before tax, you must have expensed interest first. So for you to reach to this earning before tax, you must have gotten EBIT, that is earnings before interest and tax, then minus the interest expense. When you less off the interest here, then you can get your earnings before tax, where you can apply the tax rate and then you get the earnings after tax. So the tax authority is allowing you to first expense, because the interest is the cost for the loan that you have borrowed, which is not the case. Remember, dividends are only deducted after you have computed your tax. In other words, dividends are only paid out from the earnings, the profit after tax, or the earnings after tax, meaning the dividend is not going to be allowed as an expense by the taxman. Even in the business computation, it's not allowed, but interest expense is going to be allowed. That's an advantage, because if they allow you to deduct interest expense before paying tax, it means that they are technically charging you a lesser tax. Otherwise, if interest expense wasn't tax deductible, you would be paying more taxes. But since they are allowing you to first expense interest, then you will be paying a lesser tax, because the tax percentage will be computed on a lesser figure. So that's another point. The other that we can look at, so I hope you've got this point, that interest is a tax deductible. The other that we can look at is delusion of control. Delusion of control. Delusion of control. In other words, we don't dilute the control of the organization. When you borrow money as debt finance, it is going to come, and you will not call the bank to come and start looking at how you are doing your operations. For them, what they want, borrow the money, pay back their interest, nothing else. They don't interfere within the organization control. But what happens if you if you get money from equity participants, like you issue more shares? When you issue more shares, it means you are bringing more shareholders, or you are adding more owners to the business. And these owners, they can determine what is supposed to be done through their annual meeting. They can dictate through the meeting of what they are supposed to do. So it dilutes the control, because you are going to be adding very many people that are going to be coming in as a result of buying more shares. So there are very many answers that you can talk about. But for now, I want us to look at something else. As long as you don't just, because there are very many advantages, but you have to see those advantages that are more important than the equity components. So we can now look at the factors. What are some of the factors or the key considerations in choosing the capital structure or the finance choices? How do we choose, or what factors are they influencing the organization's finances? There are factors that are going to cause an organization to have more of debt than equity, and there are factors that are going to let an organization have more equity than debt. So let's look at what are the major determinants of the different sources of finance that a business can have. So we are looking at the factors, or what we call the key considerations, key determinants in choosing the capital structure. We say the capital structure is just a combination of the different sources of finance. Capital structure, what we call the finance choices, factors that influence the finance sources. So we can talk about few of them. One, we can talk about the availability of the source, availability of funds. How that source is available matters a lot. Now, the source must be available. If the economy is very bad, then you don't expect that you will be able to get money from the public. If people are unemployed, the inflation rates are high, the disposable amount, the purchasing power is very minimal, the economic crisis, people are tight up, they don't have money. So you don't expect that you are going to raise, however much you advertise, you will not be able to raise the funds that you need from the public. So if that's the kind of situation, then you have to make sure that you go to debt. You substitute yourself to debt, because equity finance is not available at the current situation. Number two, we can look at the duration. Most of you, when let's say you go and borrow money, maybe from the bank, they might give you a loan of, let's say, 3 years, 3 years or 3 years to 5 years. But you find that you've gotten a loan that is going to take 3 years or 5 years. But the purpose for this money was for you to invest in a project that is going to generate cash flows after 10 years. Will you go for that kind of loan? Of course not, because the loan is going to end without you recouping the cash flows that you anticipated. So if they can't adjust the loan duration, to the period of the project, then you shouldn't take that loan because it will not help you. You have a project that will take 10 years to start generating money, but you are going in for a loan of 5 years, meaning you will start even paying, you will be paying the loan on the capital that you have borrowed, because by the time you start paying, the other money has not started to, the business has not started to generate the cash flows. The other that we can talk about is in terms of whether we are going to be having a fixed or a floating interest rate. Now, fixed or floating interest rate will also force you to either take debt or leave it. Now, when you are borrowing, there are these two rates. There are two different types of interests, where you can borrow on a fixed rate, and probably in Uganda, it's a bit hard for you to borrow on a fixed rate because of the high inflation rates. No one can give you a money and the interest is just fixed, because if the inflation rates are high, then it's going to lose value. By the time you are paying back, the bank is not benefiting. So what they do, they use a floating rate, whereby the percentage keeps on changing, either increasing or decreasing based on the available circumstances, economic circumstances. So all of these rates are good, but when you're borrowing and you find maybe you're borrowing, let's say, from a developed countries, if they have that capacity of giving you the loan at a fixed rate, please go for it, because a fixed will be fixed forever until you pay it. But if it is rotating, just imagine if it keeps on increasing. By the time you are paying back the money, you find you are paying huge. So if you have a chance where you can get at a fixed rate, you can go for the fixed. But if the economy is unpredictable, then you can have a floating, more so in the developing countries. The other that we can talk about, of course, if you see that these two rates are not applicable in your location, then you can opt to go for equity, depending on the rates that you are supposed to be paying to them. The other, we can talk about the security and covenants. Now, covenants are very important as far as business is concerned on either side, and it is very rare to get money without a security. Securities and covenants, they move together, but they are a little bit different. It's hard to get good money for business without having a security. The security can be company assets, or it can be the cash flows that you anticipate to receive from the different activities. Now, what is going to happen is the fact that these people, they may give you the loan and they say, we are putting some covenants, restrictive covenants, that you shouldn't sell off these properties that you have secured against the loans that we have given without our consultation. You first consult us before you sell off the items. Or they can even restrict you from getting other money from different sources before you complete theirs. They can also restrict you on what you should do with the money they have given to you. They can tell you that you have borrowed money for construction of a school. It should work on the construction of a school. You shouldn't divert that money maybe to another project. So those are covenants, restrictive covenants. So if these are many, then you are automatically going to be forced out not to go for debt, and you look for equity sources. So if the security they want is too much and you can't afford it, you just go switch and look for equity. The other is we can look at the level of gearing. The gearing is basically how the business is leveraged, like how much debt does the company have. Like you can have more debt and maybe you can't, no one can actually give you another loan. So if you are at that point, then you should go for equity, because we have a, when those banks are lending to you, there is a maximum. They can tell you that our maximum, maybe we can give you 1 billion based on the assets, or we can finance maybe up to 70% of your assets that you are securing against those loans. So this will be the ceiling. So if you have already reached the ceiling, maybe you are at let's say 65% of your assets. No, it means you are highly geared. You have more debt in your capital structure, meaning no other company will be willing to give you more debt because you are highly geared. So you'll have to go for another option of looking for equity finance. So those are some of the different factors that will influence someone's capital structure. So I want us to look at financial markets. So when you look at the syllabus, the topic says, if you look at the syllabus, this topic, they talk about it as securities and financial markets. That's the topic which we started with in the previous videos. That is the topic. But we first looked at how we mobilize money. In other words, we looked at the finance decision. We looked at how we mobilized money to finance our activities. But right now, what we are going to do with financial markets, I want us to focus on what we refer to as the financial markets. These financial markets, they are the ones that I want us to focus more on. Financial markets, they are traded on the stock exchange. They are traded on the stock exchange market or stock market. Those are the financial securities. So we want to look at these financial securities as those securities that are traded on the stock market. And that's what I want to focus more on, these financial securities that are traded. Those that are not traded on stock exchange, we are not more interested in them. And the other thing is that these securities, they are supposed to be long-term in nature. In other words, we are looking at long-term financial securities. Long-term financial securities. They are the ones that we are looking at. Now, we want to understand, we don't care whether these are debt, whether they are equity, but as long as they are long-term financial securities and they are traded on the stock exchange or the stock market. We are just going to highlight these financial instruments. One, we have common stock, and we say this is what we call the ordinary shares. We also have what we call the debentures or what we call the bonds. We also said they can be loan notes. The other, we can have other instruments, those like commercial paper, but these other ones, they are now on what we call money markets. And it's where the money market is where we trade for the short-term sources of finance. The short-term sources of finance that are traded on the stock market. So the examiner has been asking about the nature. The examiner has been asking about the nature and roles. It has been a combined question, nature and roles of financial markets. And there is when he asked for, sometimes he separates for them, sometimes he asks it in this same way, nature and roles of financial markets. And there are sometimes when he asks it for nature and roles of the commercial banks. May not ask for financial markets, but asks for commercial banks. And I want to tell you that the answers are the same. The laws and nature of financial markets, and then the nature and laws of commercial banks, those, they are the same. So for both questions, even for commercial banks, they work hand in hand with the stock markets, because we also know that financial institutions like banks are one of the major players in the capital market business. So when the examiner asks about the nature, specifically if you look at the nature of financial markets, in other words, who forms the financial markets? So when they talk about the nature, it's basically talking about who forms or who are the major participants. And we have, among the major participants, we have insurance companies. Let me just write it. Among the major participants, we have insurance companies. Can also call the insurance companies and banks. We have Forex Bureau, those that Forex business, those that are into exchange of currency, Forex bureaus, because if you go to the stock market, you may find that they deal with dollars, they deal with different currencies. So you need these Forex bureaus so that they are going to help you manage foreign exchange losses and other aspects that may arise. So this question has been coming in very many different papers, the nature and laws of financial markets. It also happened in December 2021, question 3. So don't underestimate this question, because it has a potential of taking up to 8 marks or 6, depending. So you don't need to underestimate. So we need to first get to an understanding of the nature of financial markets. What is the nature? If they talk about the nature, what do we include? Now, financial markets. Remember, here we are basically looking at the financial markets in Uganda. Financial markets in Uganda, they comprise of what we call capital markets, and I'm going to explain later what capital markets are, because there is also what we call money markets, but we have to understand what these two means. But first of all, you need to understand the fact that financial markets in Uganda, they comprises of capital markets and then the money markets. So they are made up of capital markets and money markets. However, these capital markets, these are markets. Of course, if I'm to write, these are markets, or a capital market is a market on a stock exchange that deals in long-term sources. It deals in long-term securities. Whereas this money market is a market on a stock exchange that deals with short-term securities. And the short-term securities, the good example that we can talk about for short-term securities, we can have a treasury bills as our short-term finance. So that's one category. We have the nature, we have the capital markets and then the money markets. Two, we also have we have also got what we call the insurance companies. I had talked about them. Insurance companies. I've got insurance companies, and these insurance companies, of course, they are trading in what we call the insurance markets. And these insurance markets, they are the ones that are dealing with all the insurance products. We've also have the foreign exchange markets. Foreign exchange markets, which deals with in sale and purchase of foreign currency. We also have the ones for mortgage markets. And these, they deal in loans for specified period of time based on residential and commercial properties. So those are some of the things that we can talk about as far as the nature is concerned. So when they ask you about the nature of financial instruments or financial markets, make sure you highlight the different markets that we have, from the capital markets, the money markets, you talk about the insurance markets, you talk about the foreign exchange markets, the mortgage markets, and what they deal with. So let's look at now the roles of financial markets. Laws of financial markets. Just going to give a few of them. One, these financial markets do what we call financial intermediation. So they do what we call financial intermediation, where they get money from those who have it and they give to those who don't have it. So they get money and also they give it out. They give it out in form of credit to those who need it. They facilitate business. How do they facilitate business? By facilitating trade, by making markets dynamic, where funds are transferred from one place to another. That's how they help in facilitating business growth or growth and development. So they facilitate trade by making markets more dynamic, whereby funds can be transferred easily. They also generate wealth. They generate wealth. So the people who save money, the savers, are able to generate income. And how do these people do? They go and buy shares. When they buy shares, they are going to be earning dividends. So the people who save money, these financial markets will help them to buy shares and be able to create more income or more wealth through buying those shares. Because in the process, they will be able to be getting dividends for their money. We also have absorption of financial risks. So when we bring in many items or many markets that are going to help us give people money, because everyone is going to be bringing in their shares, and at the end of the day, we are going to have economies of scale. Those stock markets are going to have economies of scale, and we will find ourselves, we are able to manage the financial risks. So if an investor is unable to bring in money, then others will actually bring in money. So by having very many companies that are listed on the stock exchange, it creates a very bigger space for people to bring in more money for investment. So it will be like a platform that will help to absorb the financial risks, because the resources may not be available. You may go to the bank and you want to acquire a loan, but they may not give you the money that you need. And the only way you can raise that money is through shares. So as many people are coming in, as very many markets are opened up, it gives the stock market a very good platform where very many people can be able to bring in money. If this one doesn't bring, the other one will bring. It means you will find a way to sort the financial crisis. The other that we can talk about is provision of liquidity. Provision of liquidity. In the stock markets, money is always there. So when there is no money in the public, let's say the company doesn't have money, they can go to the stock market and get money, or they can issue more shares and they get money. So that's, they provide liquidity. When you need money, money is always there. If money is not there, if you have a lot, then you can invest in other companies so that you reduce your liquidity and be able to make more, to generate more wealth. So those are some of the points that we could think of. You can add on more, because there are very many points that you can talk about as far as the laws are concerned. But if they give you the nature and the laws, make sure you explain it in that perspective. You highlight the different markets that we have. You explain what they do and what is traded there. Then you also bring in the laws. So take note of that question. Then let's look at the types of financial markets. I know it's almost the same thing like what we looked at, but there is something I want to clarify. Something small about these types of markets. Now, we have already discussed that we have capital markets, and at the same time we have already discussed that we have money markets. So those two are done, and we have agreed on the difference between the two, where we said that this money market This money market is used for short-term securities, and this one, capital markets, is used, or it focuses on the long-term securities. However, there are other two types of markets which they confuse a little bit. They confuse students a little bit, and those are the ones that we call the primary market, and then what we call the secondary market. And when we understand this, that will be that as far as financial markets are concerned, because we just want to get some brief key things that we see that are very important, we shouldn't exclude. So now, for primary markets, we need to understand the difference between the primary market and then the secondary market. We need to get the difference. So a primary market is a market where shares are listed. Let me write it. Primary market is a market where shares are listed for the first time, on the stock market or stock exchange. In other words, primary market is all about the first time an organization issues its shares to the public. Now, what happens is that when an organization is issuing shares for the first time, we call that process the initial public offer. It is through the initial public offer. These are some of the processes. Initial public offer. That is the process that the company that has been listed issues its shares for the first time. Now, the primary market is stopping at the point when this primary market is closed, like when the initial public offer, they call it IPO, is closed. Then after that time, then it will be what we call the secondary market. So the primary market stops at a point when the initial public offer ends. If we are supposed to issue shares maybe from 1st December 2024 to maybe 31st December 2024, the whole of this month, by the time it closes this, if this is the period for IPO, by the time it goes maybe to 1st Jan 2025, then it will be a secondary market. So a secondary market is a market where shares will be traded after the initial public offer has closed. For example, recently we saw MTN issuing its shares or floating shares on the stock market. They issued their shares for the first time. But when that process ended, don't think that MTN is no longer selling its shares. You can go to the stock market and buy. So where you can buy now is through the stock market. You can't buy it from the primary market anymore because it closed down. So what is going to happen is that for you to be able to buy shares from the stock market, you must go through what we call the stock brokers. You can't just buy shares alone. You have to go through the stock brokers. They are the ones that are going to help you sell or buy your shares, get the buyers, and also make you buy shares. So the secondary market it has very many people who are going to be participating in it. because it goes all the way. It's infinity, or it depends upon the life of the company. But of course, we expect that, but by the time the company is listed on the stock exchange, we expect that company to be a little bit stable. It's not that company that is just going to collapse there and then, because there are criteria for you to first get listed, which are sometimes financial, and others, they look at other key aspects. So that's basically what I wanted us to discuss as far as this is concerned. For the financial markets, we are going to look at the cost of capital. The cost of capital, whereby we shall be able to look at some of the relevances of cost of capital. The relevances, those are importances or the objectives, the cost of capital. And we want to get straight away, we want to look at some of the reference questions or trial numbers. I'm beginning with trial numbers on most of these topics because I want you to get it from the beginning that these numbers are examinable. So we can have maybe November 2019, question 5, part B, August 2018, question 2, November 2019, question 3. So all of it was all about cost of capital. So we want to understand what cost of capital is and how we can be able to go through the different aspects of cost of capital. This is just an introduction. So cost of capital is an important area that we need to be very careful with. But no one will ask you about the definition of cost of capital. But the definition could be from either two viewpoints, depending on whether you are an investor. If you want to determine, to get the real definition, you should have it from the two standing point. Either you are an investor or you want to borrow. You are a borrower. If you are not an investor, then you are going to be a borrower. That's when you can be able to get the different versions from the different viewpoints of whether you are an investor or you are a person who is borrowing money. So if you are a finance manager, meaning you are going to be from the view of the borrower, that is from the view of raising money. So you are going to be with the view of acquisition of finance, of funds. So it's going to be, so if you are acquiring loan, then acquiring fund, then it's going to be the borrowing rate. How much are you going to pay for the money, or they are giving you that? What is the cost of that loan that you are getting? For example, if you go to the bank and you want, let's say 1 billion, and this 1 billion, maybe you are going to do some investments. So this money is not going to be for free. You'll take this 1 billion, but it's not going to be for free. It's only going to be free if you get it from Islamic finance. Remember, we talked about Islamic finance earlier. But also we know that Islamic finance is not that free, but it's a bit relative compared to the borrowing aspect. So even if you get it from your shareholders, of course, shareholders, there you are looking at it as an investor. But if you are the finance manager and you are just acquiring funds, then you can go in for borrowing, or you can raise shares, issue shares to the public, so that you can be able to get more cash. So if you borrow from the stock exchange, then the investors For the investors, we are going to look at it. For the investors, we are going to look at it as a return on their investment, If they give this 1 billion and you've gotten maybe from shares, issuing shares to the stock exchange, then the rate of return you are going to be paying these investors is what we call the cost of that fund that you've got. So the investors, they also want a return on the money you have got after buying the shares from the financial markets. For example, if you are the finance manager and you may be required to evaluate yourself the investment that you are going to make, because if let's say you have a borrowing rate of, let's say, 10%, and you are used both debt, maybe debt is 10%, and you have also got equity of, let's say also 10%. That is the dividend that you are going to be paying. So what is going to happen is that all these people, these ones, they want their returns, even though you are the one to determine when you are supposed to pay them, but they want it. Even these guys, they want it. So this is 10%, and this one is what we call, is also, this is cost of equity, the cost of equity. Then this one is going to be the cost of debt. So what is going to happen is that for you to get the cost of capital, the overall for the company, if you add this and this, if maybe we don't have tax, we don't have anything, you get your 20%. So this 20% is going to be what we call the cost of capital. The cost of capital is 20%. So you must make sure that where you are investing this money, it is able, that business is able to generate more than 20%, so that you can pay off the debt holders and then the equity holders, and you remain with something. So if you evaluate your projects and you find maybe you have gotten maybe the percentage as that, maybe you are using ARR, accounting rate of return, ARR, and maybe it is 25, just know the 5% is now going to be what you are going to remain with, because the 10% will go to the debt and then equity will take also the 10. So that's just a rough analysis, but financially it's not how, like, if you know what you're doing, then you shall find ways, because there are other things that come in, like the tax, like, and others, as we shall be seeing, that we shall come to adjust from that cost of capital. But that's what briefly I can talk about as far as the cost of capital is concerned. It's that minimum rate that is expected from the funds that you have used in your capital structure. So let's now look at the relevances. What are the relevances? They call them relevances, significances, or importances. So you can even call them objectives or relevances. It depends. Relevances or significances or importances of the cost of capital. In investment management or investment decision. Cost of capital in investment decision. So if the examiner doesn't use the word relevance, let me write them. If the examiner doesn't use the word relevance, the examiner can use the word significance, or you can use the word importance. Importance of cost of capital. So those are some of the words the examiner may use. The importance of cost of capital in the capital structure, in your capital structure. And we say the capital structure is just a mixture of funds that are used to finance the business. So we say the capital structure is just a mixture of funds that are used in a given company. I hope we are getting the arguments. So let's now look at some of the points. Number one, we can talk about investment evaluation or investment appraisal. We can use the cost of capital is used to evaluate a project. That's the point. So you as a finance manager, you are responsible for identifying and evaluating. Of course, you identify and evaluate the relevant projects that the company must undertake to invest in. You look at the kind of businesses. Remember, as I told you at the beginning, that you should look for that business that is going to help you earn more than the cost of the capital that you received. If the cost of capital is 20%, then you should take up that investment decision that is going to give you maybe a rate of, let's say, 30%, so that the 10% can actually be a profit from that mathematical point of view, so that you can be able to see that you are making progress. So since there are very many projects that you want to evaluate or that you want to invest in, you must evaluate all those investment ideas or investment projects and choose the best alternative to invest in using the cost of capital or using that discount rate. So we evaluate this using that cost of capital, but it is through the different methods, either using the discounted cash flow techniques or the non-discounted cash flow techniques. But the bottom line is to evaluate the investment ideas and you come up with the best alternative is where you should invest your money. And the best alternative is that is going to give you more than what you have put in the business. So we use those different tools. We can use the non-discounted cash flow techniques or we use the discounted cash flow techniques. And most of the times, the examiner will tell you to evaluate the project using any given discounted, either discounted or non-discounted cash flow technique. But most of the times we always go for NPV, net present value, because NPV is a bit broader. It involves in identifying the different cash flows. You don't just discount the cash flows. You have to first look for the discount, the cash flows that you are going to discount. So unless otherwise, the NPV is more preferred. But I'm not saying that it is the one that you will always be examined on. Others, we are going to look at all of them as we are doing what we call the local NPV, and then even when you are doing the international NPV. They are a bit different. The NPV of a local company is different from the NPV of an international company, and we shall understand those ones when we go to those ideas, those investment decisions. So, but you know that for you to compute NPV, you know that you will need what we call the discount factor, because you will need to discount the cash flows that the project is going to generate, and you make them present so that you can determine whether the project is viable or not viable. And that discount factor that we always use is what we call the cost of capital. It's the one that we use to discount the cash flows to make them present. And that's how the cost of capital is used in investment appraisal or capital budgeting decision. Let's look at point number 2, designing debt policy. Now, if you have computed your cost of capital, you learn that this cost of capital, we call it, we always refer to the WACC, the weighted average cost of capital, because it is the overall. If we don't call it WACC, we call it overall cost of capital, or we call it the weighted average cost of capital, or just cost of capital, or what we call the desired rate or the minimum rate. So it has very many names, but just know the bottom line is the fact that we use it for designing the debt policy. Now, when you have computed your cost of capital, when you are using any given capital structure that you have in the question, including both the debt finance and then the equity finance. So when you combine the costs of debt and then the cost of equity, all combined together, they will form what we call the weighted average cost of capital, or what we call the WACC. So if you have discovered that your cost of capital or your weighted average cost of capital is, let's say, 10%, and you have computed and you've gotten 10%, and you are designing your debt policy, then it could be in one way, debt policy, the debt policy in terms of the money you borrow, or it could be in terms of the services you give out on credit to people. Then you may say that you may not be able to give services to people at a price that is less than the desired or the calculated cost of capital. So if let's say you are saying that this is my rate, 10%. So it will help you to design when you are giving out debt to people, and also when you are acquiring more debt, because you shouldn't expect that your weighted average cost of capital is 10% and you expect someone to give you a loan where you are going to be paying interest of, let's say, 20%. This one doesn't make sense. Or whereby for you are giving out credit 20%, 30%. So it helps you to design the mechanisms that you can use as a business. So the other that we can look at, we can use it for formulation of debt, formulation of dividend policy. You can use it to know which percentage should I give out in terms of dividends to my shareholders. So as a finance manager, you are responsible to pay dividends to your shareholders or the owners of the business. So you will use this cost of capital to determine how much to pay these shareholders, because it's going to be the cost that you will use to benchmark to know how much does it cost you to get more funding from different sources. Because if you don't base on this, if my work or the cost of capital is 10%, at least when I'm giving out dividends, at least I shouldn't exceed 10%. Reason being, if I exceed, then it is going to cost me much more money for me to raise more capital. At least I rather give them 10% of my retained earnings or the profit after tax. Then I remain with the balance as retained earnings that I can use to invest in the business to make more money. But if you give out more than, because this will be the original cost that can guide you, that for you to raise the money you've used in the business, you spent 10%. You are paying out 10%. So even when you're distributing, you can say, let me use this as a benchmark for me to set my dividend policy. Because after all, the money that is going to be paid out in terms of dividends is determined by the management. Of course, the CFO, the finance manager, is going to be the one that is advising these other people on what to do, depending on the pending investment ideas. Because you can be having a project of, let's say, 2 billion, but you made profit after tax of, let's say, 500 million. And for you want to give out all the 500 million, yet you have a project of 2 billion that you want to accomplish. So you can say that since I have already 500 million, I can keep this 500 million. Maybe I just increase the other guys' shares. They just increase, they get just paper dividend, but not the real money. So that you can use the same money and maybe you top up the 1.5 billion that is pending to make the 2 billion for that new investment. So the other, you can look at it as a measure for evaluating performance. So you can look at the profits the managers have made. Have they made enough money that can be able to pay off the debt holders, the equity holders, and also remain with something? So if they have not done so, then it means you can regulate, you can benchmark on what they have done in terms of evaluating their performance. So that's what I wanted to look at in this video. In the next video, we are going to basically focus on what we call gearing. We want to look at gearing and the cost of capital when these two are combined. What is the impact? Cost of capital. So want to understand how gearing or a company having more debt, what is the impact of the company having more debt onto the whole overall cost of capital of the business? What is the implication? That's what we are going to look at, gearing and cost of capital. Now, as I explained, we want to look at the impact. If the company is highly geared, what happens to the cost of capital? Now, this cost of capital has issues that disturb it. And one of the major issues is gearing. And by definition, gearing refers to the amount of debt finance a company uses. A company uses in its capital structure. Amount of debt finance a company uses in its capital structure. Now, one thing that you need to note is the fact that if the company is geared, if a company is geared, in other words, it has debt in its capital structure, it means it uses debt in its capital structure. However, there are those companies that are not geared, which means they don't use anything to do with debt in their capital structure. Now, if the company is not using debt in its capital structure, it means they are using 100% their own money, whether their own savings, whether their own equity shares. Now, so long as your debt is higher than the equity in the capital structure, then you can say that you are highly geared. So the problem is not being geared. The problem is to be having high debt in your capital structure, meaning you are highly geared. So once you have a lot of debt in your capital structure, your debt is more than. So if the debt is more than the equity, then we can say you are highly geared. That is highly geared. But if your equity is more than the debt, then you are not geared. Now, the paper doesn't stop, like what we are studying doesn't stop you from using debt in your capital structure. So, but what we are bringing in is the fact that, or is the concept of gearing that you understand. Because I expect that the more you use debt in your capital structure, you are actually geared. You are a geared company, and we are not against being geared in your capital structure. But we just want you to understand the implications that using debt in your capital structure, it has an implication on the cost of capital. And we want to look at its impact when you have more debt in your capital structure and when you have less debt in your capital structure. Now, we have agreed that as a CFO of any business or the senior finance manager of any business, you are responsible for some decisions as we looked at them. And one of them, we said some of the decisions that you are supposed to do, you are supposed to do investment decision. So you are supposed to make decisions about investment, about dividends, and then financing decision. But we said working capital management is not part of our syllabus. That one we looked at it under the financial management. But for advanced financial management, we don't have working capital management. So because of these decisions, you need to be mindful if you are a company that is highly geared. So if you are highly geared and you are supposed to make all these decisions, then you should be mindful because it has an impact on your cost of capital. So if you are highly geared and you are thinking to raise more funds, maybe using the finance decision, and you are seeking for more money from other lenders, then that might be a problem because as I said, because I told you companies have a ceiling, a maximum that they can borrow. Even banks, they give you that for your company, we can maybe lend you up to 70 or 75 or 80% of your assets. So if you are highly geared, meaning almost your assets are financed by debt, maybe 65% of your assets are financed by debt. That's what we mean by being highly geared. So if you want to acquire more funds through debt, then it's going to be a problem to you. Why? Because of the fact that we expect you to be facing a challenge of people not willing to grant you the money that you need because of the fact that you have very many loans. So if you are highly geared and you need to raise more funds, at least it would be a very good idea for you to think about equity, looking at equity finance sources, because you're already highly geared. But how do we know that this company is actually highly geared? What is the real mathematics that we look at, or what are some of the percentages? We are going to dive into that when we look at the gearing ratios. But for now, just understand, if a company is highly geared, it means its debt finance is more than the equity finance. Now, once a company is geared, there are risks you will face, and there are two major risks. One of them is what we call the finance, or we can call them financial risks. And the other is what we call the operational risk. The operational risks. So there are two. When the company is geared, we don't care whether it is highly geared or low geared, but there are risks. One of them, financial risks, and then the other is operational risks. So for examination purposes, we need to take note, because here the examiner can bring to you a standalone number carrying 25 marks, explaining this kind of arguments. So we need to be careful in what we are going to discuss. Now, what do we mean by financial risks and then the operational risks? How are they related to the fact that when the company is geared, you face them? Now, when we talk about financial risks, maybe we start with that. Financial risks. When we talk about financial risks, we are only interested in, of course, first of all, we shall need to first understand what it is. Now, the concern of financial risk is that the owners of the money are likely to get reduced dividends as a result of the financial risks. So the company predicted to get, let's say, the company predicted to get, let's say, 100 million. This is profit after tax. If you have predicted, maybe your estimated profit, this is estimated profit after tax part. But when the year ends, you find that you have made 60 million as your profit after tax. This is actual. So what this means is that even the dividends that you had anticipated, if let's say you were saying that we shall be paying 10% dividend, 10% on the estimated here, it will be 10 million. But here 10% will only be 6 million. Are you seeing that there has been a reduction in the dividend that the total dividend that we are supposed to pay to our people or to our owners? So it has reduced by 4 million because of not achieving what we had planned to achieve. So even the dividend, the fact that the shareholders, their dividends is going to reduce because of financial risks is because the fact that what we had estimated to receive is 100 million, but we got 60. We are supposed to pay them what we have, even though we had estimated to get 100 million, and that will raise maybe 10 million in debt, in dividends. We shall distribute only the 6 million that we have received because we base on what we have achieved. So, because of financial risks, shareholders will have that fear that since we are geared, then financial risks might affect us. These financial risks, because now, what causes the dividends to reduce is because maybe interest was, remember interest is paid, is deducted before paying taxes. So before you arrived on this 100 million, maybe, or the 60 million, let's go with the 60 million that we have actually achieved, this 60 million. We first deducted the interest for the people who gave us borrowed money, that is debt. If we never had debt, that amount that we paid out as interest or that we deducted as interest would have increased. our profit after tax. And in that sense, we would also have a higher dividend that would be paid to the shareholders. So by mere fact that we have debt in our capital structure, shareholders will be worried that their dividends will be lower. So that's one argument, or that's as a result of financial risks, because they fear to lose money, given the fact that they will be bringing in more people in debt. However, the examiner might prompt you to compute financial risks. In other words, they may tell you to compute the risk that is associated with these shareholders' way of losing money. What is that risk? Either in percentage or the ratio, we don't know. We don't know yet until we have done a number. So, the examiner might prompt you to compute financial risk, or what we call gearing associated with financial risks. In other words, we are looking at financial risks based on the fact that the company is geared. We don't care whether the company is highly geared, but as long as it has debt in its capital structure. Because if it is not highly geared, then even the risks, the financial risks will be a little bit minimal. So we don't make any comment. We first compute, then we make a comment that based on this, then maybe the financial risk is a bit lower. So we have to be very careful, because you could be computing gearing associated with financial risks, and later we will also be concluding with gearing associated with operational risks. So these are not matters of level 2. We have now reached to the advanced financial management. So these items, we have not talked about them under our financial management paper on level 2. So these are new areas that if you have just come from level 2 and you're just doing your advanced financial management paper for the first time, these are new areas that you need to focus and have something. So I've said that the examiner can bring a standalone number here. That standalone number, it came, there is a year when it came. It was taking 25 marks. It was, I think 2019. It was carrying 25 marks. A standalone number on this same. Gearing associated with financial risks, then gearing associated with operational risks. So in the next video, we are going to look at, first, let's understand what gearing ratio is, or what we call the leverage ratio. Gearing ratio. Before we compute, we first need to know what a gearing ratio is. Gearing ratio, or what we call the leverage ratio. Gearing ratio, or what we call the leverage ratio. So I need us to first understand what gearing ratio is and what leverage ratio is, or gearing or leverage ratio are, so that we can be able to proceed to the computations. Because after understanding this, we shall get the formulas that we are going to be using to be able to compute these gearing associated with operational risk and then the financial risks. But I hope you are getting where we are heading. But we want to first understand what gearing ratio is all about before we can be able to pick a practical question where we shall be able to do a computation about the financial risk, gearing that is related to financial risk. So let's first understand what gearing ratio is. So gearing ratio or leverage ratio. Now, how do we measure financial risk for a company that is geared? For a company that is that is geared. So this is basically what we are trying to answer. How do we measure a company? How do we measure financial risks for a company that is geared? Now, one way of measuring financial risk for a geared company is by using gearing ratio, and most importantly, the debt to equity. The debt to equity ratio. So debt to equity ratio, or by using what we call the interest cover. These are ratios that we studied in our advanced financial management. So one way is to use the gearing ratio, and the gearing ratio is mainly debt to equity ratio or the interest cover ratio. However, there is what we call financial gearing. Now, financial gearing shows the relationship between shareholder funds and the prior charge capital. So the financial gearing shows the relationship between shareholders funds and prior charge capital. That's what we call financial gearing. Now, there is also what we call operational gearing. Now, operational gearing shows the relationship. This one shows the relationship between contribution and profit before interest and tax. So, operational gearing shows the relationship between contribution and profit before interest and tax. We know that contribution, we know from the fact that contribution equals revenue minus total variable costs. Total variable cost of sales, that's when we'll be able to get the total contribution. Now, let's now focus on the exam. Let's put our focus on the exam. So, the examiner will come out clearly to tell you either to compute any of the above gearing ratios. So he can tell you to compute financial gearing ratio or what we call the operational gearing ratio. But for you to be able to compute those, then you need to know the following. One, this is something that you should know. You need to explain the ratio after making some computations. So you have to make explanations for any ratio that you have computed. And then you tell us the level of gearing. You should explain the level of gearing. In other words, you tell us the level of gearing and you be able to explain the computations that you've made. So, after explaining the level of gearing, whether you are going to to move forward or you are not going to move forward. 2, because we have got very many formulas for computing financial gearing, then we need to take note of the different formulas that we have for computing what we call the financial gearing. So we have very many formulas. Now, financial gearing, let me just use FG to mean financial gearing, just to create more space. Financial gearing equals prior charge capital over equity capital. This should also include reserve, including reserves if they are there. So that's one method. The other, you could use prior charge capital over total capital employed, or what we call the net assets. The net assets. You know, capital employed is net assets. But now we need to understand what this means, prior charge capital, where prior charge capital, so we need to understand prior charge capital is the one that has a right to the receipt of interest or preferred dividends. Prior charge capital is that capital that has, it's the capital that has a right to the receipt of interest or preferred dividends. Preferred dividends in a precedence to any claims on distributable earnings. Distributable earnings on the part of ordinary shares. In other words, it's that ordinary share where you have a right to receive dividends or interest. It's that capital where you have a right of receiving dividends. 2, it can also, the prior charge capital can also represent the prior charge capital. Prior charge capital can also include or exclude minority interest. Minority interests, deferred tax, and deferred income. So we exclude this item. These items are supposed to be excluded from the prior charge capital. We are supposed to either include or exclude based on the scenario that they have given to you. So we should exclude things to do with minority interest. Minority interest is from the control perspective, where an organization has some level of control in the other. So you need to be careful, because that information will be available in the financial statements, specifically the balance sheet. So you may find that you have capital in the balance sheet, because I'm trying to explain the prior charge capital. If you may find that you have capital in the balance sheet, but you still, on that same capital that you have, you will not pay any interest on it, neither you will pay any dividends. Like for instance, I can have capital, let's say I have debt, but that debt I'm not paying it. I may have shares, but those shares I'm not paying dividends. Maybe someone gave me the money. Venture capitalist, he said, just take the money, do the business, bring back my money without any interest. Maybe it's a loan, but I don't pay any interest. Someone gave me the loan, but when I get back the money, I take it the way it is, minus paying any interest. So that can't be included, because I will not be able to pay or even pay interest or even pay dividends. But I'm using that money in my capital structure as my capital. So those things, they will be in the financial statement. And that's why I'm highlighting them, that if you see them, it's upon the examiner telling you that this is this is this, that you can include. But if you are not told, then you should exclude them from what we call the prior charge capital. Prior charge capital, we said it is that capital where you are going to pay interest on it, or you are going to pay dividends on it. If it is shares, those shares must be able to receive dividends from where they came from. And if it is a loan, you must be able to pay interest on that loan. So you can see that when you are computing the financial gearing from the formula, we are trying to look at, you see that we are trying to look at the prior charge capital, this one here, the prior charge capital over the equity capital, or over the net assets or total capital employed. So when I'm computing the financial gearing, I'm looking for prior charge capital. Technically, that is capital that has a right to receive interest, or you are supposed to pay interest on it. Of course, if you're not paying interest, you are going to be paying dividends, as long as you're using it as the capital. So you are either going to be receiving, or you are going to be paying out either a dividend or an interest. And in most cases, the order doesn't matter, as long as you look at a certain amount that you are using as your capital, but that figure you are paying interest, or you are paying out dividend, then it's supposed to be included in the prior charge capital. But in case of a company, because there are instances where the companies may be winding up, they are liquidating the company, and in line with, let's say, the credit hierarchy, because we are saying the order doesn't matter, but there are situations where if the organization is winding up or they are liquidating the company, the order matters, because we get from the credit hierarchy who is supposed to be paid first. There is no way you are going to pay the shareholders minus paying those debt holders. You first clear the debt component, and then the shareholders will take what has remained after clearing all the liabilities that were there. So most of the times, if you have companies that are winding up, they are going to be paid according to their claim to the prior charge capital. So this is where the examiner will confuse you, where he might say, maybe he might put the capital in the balance sheet. You see that you have one item of capital, but you are not going to be paying interest, or you are not going to be paying dividend on it, and they are calling it capital. So if you are not going to be paying interest, or you are not going to be paying dividend, then it shouldn't be included in our prior charge capital. So one of the things that we talked about, we looked at the deferred taxes and deferred incomes. So if let's say you have not been paying, let's say, taxes for 3 years, if you have not been paying taxes, then it's going to be a liability. You have accumulated some money because you are supposed to pay, but you have not been paying. So you are going to have a long-term liability that is going to be provided in your balance sheet as a long-term liability. And of course, you know that you are going to be paying interest on that, because if you don't pay the taxes are going to accumulate some interest. It's like you have reserved the money. You would have paid that money, and it goes, the other interest doesn't come in. But since you remained with the money, you didn't pay, so interest keeps on accumulating. So once you know that you are going to be accumulating interest on it, or you are going to be receiving, because it may be an income, you are going maybe to receive interest, then it's supposed to be included in our prior charge capital. But if you know that there is an element where you are not going to pay interest, or you are not going to receive it, then it must be excluded from that prior charge capital. But also, prior charge capital could also include or exclude what we call minority interest. We said minority interest, deferred tax, deferred incomes, they can be included or excluded depending on the scenario they have given in the financial statement. But just know some of these, they are either going to be included, some are not going to be included. So as long as you are not going to pay interest on them, like maybe for deferred revenue, deferred taxes, and that's ideally what we want to consider, unless you are going to be prompted by the examiner, as we shall see in some of the practical numbers, because the examiner can tell you, maybe he gives you a note, he gives you the balance sheet, then we'll have some additional information where they are telling you you are going to be able to be paying interest. Now, for a company, being geared is not a problem. But if you are gearing, this is where we are going to get the comment, what we are going to comment on our results we've computed after getting the financial gearing. We need to compute and explain. So we have no problem with the company being geared, but the problem is that if the company is so much into debt, it's going to bring what we call the financial risks. And now we are going to compute this financial risk, or what we call the financial gearing, in percentages. The result, the end point is going to be either it can be in percentage, or you can compute it in decimals. Now, if the gearing is above, when you are making the conclusion, if the gearing, because we are talking about the financial gearing, is above 100%, then we can say that that company is highly geared. But if you are below, this is above 100%, we say you are highly geared. But if the gearing is below 100%, then that company is not, we shall not have any problem with that, meaning it's not all that geared. So we are going to try to look at some calculations, but the examiner is likely to specify, in other words, the examiner most of the times is going to be specific on which formula to use for computing the financial gearing. And we are going to look at how we can be able to compute that based on all these formulas that we have. Then it will be upon what the examiner brings that we shall focus on. But there are scenarios where the examiner might not give you the exact formula to use. So if the examiner doesn't specify which formula, then you base on the information that has been given to you in the question. Because you may find you are prompted maybe to use another formula, but looking at the information you have, it can't allow you to use that same formula. So you base on the information that is available. The computations for financial risks, and want to look at the financial gearing by looking at a simulation. And this example is going to be something very basic, but it is going to help us put in context what we looked at, like the formulas we had looked at under financial gearing. So without wasting more time, let's look at the simulation and we see what it has to tell us. So from the simulation, we can see that they are saying from the following statement of financial position, compute the company's financial gearing. And you can see they have given us the current assets, they have given us the non-current assets. So they are telling us they are shillings in thousands. They are 1,000 shillings. So it's in thousands, the figures that we have. So they have given us the non-current assets as 12,400. They have given us current assets as 1,000. The total assets are now 13,400. They are giving us the financing part of it, financed by debenture of 4,000. Debenture is 4,700. Bank loan is 500. Then they are telling us provisions for liabilities and charges. That is deferred taxation, 300. Deferred income, 250. Ordinary shares, we have 1,500. Then we have preference shares as 500. So if you try to go down to the question, we can see that we have share premium, and that share premium is, the share premium is 760. we have the revaluation reserve of 1,200. Then we have the income statement. Of course, the income statement, we know whatever we get from there is that profit for the period. So this is like more of retained earnings. So the retained earnings is 2,810, giving us a total of 12,520. So they have also gone ahead to give us the current liabilities. We have loans of 120. We have bank overdrafts of 260. We move downwards. We also have trade payables 430. We have bills of exchange, that is 70, giving us a total of course, we add the current assets from the other 12,520. It gives us 13,420. So this is the very figure that we are going to use. Now, that's the end of the question. They are telling us we need to look at the simulation. So let me switch to where we are going to be doing our workings. You can pause the video so that you can copy down the question and we'll go through together. So let me try to go back a little bit the question and you'll be able to see what we are having. So that's the information that we have. So we want to look at the solution. We see what we have to do. So let me take off this and we share the screen where we are going to be doing our computations. So welcome back once again. Let's now look at that same question. We see how we can be able to solve what we have. So let's look at the solution. Now we can see that they have told us to compute gearing and they did not tell us which formula to use. So since they have not told us which formula that we are going to use, but we know we are going to be computing gearing, but we also looked at in the previous videos, we looked at the formula for computing gearing. From our notes, we've seen the different formulas that we can use to compute the financial gearing. And financial gearing, we said it equals financial gearing. Some of the formulas we looked at, we said it equals prior charge capital over the prior charge capital divided by equity. That's one of the formulas. But we also made some comments that we don't include capital that doesn't qualify to receive or pay interest or dividend. And if you look at the question, you will see that we are actually having some aspects in the question. We have those capital amounts that don't actually qualify to paying or receiving interest or dividends on them. So we need to not to include them. So we need to compute the gearing ratio, and the gearing ratio is actually the financial gearing. So one of our formulas is, we said, prior charge capital over equity, or what we call the net assets. Now, we need to first get the workings. We need first to know what prior charge capital is all about. So let's now first look at prior charge capital from the information that they have given us. The prior charge capital. What are those items that we are going to include in the prior charge capital? Now, for us to get the prior charge capital, I'm going to be picking the preference shares. I'm going to be picking preference shares, I'm also going to be picking debentures. I'm also going to be picking the long-term loans. Let's first pick those. We look at the items. What's their amount? We've seen that debenture had 4,700. We are working thousands. So this was debenture. It is 4,700. We looked at the preference shares and we are seeing preference shares is 500. So we also have the long-term loans. These long-term loans, we've seen that the long-term loans, we have these, the ones you are seeing, bank loan, which is 500. So you can see once we add the total of that, we will be getting 5,700. That is the total. And we've first included only these ones, reason being is the fact that these are the ones that bear interest, or where you are going to be paying interest, because by legal definitions these are all debt instruments, all these are debt products or debt items. So we first added the debt items, and we've seen I've gone ahead and I ignored the short-term debt. Of course, we had the short-term debt where we had, if you look at the current assets, the current liabilities, we had things to do with the loans over 120. We had the bank overdrafts. So I excluded those ones, even though we pay interest on them, but I first excluded them. I wanted to first deal with the long-term debt items. Now, the total that I've gotten without including the short-term debt, it is 5,700. And I have a reason as to why I've done it, or I've computed it that way, because we wanted to first separate these items, and we shall learn more about it. But if we bring in things to do with the short-term debt, because of space, I'm going to combine. Just call it short-term debt. And within the short-term debt, of course, we have the overdraft. And the overdraft, we've seen the bank overdraft is 260. We also have the loan. The loans we are seeing we have 120. So once you add these two, you will see that you are going to be getting, this is 3,800. And once you add this, you'll be getting a total of 6,080. Now this 6,080 is the total of the short-term and then the long-term debt. So we have included both the short-term and then the long-term debt to give us the total debt where we are paying interest for using that kind of items. So it's all debt, but it means there are things which we have left out. There are things to do with provisions for liabilities and charges, that is deferred taxation. We have ignored that. We have ignored things to do with trade payables, bills payables, because those ones we are not going to be paying interest on them unless the examiner states it that within the deferred taxes, even though it is a long-term aspect, we are going to be incurring some interest on it. But if the examiner doesn't tell you, then you don't include it. If you don't see that comment, then please don't include that. So that is what we call the debt, the prior charge capital. So even if they say it is long-term deferred payment, we don't include that in our computations. Now, we have gotten our prior charge capital as 80, as 68. So we need now to look at the equity. Let's get now the equity. Now, of course, for the equity components are very easy. So for us to get the equity, we get it also from that balance sheet where we add the ordinary shares. We also add the share premium. Then we also add what we call the revaluation reserve. We also add what we call the retained earnings or the income statement. This is the retained earnings from our income statement. So once we add those, we've seen that we had the retained earnings was 2810. Then the revaluation reserve, of course, was 1,200. Then we added the share premium was 760. Then we add the ordinary share, which was 1,500. So once you add those, you'll be getting 6270. So this is the total equity. Total equity of 6270. Now, we want to get our financial gearing. How do we get the financial gearing? We said the formula for financial gearing was prior charge capital divided by the equity. So it's going to be the 60/80. This is going to be the 60/80 divided by the 6270 times 100, of course, to make it a percentage. So this is going to give you 97%. So that's our gearing. So we have gone ahead to compute what we call the financial gearing. So our financial gearing equals 97%. So want to make conclusion or want to advise the business what they should be doing. One thing that you need to note is the fact that in our equity, we did not add in preference shares. Remember, we said preference shares is debt. Because we go by the legal definition that preference share is supposed to be paid back. In other words, you are supposed to pay back for these preference shares. We go by the legal definition as per our financial management. But if you go to your financial reporting or the financial accounting, they bring in the other aspects to do with whether the preference shares was redeemable or it was irredeemable. But here we go by the legal definition, and that's why we've not added in the preference shares in our equity component. So that's how we compute the financial gearing. But now, I want to give you a scenario before we make a comment. I want us to comment and to have it in mind. Let's assume that the other one was part A of the question. Sometimes the examiner can tell you to use another formula. Sometimes the examiner can specify the formula that you are going to use. So you can go by the other formula where you expand the formula for financial gearing, which is the prior charge capital divided by equity plus the prior charge capital. So the equity is the same that you have added. It is just that you get the prior charge capital, what we got above, then we add back we expand it and we add the prior charge capital that we've gotten. So you'll be, the answer here will be, you'll get the 6080 over the 6270 plus the 6080. Of course, even this you multiply by 100, and this will give you something like 49.2%. So you'll be seeing that when you do that, the gearing drops to this 49.2. Remember, the other one was just 97, but it has dropped to 49.2. But we have different ways how you are going to be commenting based on the formula that you have used. We have also got another formula. Let's say this is our part C. We have also got our formula where we are saying that financial gearing is the prior charge capital divided by capital employed, or what we call the net assets. And we know that net assets, we said net assets equals the total assets minus the current liabilities. That's how we get the net assets. However, the prior charge capital used here is the one that we computed, but we ignore the short-term debt. So this prior charge capital that you are seeing up here is going to be ignoring the other short-term debt that we computed. Meaning here we just go by the long-term debt, which was, I think, 5,700. So we ignore the short-term debt. So at some point it doesn't actually matter. You can include it, but it's better if you exclude it, because what they are looking at here, they are trying to ignore the current liabilities. Because when we get the net assets here, you will see that we ignored the current, we are excluding the current liabilities. We are getting the total assets minus the current liabilities. So if you include it up here, it will be like, it will not make more sense. But most of the times they exclude it. But even if you include it, they will not penalize you for that. So that's how we do, for us to, we do the financial gearing for us to be getting our gearing, so that we can be seeing it in a minimal percentage. However, there is what I want you to understand. For you as the CFO or the senior finance manager of that organization, you need to be prudent. In other words, if you are that person and you want to survive in business, because you are the person who is going to be giving the advice to these people. So if you want to survive in business, most of the these CFOs, they acknowledge the second method, this part B, this one. They acknowledge it, which is giving them a minimal percentage. They go by the second approach because it shows that the company is not highly geared as per se. Because if you look at the 49%, the other one was 97 in part A. We got 97. But this one is giving them 49.2. If you look at it percentage-wise, you will conclude that maybe the other, of course, 50.8 is equity. And you're not going to assume. Because if you use this method, you are going to have a little bit, a more or less of a percentage that is a bit lower compared to using the other formulas. So that's what the wiser CFOs that want business to, of course, to boost, to boom, that's what they use. Because if you use this method, even if you go to acquire a loan, they will look at you as if you are not all that highly geared because of the formula that you are using. So since the formula is going to be giving us a different answer and it is going to be used to make a decision, then it's also a problem in the formula itself. It's going to create problems because someone can be judged based on the method they have used. So as a wise CFO, they go with this percentage. So, but now the people who are going to be regulating the business, because if you are, let's say, in the communication industry, the person who's going to be your regulator is going to be the Uganda Communications Commission. If, let's say, you are MTN, you are going to be regulated by the industrial regulator, which is the UCC, or the Uganda Communications Commission. If maybe you are in the banking industry, your commercial bank, then you are going to be regulated by the Bank of Uganda. If you're microfinance, then you are going to be in the microfinance support center. So these two people, the regulator and the company itself, they are preferring different methods. The regulators, they prefer the first one because the first one is the one which gave us 97%. So they can base on that and they say this company is highly geared. But if me, the CFO of the business, I prefer that method that is going to give me a lower gearing, financial gearing ratio. Because by having 49.2, I can be able to get more money from other lenders. But the regulator will prefer the other one, which gives them a higher rate so that they can be able to make a comparison. Because we are being prudent a little bit. From the side of the company and also the side of the regulator, they are trying to be a little bit prudent. Because if you are the regulator and you go by this second method, then you are going to say as if the company is not all that highly geared. But if you use the other method, then it's also going to give you a different method and a different percentage. So the regulators, they prefer the first approach because it shows the true picture of whether you are geared or you are not geared. And that's why most of the times the examiner will tell you which method to use. And if he doesn't, then you can just go by any of this method. Any can work. So that's what I wanted you to get as far as the computations are concerned. So what we are going to look at in the next video is going to be looking at the same gearing ratio. But here we are going to be basing on the market values. Remember here, the values that we have used the values as per the balance sheet, meaning those are historical values. So we want to look at what will be the gearing, because market ratios is going to give us what we call a market capitalization, and it's going to give us a different picture, whereby if the item is tradable, then of course its value keeps on changing. It can be higher, it can be lower, except for debt, because we know debt is as per the quoted rate. If I've given you 100 million, I expect you to pay 100 million at the maturity period of the loan. But for debt, for equity components, Like for ordinary shares, I can buy my shares when they are 200 per share, but by the time maybe after 3 to 4 years, you find that the market has actually reduced. The shares that were 200 shillings, they are now 100 shillings, meaning even the market capitalization will actually reduce. So want to look at those dynamics. What happens if at all we are basing on the market values? So take note that the other one, we are going to be using the same methods, but here we are basing on the market values. We are using the market prices of that instrument at that given period, so that we can be able to understand what we are doing and be able to make a comment, because we've said it's not all about making computation, but it's all about advising based on the results that we've got, based on market values. But I want you to note something small, that the formulas here are not going to change. What is only going to change is the fact that instead of us using the historical values, we are basically focusing on using the market values. What that means is that they will give you, like for equity, we know the tradable items. These tradable items, they are preference shares, the debentures, if they are bonds, if they are loan notice, and others. Of course, we also have the ordinary shares. Now, these ones, they will always give you what we call the market price per share. If they don't give you the market price per share, you know how to get the market price per share. They may give you the par value of the asset, of that item. They tell that this preference share had a par value of this. Then they give you the total amount. Of course, you'll be able to know. If they give you the total amount, you can actually be able to know the market price. But most of the times they may give you the market price. I'm not going to do a quick broader number to explain this, but I just want you to highlight on the key things that you should expect if it happens. So what they do in this one, they will give you the market values. So instead of using the other values that they have given you, you make sure that you compute what we call the market capitalization. Market capitalization. In other words, you compute the total amount. So this is going to be the MPS, the market price per share, times the number of shares. So if they give you, if you want to get the number of shares, of course you know how to get the number of shares. You'll get the amount that they have given you divided by the par value. Then you multiply by the market value. So that's what I'm meaning. After getting the market values, of course, you multiply it by the number of shares to get the new market capitalization that you are going to use in computation of the thing that you are going to put in, either the prior charge capital or the equity component. So that's basically what is supposed to be done from that perspective. But what I want to start with for today is the fact that the other time we spoke about two things. The risks, we spoke about the financial risks that and those resulted into what we call financial gearing risks. But we also talked about things to do with the operational risks. So we want to look at how do you compute the operational gearing. So this is the second phase. The other one, we have been talking about what we call the financial gearing. So want now to look at the operational gearing. And this is a second part. All this is because we say that there are two risks. We are going to either have financial risks or we are going to be having what we call operational gearing. And we got this from the other topic where we looked at the cost of capital and the gearing. we say there are two things that will result in once the company is geared. Either we are going to have financial risks or we are going to have operational risks. And the operational risks gave birth to what we call the financial gearing. Then the operational risks gave birth to what we call the operational gearing. So I want to look at what will be the impact of the cost of capital in the sense when it has resulted into what we call operational risks. So that's what we want to look at. Now, we need to first understand what operational gearing is. Now, operational gearing has very many formulas, but there is one that looks at the modern financial management, because there is what we used to cover in the past and what we are financial management is a little bit evolving, and what we used to look at in the past years is not the same thing that we are looking at given the fact that industrialization came into existence. There are very many industries. So financial management also keeps on changing. So we used to have the operational gearing that was not in considering what we call the fixed costs. By then, we are not looking at the fixed costs. But because now if you are insisting on the operational costs, that those are the costs that are incurred whether you are producing, whether you are not producing. If you look at that, but the whole interpretation by the examiner, it came out to be the same. Those who do it in the previous aspects or those who do it in the different methods that we are going to be looking at to compute what we call the operational gearing, the examiner has concluded that the implications are going to be quite the same. So we are going to have different scenarios on the interpretation. So, but now what you need to know is that recently the examiner looked at what we call the fixed costs. But operational gearing will be if we are to basically look at what we call the operational gearing, the formulas, we have what we call the contribution. You know, contribution divided by profit before interest and tax. Profit before interest and tax, or what we call the PBIT. Profit before interest and tax. Of course, this one you multiply it by 100 to make it a percentage. However, operational gearing responds to what we call business risks. And business risks looks at more of low profits or losses, depending on the nature of the business. So how do we measure the business risk, or how do we measure the operational gearing? Because we say that operational gearing bases or responds to what we call the business risks. Because those business risks, they are more concerned when the company is making low profits or losses. So the way we measure is we get the contribution and we divide it with profit before interest and tax. How do we get contribution? We know contribution is gotten from sales minus variable costs. In other words, we get the total sales revenue minus the total variable costs to be able to get the total contribution. If they give you the contribution per unit, then of course you know it has been gotten from getting the selling price minus the variable cost per unit. So if they give you the contribution per unit, you just know that you are supposed to multiply by the number of units to be able to get the total contribution. So here we use the total contribution. Maybe to put it here, you know that it is from sales minus variable costs. That's how we get the contribution. Sales minus variable costs. And we divide it by the profit before interest and tax. Of course, that's the operational profit. You know, the operational profit doesn't include or doesn't allow you to expense interest, because we know interest is going to be a financing cost. So the profit before interest and tax, that is the profit you have achieved before you pay off the people who financed the operations. Remember, we finance operations using debt. And the reason as why we take off interest is because interest on the money that we have used in the operation of the business is tax deductible. So here we don't first exclude it. Reason being, we want to look at what was the profit that we have got before paying off the people who gave us the money, and even before paying off the tax, because the tax is just a statutory obligation you are supposed to pay. It's by law. But in other words, we can't treat it as a normal expense of the business, because it is not as a result of the operations of the business. If I make a loss, I'm not paying profit. I'm not paying taxes. So that's the implication. That's why we are taking the profit before interest and the tax. So if you get these financial statements, you can be able to get this information. We know that all this is supposed to be gotten from the income statement. So you are supposed to be given an income statement for you to be able to compute these analysis. It is from the operations, and the operations is within the performance of the business. If the business is not performing, then we don't have anything to do with operational risks. These operational risks, they are just affecting they are just affecting the profit that you should get. Otherwise, they don't look at the whole entity, but they look at the operations, whether you are able to make profit or not. So we get that problem. So we want to look at the money that we use to finance these operations. Are they making something? That's basically what we are trying to look at. So we look at the risks that are associated with the kind of operations that we are going to be dealing with. So let's now look at something else that is also going to help us address the same concern of risks in the business. We can also do that by looking at what we call the interest cover. So interest cover, we can call it a ratio. Interest cover ratio, because it is always given the number of times. Now, the other method that we can use to measure what we call operational gearing, if you don't use the other formula of getting the contribution divided by the profit before interest and tax, we can use the interest cover ratio. And this interest cover ratio is going to be the profit before interest and tax divided by the interest expense. So this is what we use to measure what we call the operational gearing, and we use what we call the formula is gotten by you getting the profit before interest and tax divided by the interest expense or the interest charge, stock expense. So the interest expense will be given to you. So the interest, of course, this is always in number of times. In other words, here I want to see how much the operating profit. Of course, this is the operating profit. How much of this operating profit you are going to generate? If we see that we have generated such and such amounts, the next question we ask ourselves, is this operating profit, is it enough to cover the interest expense? And if it is enough, in how many times? Like the interest expense can be 2 million. But we have made maybe the profit before interest and tax of, let's say, 20 million. So if you divide the 20 million divided by the 2 million, you'll find yourself having 10 times. In other words, if you are to pay the debt holders, the profit you have earned can pay them 10 times the interest you are going to be paying to them. In other words, it checks whether you are capable of paying your debt people, the people who have given you the money that you are using in the operation of the business. So what is the bare minimum? Of course, these are we learned this in financial ratios. We looked at them under ratio analysis, and we said that, of course, if you are doing well, if you are doing so well in the business, we expect that the interest cover should be higher than 3 times. If you are doing well, we expect that at least you can get more. In other words, we expect if the interest expense was 2 million, we expect you to have at least the profit of more than 6 million. So it is going to be 3 times the profit, the interest expense. That is going to be 6 million. So we expect you to earn more than, at least, for you to have 6 million and above. If you are using the money, where that money you are using in the business, you are paying 2 million as interest, you should at least earn 6 million and above for you to say that you are doing well. So if you find yourself the number of times your interest cover is, in other words, the interest cover in a nutshell, it is just looking at how many times can you be able to cover your interest expense using the profit that you have earned. And this profit you have earned must be before paying off the interest. That's why we are using the profit before interest and tax, because that is the operating profit. And that operating profit is gotten from getting the gross profit minus the operational expenses, only operational. So these are the other way you can look at it. If you put it in a percentage, because it may be given to you in a percentage and you say, Charles told us it is going to be in times, they can give it to you in percentage. So if they give it to you in percentage, then it should be more than 100% if it is a percentage wise. But just note, it doesn't have a unit. It's supposed to be in times. If they put in a percentage, it is okay, but it's a ratio. So if it is below 100%, then the company is not okay. Of course, if they give it in a percentage, sorry, it's supposed to indicate something, because if you are close to 100, no, actually, if it is in a percentage, then it's supposed to be lower, because the whole argument is that if the interest is 2 million and I have made a profit of 2 million, are you not seeing that it is going to be 100% net, which is actually 1 time? If I've made a profit of 4 million divided by the 2 million, if you multiply by 100, I want to be at around 50%. Reason being, I'm able to pay twice. So the lower, the better. Because if it is lower, the implication is that the other number of times are many. So let's look at the debt ratio or debt to equity ratio. Most of the times we don't talk about the debt to equity ratio because we know that debt to equity ratio or the debt ratio is actually covered on level 2. That's why we ignore it, but I want to talk about it because it's one of the method that we can use, but most of the times we don't talk about it. The debt ratio, or what you call the debt to equity ratio. So this is one of the things that we don't talk about, as I said, because we know that you covered it on level 2. And I told you that things you covered on level 2 doesn't mean that they will not appear here. They may appear, some of them. So we cover this under financial ratio analysis. But these are some of the ratios. These are some of the ratios that we use when we are talking about financial and then the operational gearing, or what we call the financial or operational leverage. But the examiner will not ask you to compute the ratio. Otherwise, he will be taking you directly to the ratio. And this is what they will examine you, where you will be asking you to assess the impact of the new investment. So I want you to learn this, but I don't want you to understand that they are going to ask you to compute the ratio. What they will ask you for this, if it has been brought, it will be taking you to what you call the new investment. And they want you to assess the impact when you're assessing the impact of either financial or operational gearing on the new investment. The issue is on the new investments, and that differentiates it from what we know, because this is something that is going to be coming on the new investment if you have made an extra investment. In other words, they will come when they have given you the ratios, but they tell you to assess the impact of those ratios on the new investment that you have made. So you find yourself, you're already geared as a business. You are already geared. Now, but they want you to do a new investment. Remember, this new investment, you are going to look for money. We don't know whether the money is within the business or you are going to look it from somewhere else, from the different sources that we looked at. So the result, as a result of you getting a new investment, we are getting something that is new. When you are setting up a business, we are getting different cash flows because we expect to increase our cash flows because it is going to be a new investment that is going to be coming in. So as the investment comes in, we expect even the sales to increase. But don't forget that you are already geared in the business. But as you add on an investment, you are expecting to generate more cash flows. And at the same time, you may be expected to look at for more sources. If you don't look at the more sources, maybe if the money is available, but we expect you to have an increment in the sales that you have been making. If you have been maybe producing soda and maybe you are now going into production of water, the new water production is going to be the new investment. And we expect to increase more sales as a result of the additional investment that we have made. So we want to look at the fact that we are already geared in the business. We have gearing ratio. The other ratios, we've been computing them, trying to know whether we are going to be geared, highly geared or not. But here we're already geared, but we are just adding in an investment, and you want to look at the impact of our gearing to the new investment that we have ventured into. So sales, we expect the sales to go up, the costs to also increase. Others may reduce based on whichever analysis that we have done that made us to reduce the costs. So the gearing is also going to go up, as I said, because we are going to be acquiring more funds. So the examiner might ask you for the impact of the new investment and he wants you to show methodically how to do a number that has some kind of those two things that I've talked about. So this is what we are going to look at in the next video. The next video is going to be looking at a new investment, and we are basically looking at the impact. We are already geared in the business, but the fact that we are already geared, the gearing is also going to widen because we are introducing in a new investment, and we may be prompted to look for more sources. So we are going to look at simulation number 2, that is going to be basically looking at the impact of the new investment. What will be the impact? What do you think that are going to come in? Or what will happen to the profit before interest and tax? What will happen to our contribution? Because as sales keeps on going up, even the costs, if costs remains constant, then we are okay with it, because we shall be getting more contribution. Because there are some investments that you can do that will not increase the costs. If let's say we've been producing the same products, but within those same products there are some costs that can remain constant, and we keep on incurring other costs. That's why I started by looking at something to do with fixed costs. So I want to look at the analysis. How can you be able to guide based on the impact that you have, given the fact that the company is highly geared, but you are introducing in a new investment. Before the investment, so want to look at before the investment. So the interest cover before the investment, we said it is going to be the profit before interest and tax. But this is before, so we are going to take that as 3.6 divided by what is the interest expense before. So we look at the old income statement, which gave us 800. So once we divide that, we'll be getting 4.5 times. So we now look at after the investment. After the investment, then we need to know what was the interest cover. So the interest cover, we take the profit before interest and tax for that adjusted income statement, which was 4.680. We divide by the interest. The interest expense was 1.5. We take the interest expense that was given to us, that we computed, and when you do that, it will give you 3.12 times. These are number of times. So you don't stop here, you need to comment. You make a comment. So comment, or what you call the recommendation or advice. What will you advise based on that? The advice. Now, based on the reduction, of course, based on what you have seen, the other one was 4.5 times, this one is 3.12 times. So based on the reduction in the interest cover from 4.5 times to 3.12 times, then you won't recommend. You should not recommend. You should not recommend the investment, because we said that for the interest cover, it must be seen increasing all the time. However, since it is above, because now you may be locked in a situation whereby in reality, because we said that it should at least be above 3 times, because you can't say the business doesn't operate or doesn't continue, but we look at the scenario that since it is above 3% or 3 times, then we can advise the business maybe to look at what are some of these items that they can reduce so that they can be able to increase this number of times. So some of the recommendation would be they should at least reduce this so that they can be able to increase the interest cover, so that it can be a little bit better based on the information, because here it's not too bad since it is almost above, it's above 3 times. So that's what we have from that. So we need now to compute the financial gearing. Financial gearing, this is our part C. Part C of the question wanted us to look at financial gearing, and they gave us the formula. They told us we should use prior charge capital over the total capital employed. So we need to look at before then after. Before the investment, the financial gearing, of course the prior charge capital here is 8,000 divided by, of course here we are going to take the 8,000 plus the 24,000. That is going to give you 25%. Of course this one multiply by 100 to make it a percentage. Then we also look at after the investment. After the investment, the financial gearing equals to the 8,000. Of course we have to add the 10,000. That was the new capital that was introduced. Divide by the 8,000 plus the 10,000 plus, of course, the retained earning, the other figure that we got of 2413. That is the figure that we computed from our adjusted balance sheet. It is 24,133, and this will give you 42.7%. So what will be the advice or comment? Advice or comment? So based on the financial gearing, you won't recommend. We shouldn't recommend. Why? Because we are seeing it is a little bit increasing. It was 25%, but now it went to 42.7%, which has caused an increase. So since it is increasing, it means these people, they are actually geared, or they are becoming more geared. So we shouldn't recommend. But however, remember we said for financial gearing, at least it should be exceeding 100%. So since it is below the 100%, then we can say they should find a way of how they can maybe they can decide not to pay dividends so that they can be using that money for these other investments so that they can lower this gearing, financial gearing. So since it is below, as the CFO, of course, as the CFO, you may not overcommit. Like, you may not overcommit yourself, but you need to be a little bit objective enough, because gearing will always remain in your capital structure. But the problem is when it is highly geared, because we said that it is only going to be highly geared if at all it has exceeded 100%. But if it is below 100%, of course you can't commit yourself that let's get more and maybe we'll be at 99% just because we are below. So you may not commit yourself to that, but since it is below, there is no way you are going to say, I'm not going to have debt in my capital structure, if at all you are struggling to raise your own capital. So what is very bad is to be a little bit geared, to be highly geared. So we said that since it is not above 100, there are two ways. You can say we are not recommending because we have seen an increase, because we expect the debt at least to be lowering down. But you should also look at a point that since it is not above 100%, we can also say that since it is not above 100%, then the investment would continue, even though there has been an increase from 25%. Of course, you recognize that there has been an increase, but since it has not exceeded the 100%, you can say they should go on with the investment, but they should look at ways of how they can mitigate that in the future. Because the worst case scenario is going to be when it has exceeded 100%. So that's basically what they wanted us to do. So I want someone to find ways, because we looked at some of these reasons. What could be the circumstances under which debt finance would be more appropriate? In other words, why would we take more debt than equity? Because at some point, these are the points we looked at, the importance of debt over equity. Because these are the same that are giving us scenarios. Remember, the question approach is going to be a little bit different, but the answers are the same. So if at all we say that the interest on debt is tax deductible, it's a point, it's a circumstance that forces someone to actually prefer debt than equity, because we know that dividends are not supposed to be deducted. They're just an appropriation of the profit that we have made in the business. The things to do with the dilution of control, people are going to come in when you have equity. But here, there is no dilution of control. Management still has its own ways of how to manage the business. So I want us to look at the trial numbers. What are some of the trial numbers that we can have on this kind of arrangement? What are these trial numbers that we can basically look at? The reference numbers that we can go by, maybe looking at November 2019, question 5, part B. We can also look at August 2018, question 2. We can also look at November 2019, question 3. So you see, these numbers are really examinable. So if you'll be able to do these numbers, you'll be able to actually understand some of these aspects. So without wasting more time, let's look at something else. We want to focus on things to do with the element. We try to analyze the elements of cost of capital. elements of cost of capital, and that's what we are going to look at. So right now, I want you to be able to try out those numbers and also let us know in the comment section what you think of the video that we have done, or so far what you have understood or what you have not understood, any complaint, suggestion of any sort of something that you can add on what you have learned through this tutorial. Elements of cost of capital. The elements of cost of capital are only two. We usually say that cost of capital is made up of two elements, and these two elements include what we call the risk-free rate, which we abbreviate as RF. And in most cases, this risk-free rate is represented by the treasury bill rate. Is the treasury bill rate, or what we call the central bank rate, or the CBR rate, the central bank rate. So when you hear the government of Uganda, or of course the central bank, that's the Bank of Uganda, and you hear that the Bank of Uganda has issued the CBR rate, or the central bank rate, because this CBR rate is the rate at which these commercial banks are going to borrow at. Is the rate at which the commercial banks must be lent at, or the rate at which they must borrow at from the central bank, is the borrowing rate for commercial banks from the Bank of Uganda. So it is always, in the most cases, the treasury bill rate, which is the one that we call the risk-free rate. In other words, an investor, it's the rate an investor would get without any issue to do with risks. That's the rate an investor is willing to get without any risk. So it's like the nominal rate you are supposed to get without any risk. However, when it comes to cost of capital, if you go to the commercial bank, you find that how the guys in the commercial bank, how they arrive on their cost of capital, how these commercial banks are going to arrive on their cost of capital, or what we call the borrowing rate. They pick what we call the risk-free rate, and then they add, of course, they add what we call the risk premium, if any, because they may not be there, if any. Now, that's how the commercial banks will arrive to their cost of capital. They get the risk-free rate, that is the rate at which they borrowed at, plus the risk premium, if at all it is there. Therefore, that's why we are saying that cost of capital, we have what we call the risk premium, and a risk premium is a return to compensate for the financing risks, or the gearing risk that we've been talking about. The risk associated by giving out the money. So the risk premium is the return to compensate for the financial risks of having debt in your capital structure. Once you have debt, then we are going to face a challenge of whereby the risks are going to be high, because if we don't pay the debt, the lenders can actually take up our company. If we don't pay them, the interest is going to be accruing and we'll be getting interest or arrears and some other penalties. So what is going to happen is that you will earn what you call a risk premium for as long as you use debt in your capital structure. So that's the amount, that the return you are going to earn for the risk that you have taken to include debt in your capital structure. So once you have debt in your capital structure, then you qualify for what we call financial risks. But at the same time, the risk premium compensates for what we call business risks. So the risk premium compensates for what we call financial risks, and at the same time it compensates for what we call the business risks. So once you have debt in your capital structure, then you automatically qualify for what we call the risk premium, because it is what is going to compensate for the financial risks of you having debt in your capital structure. But we are also saying that that same return is going to cater for the business risks. We've known that financial risks only comes as the moment you include business, as you include debt in your capital structure, or you use debt in financing the operations of the business. But at the same time, we are saying that the risk premium compensates for what we call the business risks. Therefore, that makes the cost of capital, the whole cost of capital, or the overall cost of capital, of the business to actually have the two elements. So that makes the overall to be a combination of both the risk-free rate and what we call the risk premium. As I said, it will be hard for a business to actually go and borrow from the Bank of Uganda. It is impossible. It will be only the commercial banks that are going to borrow from the Bank of Uganda. So what that means is that the business itself will not utilize what we call the risk-free rate alone, meaning it will be only the commercial banks. But since commercial banks use money to trade as their inventory, what they are going to do, they are going to make sure that they get what we call risk premium. They are risking their money to give it out in debt. So you will find that what is going to be charged from your company as you borrow money from the bank is different from what these banks are actually getting the money from the central bank. That's how it operates. So the reason as why they are including the risk premium is to cater for both financial risks and then the business risks. Now, these are going to help the business as a business. Once you include debt in your capital structure, you have brought a problem, because you are supposed to be paying interest on the money they have given to you. Why is it a problem? Because it is a problem. Once you don't pay, the amount will keep on accumulating and you'll be paying arrears and penalties on arrears and the normal payment if at all you don't pay on time. It's not the case with the equity shares, because for equity shares, even if you don't pay, it's the management to tell that we have made maybe such and such amount, then let's declare that we are going to be paying into dividends to our shareholders, which is not the case here. When commercial banks are giving out debt brings in to itself, it brings risk of you not paying them. That's a finance risk. They are risking their money to you. And also once you include it in your capital structure, it brings what we call financial risks, because you are at stake of losing the money if at all you don't pay on time. But at the same time, we are including the fact that we are also compensating for what we call business risks. And the only compensation that does the two is what we call the risky premium. So the conclusion is that for the cost of capital, for the overall cost of capital, is going to we are going to be having what we call the risk-free rate plus the risky premium. But if you look at the capital structure, specifically the long-term financial instruments, in most cases, these are made up of ordinary shares, and then of course the ordinary share from the equity perspective, then the debt finance. So this is what you are going to understand. This risk-free rate and the risk premium, they are only on the debt aspect. But in a capital structure, we have a combination of different financial sources. We can highlight some of them. You'll find that in your capital structure, you have what we call common stock, or what we refer to as ordinary shares. 2, you have what we call preference shares. You may have what we call debentures or bonds. And at the same time, you can be having what we call term loans. And sometimes we may be having something to do with retained earnings. So you find your capital structure has all these items. They are the ones that you are using to make the investment. Therefore, these are the long-term financial assets that we believe are making up the capital structure in terms of the long-term financial services. Now, we are looking at the capital structure. Sorry, we are looking at the cost of capital. And it's important we look at the cost of each of these long-term sources of finance that we use. So we want to look at what is the cost of using what we call, of course, this one we always compute it as cost of equity. We want to look at what is the cost of each source, what is the cost of equity, what is the cost of debt in their composition. What is the cost of term loan, what is the cost of debenture, what is the cost of a bond that you have used in your capital structure. So once we combine all the costs for the different financial sources or financial instruments, then we can have what we call the overall cost of capital. So the cost of capital does not necessarily include one single source. So we need to know how to be able to get the cost of using each item. What is the cost of using ordinary shares in our company? What is the cost of using debentures, the bonds, preference shares in our company? Because at the end of the day, if in my capital structure, I have a mixture of equity and debt, as you are seeing here, then it will call for me to know what is the cost of each of those items. Because remember, when you're borrowing this money, you are going to be assigned different rates. Even banks charge different rates based on which type of loan that you are taking. Even if it is a salary loan, you can find a salary loan in Standard Chartered has a different interest rate as compared to that same salary loan in, let's say, Stanbic, Post Bank, Housing Finance, and all that. Why? Because they are looking at the different risks. Everyone is incorporating in the different risks, but they are also looking at how they can competitively compete for the same customers. Now, once we put all these costs of each individual source together, it forms what we call the weighted average cost of capital, or WACC. And this WACC is what we call the cost of capital, the overall cost of capital for the entire organization. Now, for me to compute what you call the WACC, or the weighted average cost of capital, you need to first know the specific cost of each source of finance, or each element. When we talk about the elements of cost of capital, we are actually looking at the specific cost of each of those financial instruments that we have used in financing the operations of the business. So, for you to be able to compute your WACC, we need to first know the specific cost of each element. And that's where we shall need to know how do we compute the specific cost of common stock, the specific cost of debenture, and the examiner will not examine you on this. But the question we do, they originate from here. So if you don't know what we are talking about, how to compute the specific cost of each of these items that we are using in our capital structure. Remember, we said the capital structure is just a mixture of different sources, a mixture of funds that are being used in an organization. So we need to know the specific cost of each of these items. If at all you don't understand, because we are basically using the knowledge that we learned from our level 2 financial management. If you don't actually know what we are talking about as per this level, then it's going to be a little bit hard if at all we go to Kapam. It will be a little bit, you will struggle. But we are going to make sure that at least we analyze things to the point that everyone can be able to understand. So just stay connected. So we want to start with cost of equity. So the cost of equity is something that we are going to look at, the cost of equity, to be able to understand how best we can be able to compute the specific cost of equity. So cost of equity, KE, cost of equity. Let's look at the cost of equity. So when we are talking about cost of equity here, specifically I'm referring to what we call common stock. I'm referring to common stock, or what we basically call ordinary shares, and then the retained earnings. So once I'm talking about cost of equity, I'm referring to ordinary shares and then the retained earnings. So, of course, you know the equity component is composed of the retained earnings and then the ordinary shares, or what we call the common stock. So when we are trying to get the specific cost of capital, it is either whether we are computing the cost of equity, whether we are computing the cost of common stock or cost of retained earnings, we call it equity. All of it is combined. So if I'm prompted to compute the cost of common stock, the answer I will be getting for common stock will be the same answer that will be for retained earnings. So the answer that we are going to get as the common stock, it will be the same answer for stock, common stock, and then the retained earnings. And that's because of all of that is equity. So how do we compute cost of equity? How do we compute the cost of equity? So when you are computing the cost of equity, we use some formulas. We can compute using what we call Gordon model, or what we mainly call the dividend valuation model. This is the dividend valuation model. It's also abbreviated as DVM. The dividend valuation model. They are the same. They mean the same thing. There is also what we call the capital asset pricing model. Capital asset pricing model, what we mainly call CAPM. That's what we abbreviate as CAPM. And lastly, depending on the data available, we have what we call the M&M model. That is Modiglian and Miller. Modiglian and Miller. That's what we refer to M&M model. So there are only these three methods that we can use. What we basically focused on as far as your financial management was concerned on level 2, we looked at what we call the Gordon model. That's what is permitted on level 2. But here we go ahead and do the CAPM and then the Modiglian and Miller, or the M&M model. Therefore, these are the only methods in your paper here for advanced financial management that we shall use to compute the specific cost of ordinary share, or cost of equity. But for today, we are going to be focusing, of course, we are going to look at each of them in detail and we do some analysis. But for today, we are going to focus on what we call the Gordon model. This is just like a revision because we have been doing Gordon model from level 2. So at least we know what we are supposed to do. So we do Gordon model, or what we call the dividend valuation model, so that we can be able to link up to what we studied before we can go to these other new methods of computing the cost of equity. So once we know Gordon model, then we can add these other, the M&M, and then finally we look at the CAPM. But you should know that if your capital structure, or if in your capital structure you have equity, then the cost of using equity sources will be computed using any of these three methods. And probably most of the times they will examine you on only one method. One method can be used at a time. So they may give you a question when they're asking any of the three methods, but one will be asked, any of the three will be asked for you to be able to compute this. So we should now get to know which kind of data that we are having and which method can we use based on the data that we have. If the information you are seeing is calling you to use Gordon model, you go by Gordon model. If it is calling you to use CAPM, you go by CAPM, or M&M, Modiglian and Miller, you use that based on the information that is available. Because sometimes they may not tell you which method to use, but based on the information that is available, you can basically tell that in such and such a scenario, I'm going to use Gordon model, CAPM, or M&M model. So let's start by looking at the Gordon model. Gordon model, or what we call the dividend valuation model. So I want us to first know the formulas. We know that KE, that is the cost of equity, equals D naught into 1 plus G over MPS. This is market price, and this is always XDiv. It's always XDiv plus G, which is also equal to D1 over MPS, but we say this is should always be XDiv plus G, where we know that the D naught is actually the current dividend, D1 is the future dividend, then G is our annual growth rate. This is growth rate. Then of course this MPS we notice the market price per share. So the cost of equity equals D naught into 1 plus G over MPS XDiv plus G, or equaling to D1 over MPS XDiv plus G. So we know that the D1 is our future dividend, and then the D naught is actually our current dividend. Now, I want to explain something that we didn't actually get on our level 2. So when we say that KE equal to D naught over MPS, this is XDiv plus G. We said this is our future dividend, annual growth rate, then market price per share. Now, the D1, as it says, future dividends, but we have trouble. The trouble that we have is now on computing the future dividend. That D1 gives us a trouble, because sometimes we can't be able to determine the future dividend if it has not been given to us. Therefore, what we do, we compute the future dividend by growing it. And the only way we can grow it is by using this same formula, D naught, because this is the current dividend, then we grow it by 1 plus G, that is the growth rate, over MPS plus G. Because this item that you are seeing we are adding it up here is just this D naught into 1 plus G. Is just to help us to get the D1. Because this will mean that the current dividend, then we grow it so that we can be able to get the future dividend. That's why we always have these two methods. But one of them is just helping us to understand or to be able to grow the current dividend that they have given us into the future dividend that we don't have. But of course, in level 2, we couldn't explain further. We could just try to understand that that's how it is. But I hope now you are getting the real, because the other side we could just simply tell you the formula minus explaining why there are two formulas that are actually appearing. So this is the formula that we use. So here I wanted us to understand that using that formula can help you to get what we call the future dividend, which is always a problem. So when we use this formula, it is helping us actually to be able to get the future dividends, because it helps us to inflate the current dividend into the future by using the growth rate, the annual growth rate in the dividends. I hope you are getting what we are talking about, because we are just projecting the current dividend. So we are using the current dividend to project it to throughout the given period of time. And that's the information that we are using to be able to compute the future dividend. So the current dividend, then you go with the information given and then select the method that you are going to apply. If at all they have given you the future dividend, then you should just choose this formula. But if you don't have the future dividend, then you can, and you have been given the current dividend, of course you go by that. But the problem, all the trick, is this item down here, the market price. Let me also explain something. We say that the market price per share, that's what we call the MPS, should always be exceeding. So it should always be exceeding. What it means, it should be exclusive dividend. The dividend shouldn't be there. Whether the examiner has told you or they have not told you, just know that the market price per share is always exceeding or exclusive dividend. And in paper 10, we are a little bit silent. But at least now you should understand that it is a standard. If examiner gives you, let's say, the examiner gives you MPS, CAMDIV, then you should maneuver around to be able to get the XDIV. And of course, we know that market price CAMDIV is always equal to market price XDIV, then plus the D naught, that is the initial div or the current dividend. So you need to be careful, because the examiner might give you MPS, market price per share, CAMDIV. And CAMDIV means it is inclusive dividend. So it means the market price is inclusive, or it is reflecting in the current dividend. So once it is CAMDIV, meaning it is reflecting in the current dividend that is going to be paid, then we have to make sure that we convert it and we get the XDIV. We remove that current dividend that is going to be paid. But we know that when you are using Gordon model, we always use market price XDIV. So once we are going to be using market price XDIV, what will be the formula? The market price XDIV will actually be, of course, you just take this side, this one, the other side. When it crosses the equal sign, when it crosses the equal sign, of course, this sign has to change. So it is going to be market price CAMDIV minus the D naught. So once you have been given CAMDIV, make sure you remove that component to do with the dividend that has been declared. So let's look at a simulation, just a short one to help us get. So a company is expecting or is expected to pay a constant dividend of UJX, Ugandan shillings, 400 per share. Full stop. The current XDIV market price. The current XDIV market price is UJX 3,000. Then the required. What they are saying, part A, they are telling you what is the cost of equity. Part B, they are asking what is the cost of equity. What is the cost of equity if the unexpected growth in dividend is 10% per annum? The unexpected growth in dividend is 10% per annum. Sometimes they may not add that word per annum. You just notice always per annum, because if you are told, you have not been told. It is always per annum. Maybe if you are told otherwise. So part A, we said KE equal to D naught into 1 plus G over MPS, and we say this is always exceedive, which is equaling to D1 over MPS exceedive plus G. So now we look at the information that they have given us to see, are we going to use which formula are we going to be using? So they have given us that they are saying that the company is expected to pay a constant dividend. So this is just a current dividend. This is a D naught. A D naught which is 400 shillings. Then the MPS, of course, they have told us MPS, and they have given us exceedive of 3,000. They have not given us the growth rate in part A. Growth rate is 0, so we just put in this formula. So it is just going to be 400 over the 3,000 times 100, and that will give you around 13.3, that is 13%. So once you have known that the dividend they have given you is a current dividend, then you don't take this method. You just go by this formula. So we do the same thing for part B. Still, they have given us the D naught of 400, but this time around they have given us the growth rate of 10% per annum. And the MPS is still the same, of 3,000. So when we substitute into our formula, the formula is KE equal to D naught into 1 plus G over MPS. This is exceedive plus G. So we substitute into the formula, and we get our KE as 400 into 1 plus 10%, that is 0.1, over the MPS of 3,000. But at the end of the day, we are supposed to add all this plus 0.1, or the 10%, and this will give you 24.6. That will be, if you round off, that is 25%. So you can have very many numbers as you want, but that's basically what we can do. Now, that's by using the Gordon model. Before we conclude the Gordon model, I want us to look at a situation where you can be told that the growth rate in dividend, you may find that they have not given you a growth rate in dividend, just like the way they have not given us to us. They have not given to us the growth, the G in dividend, the growth in dividend. But they have given you additional information that can facilitate you to be able to compute the growth in dividend. So how do you go about it? So want to look at a situation where we are going to estimate the growth in dividend and be able to incorporate the Gordon model. Want to estimating the growth in dividend. Now, this is a little bit tricky. It's a tricky part of all the things that we do as far as Gordon model is concerned. The examiner might not give you the growth rate, but he has given you additional information. So he may not give you the growth rate, but he gives you some additional information that you can use to be able to compute the growth rate or the growth in dividend. And sometimes what they do, the examiner can, for example, give you the years and their corresponding dividends paid, where these dividends will be increasing, and in this case you cannot conclude that there is no growth rate since the dividends are not constant, because they may give you these dividends, but the dividends are constant. Every year their pay may be same amount. Or they may give you the dividends, but these dividends are keep on increasing, meaning there has been some kind of increment. So what do we do if at all we have such kind of scenario? So if we have such kind of scenario, we have two methods that we use, and we are going to look at both of them to be able to conclusively have everything in what we want to cover. So if the dividends are not constant in nature, then you are expected to compute the growth in dividends. We also discussed this in paper 10, but we are trying to repeat it so that we can be able to be on the same page, because it will be very sad for you to actually fail things that you already know. So the two methods we have, there are two methods that we can use to compute the growth when the dividends are not constant. One, we can use the formula G equal to, we have the latest dividend over the earliest dividend. So all of this minus 1. So in here we have n minus 1, where n is actually the number of years. So let's have a small simulation that will help us to have a table that will help us to understand. Let's look at a simulation. So we can have this, can say the dividends of KC group over the last 5 years are given below. So we can have the years, then we have the dividends. Year 1, it's 180. This is 210. This is 220. This is 24500. And then the last one is 280,000. This is 5th year, 4th year, 3rd year, 2nd year. So that's the information that we have, and they are telling us that KC group is current ex-div market price is UJX 4,000, and it has in issue 1 million ordinary shares. Full stop. We have the required. They are telling us to calculate the company's cost of equity. So we need to get the company's cost of equity. Solution. Let's now look at the number of years, n. Our n, they have given us 5 years. And what is n minus 1? Because we saw it supposed to be in the formula. So this is going to give us 4. This will be 4 years. Now we need also to know what is the latest dividend. The latest dividend is 280. Then the earliest dividend is 180. So we substitute in our formula. We've said that G, the latest, which is 28, divided by 180. Of course, all of this is supposed to be under square root minus 1. But this one has n minus 1, which is the 4. So the fourth root of these two items. So this, you will see that this is going to give you 0.12, of course, times 100. And that is going to give you 12% as the growth rate. That is the growth rate. That's how we compute the growth rate. The whole idea is actually for us to be able to compute the growth rate, because the rest, substituting in the other method, is going to be very easy for us. So that is the first method. Then the second method, of course, the second method is what we call the Gordon's growth model. Gordon's growth. The other one is Gordon model, but this is Gordon growth model, or what we call the Gordon's approximation, growth approximation. Gordon's growth approximation. So it is the same person who introduced in this. So is saying G equal to R times B, where R is our return on capital, or what we call the cost of capital, the return on invested capital, or return on capital. This is the cost of capital, or RRR, the required rate of return. Then B is now the retention rate. Retention rate. Now the retention rate is actually, it means the remaining, or what we have retained, the remaining rate after deducting taxes, after deducting the rate of dividend, after deducting the rate of dividend. If let's say, for example, if we have paid maybe, we are saying that maybe we can pay 40% of our profit after tax, then what has been retained is the 60%. So it will be 100 minus the 40%, which will give you the 60%. That is the retained that we are talking about. So you get the retained profit after tax, then you multiply by the required rate of return. That will give you the growth in dividend. So for this formula, the examiner will be talking about the retention rate. For example, if let's say, if you are the CEO of the business, as I said, you decide that maybe you are going to pay dividend of, let's say, 50%, 60%, and you are going to pay dividend of, let's say, 60%. So the retention will actually be the remaining part that you have not declared as dividend. So it will be the 100 minus the 60 you have declared. So the balance is going to be the 40%, which is the retained amount. So what you have to understand is that in this question, he will tell you what the rate of return is, the rate of capital or the cost of capital for the monies that you have reinvested in the business. It's the one that we call the required rate of return or the cost of capital, whichever name they call it. However, these numbers are not set as a standalone numbers. I don't want you to assume that a number is going to be set as a standalone. No. But they will bring one question that requires you to compute the cost of capital, the cost of equity. They want you to compute the cost of capital because in some of the capital structure, they have given you equity. But when you look at the equity components, the information they gave it for you to compute the specific cost of equity is actually lacking the growth in dividend. That's why you look for the information that has been given. You choose any of these two information or these two methods that you can use. So don't get confused. This is just a small issue within the cost of capital. So we are done now with the Gordon model. But you have to watch out this aspect. One, we said you have to watch out to see whether they have given you the growth rate. Two, you have to find out, have they given you a current dividend or a future dividend? If you can have this with you, then you will be able to do any number that will require you to use Gordon model for computing what we call the cost of equity. So we are done with the cost of equity. And what I want us to do is to go ahead and look at what we call the cost of term loans. This is something that is very, very easy. The cost of term loan. These are specific cost of each item that is used in the capital structure. So the cost of term loans goes by the argument. In other words, the argument is that you look at what you have agreed with. You look at your agreement, loan agreement. We don't compute anything to do with the cost of term loan. You look at what you agreed first. After understanding what you have agreed, then you will find that the examiner is going to tell you, in an exam, they can tell you that we have a 9% term loan and they are giving you the amount of, let's say, 200 million. So what is going to happen? This is the cost of that term loan. It is fixed. So this 9% means is the one that we are going to use as the cost of term loan. However, in the exams, we don't take this 9%. Most of the times, we don't take it as it is because we have to do what we call an adjustment of taxes. We adjust the tax. So the cost of debt, let me call it term loan because it's also debt. It is always that rate, the fixed rate that they have given you, we call it KD, into 1 minus the tax rate. If they have given, let's say the tax rate is 30%, you make sure that you put it you put, this is 9%, which is 0.09, into 1 minus 30%, which is 0.3. So that means it is going to be 0.09 times 0.7. And this will give you a percentage of 6.3%, which is roughly 6% if you round off. So we take the 30%, but the examiner has a right to tell you which tax rate, even if they say 50%, even if they say 100%, just go with what the examiner has told you. Because I'm taking 30% because as per the Uganda, we know that the income tax is 30% for the business. So corporations, we know that they charge them 30%. However, as per the paper, the examiner has to tell you. So you have to be mindful about the tax. If the tax has not been told, don't assume, but you have to understand that tax is a big issue as far as advanced financial management is concerned, especially when you're looking at the cost of debt. The reason as why we didn't include tax in our cost of equity is because dividends, they are not tax deductible. But we all know that cost of debt, the cost of debt is of course you are paying interest. Like for instance, this one is 9%. But remember we said there are things to do with tax, because we said interest on debt is tax deductible. That's why we first expense the tax and we take the 6% than the 9%. We get it from the other argument that interest on debt is tax deductible. Even if in the question they tell you it is a short-term debt, we must adjust for tax, since you are going to pay interest, unless it is a zero coupon. You know, there is when they can tell you someone has given you maybe 200 billion or 200 million or 500 million, but is not going to charge you any interest. So if it is a zero coupon loan, then we are not supposed to be paying interest, because we are not going to be taxed. Even we will not have that saving in tax. We shall look at some of the computations and we see how we do when it comes to investment decision, and we see how we have issues to do with the tax saving. That's when I'll explain more on the implication, what is the implication of interest and then the tax. So that's when we shall talk about more. But what you need to know is that whenever you borrow, because the taxman always gives you a tax saving, which implies that any debt a company has, we have to take off the tax rate. Even when you check the general formula of work, well, I know we have that formula, that big formula, and here we are going to actually use it more often. That work formula, we are going to use it, but I'll bring in that formula a little bit later as we have understood how to compute the specific cost of each debt. So we have done issues to do with the sorting the specific cost of equity. We have done issues to do with sorting the specific cost of term loans. And now we are left with preference shares, bonds, or debentures. And we shall also have things to do like convertible debt, convertible debenture, whichever aspect they call it, before we go on to compute the overall cost of capital for the company. That is the work. Cost of preference shares. So the same way we do cost of preference shares is the same way we do So how we compute the cost of preference share is the same way we compute the cost of bond, and at the same time is the same way we compute the cost of debentures. So it's the same way we compute the preference shares, is the same way we compute cost of preferential shares. Now, if you discover in your capital structure that you have all these, you have bonds, you have debentures, and at the same time you have what we call preference shares, then the same way we compute one of them is the same way we compute all of them. So we want to basically look at how do we compute the specific cost of preference shares. Can call it KP, cost of preference shares. So we've said that we need to know how to compute the cost of debt, the cost of preference shares, the cost of bond, and then the cost of the debentures. And all of these are debt instruments. And that's why we determine them in the same way. But not forgetting the fact that these are tradable instruments. The only reason as to why we didn't include in the cost of debt, the cost of term loans, is because term loans are non-tradable instruments. They are as per what? They are as per their quotation. How they are quoted in the agreement is the same way we go by them. So let's now look at how do we be able to incorporate in these tradable debt finance instruments or assets, if at all we are looking at the general formula of our work, or the weighted average cost of capital. So the cost of debt finance, whether they are many, there must be adjusted for tax. You must adjust for tax. And secondly, we said that the way we compute the cost of each of these items is the same way we compute the cost of using these other items. So when we compute one, just know we have known how to compute all of them: bonds, debentures, and preference shares. Now, this is what is going to happen. When we are looking at cost of debt, the cost of preference shares, we ask ourselves these two questions: is it irredeemable, or it's redeemable? We ask ourselves these two questions: is it redeemable or irredeemable? So before you compute the cost of preference shares, cost of debt, cost of debenture, you need to first ask yourself whether that trade instrument is redeemable or irredeemable. Now, the easiest is when the cost of the preference share is redeemable, because if it is irredeemable, then the cost of the cost of preference would be the cash flow. In this time round, since we are dealing with the preference, it is going to be the cash flow over divided by the MPS, the market price of preference. If it is a bond, of course, you know the cash flow we expect for preferential holders is dividend. But these others, like for the bond, debenture, we expect interest. For the shares, we are paid dividends. So the cash flow here is dividend. But when it comes to bonds and debentures, there we expect to be paid interest. So you need to be careful on that. So what we have here is annual interest or annual dividend, depending on what you are dealing with. Now, if you find it is irredeemable, then you just get the cash flow over the market price of that instrument you are dealing with, and that will give you the specific cost of that instrument. But however, if you find that it is redeemable, if you find that it is redeemable, then it has issues. If you find it is a bond, preference share, and you find it is irredeemable, then it will be your IRR. We shall be computing what we call IRR. But now let me elaborate a bit. If at all it is irredeemable. So when it is irredeemable, we said we take the cash flow. So the cost of preference will be the cash flow. But remember, we said that we are supposed to adjust for a tax. It is a must. For paper 16, we are supposed to adjust for tax. So when you pay the cash flow, or when you are paid the dividend, or when you pay the dividend on the preference shares, you are supposed to have what we call a tax saving or a tax relief. So the cash flow must be adjusted for tax. So here we are going to adjust for tax 1 minus the tax rate over the market price. But this is also supposed to be ex-div. If it is interest, it's supposed to be ex-int. Market price of preference, ex-div. But now, if at all it is a bond, not a bond or a debenture, what happens? And it's a bond, and at the same time it is irredeemable. What are we going to do? Then just know what you are going to be receiving, or what you are going to pay as a company is interest. It's not dividend. You are going to pay interest to the bondholder. So we need to adjust that interest that you are going to receive for tax. Then we divide by the market price of that bond. So if it is let me just call it KB to mean cost of bond, specific cost of bond, it will be the interest adjusted for tax 1 minus the tax rate divided by the market price of the bond. But still, this one is supposed to be ex-int. Sometimes they may give you a cum-int, meaning inclusive interest. But here is supposed to be exclusive interest that has been declared or that has been paid. So you need to note that irredeemable debt is more of equity. So irredeemable debt, we know that something to be irredeemable, it means you will not be able to redeem. You will not be paid back. It doesn't have a maturity period. So the implication is that that money is you are going to take it there, and it will be there forever. As long as the company is existing, it will be there. But they will never pay it back. What they will only be doing, they will be paying interest or dividend, if at all it's a preference share. So I hope this highlights that. Now, let's now look at if at all it is redeemable. If the bond or a debenture is redeemable. If that bond or debenture is redeemable. So we look at cost of preference share. if at all it is redeemable. So the formula that we use here, if at all you find it is redeemable, which means it is supposed to be paid back, it has a maturity period, then we also use it is supposed to be the IRR. But remember, when you are computing the IRR, there are things where you need the market price. Make sure that the market price you are taking is exclusive, X-int or X-div. So the market price is either supposed to be X-div or X-int. Now, if preference share are redeemable, then the cost of that preference share is IRR. However, I told you as per this paper that we are supposed to adjust for tax. So IRR, we deduct it, we adjust it for tax minus 1 minus the tax rate. That is the easiest formula. The other formula would be for you to adjust the cash flow that you are going to use to compute the IRR. But the other one will be a little bit tricky. We are looking at things of saving time. You just get the IRR, adjust the final figure for tax. So you adjust for tax. But as I said, there are two ways. You can adjust the final answer, which is the IRR for tax, or you adjust the cash flows. You first adjust the cash flows, then you continue. So even if it is a cost of a bond, it will be IRR as long as it is irredeemable, but it's supposed to be adjusted for tax because it's a debt instrument. So that's basically what we can do. But now I want us to look at the simpler one, which is, let's look at the simulation of computing the cost of irredeemable debenture or irredeemable bond or preference share, because we said the computations are the same. So simulation. So a company has in issue 5% irredeemable debentures currently quoted at UJEX 105.5 come interest. Actually, let me just complete it, but sometimes they may just not complete. Come interest per UJEX 1,000 full stop, assuming a corporation tax of 30%. Then they are continuing that calculate the cost of debt. So that's the simulation that we have. So let's now look at the solution. So we first know that they have given us a come interest of, maybe we can give the formula. The come int or come interest, we know it is X int plus the interest that they have paid. If it was a dividend, then it would be a dividend that has been paid or declared. But the other thing you ask yourself, is it redeemable or irredeemable? We have found out that this bond is irredeemable. And we said that if it is irredeemable, then the cost of that debenture is going to be the interest 1 minus tax rate over the market price. This is MPS, and this is supposed to be X int, the market price of that debenture. That's the formula. So let's now first compute the amount that we are going to be receiving as the interest. So the interest, they have told us it is 5%. Now, for us to be able to get the interest or the cash flow that we are going to be receiving, it's going to be the par value times the rate. The par value of this debenture, they have told us here, if you look at the question, they have told us a company has an issue of a 5%, that is our rate. This is what they called a coupon rate. It's actually a coupon rate times the par value. So irredeemable debenture currently quoted at this is the market price, come int per UJX 1,100. This is that is the par value of that debenture. So this is going to be, of course, this is the coupon interest. The coupon interest they told us is 5% times the par value, which is 100. We say that if they don't give you the par value of a bond or a debenture, we know that their bonds and debentures, they are internationally sold in 100 tranches. But here the amount was given to us, so it is going to give us 5 shillings. Now the next thing that we want to look at, the market price X int, because they gave us a come int. So market price X int is going to be market price come int minus the interest that was paid. So the amount that we have here, the come int is 105.5. What was the interest? The interest, they told us it is 5, because we have just computed the interest, which is 5. So when you do that, you'll find 100.5. This is our market price X int. Then we substitute in our formula. Remember, the formula of cost of a bond is actually the interest into 1 minus the tax rate. We are adjusting that for tax, then MPS X int. Market price of that bond, but it's supposed to be X int, exclusive. So what now we do, we just substitute into the formula, we get the answer. So our KD will be equaling to 5, that is the interest, into 1 minus the corporation tax. They told us 30%, so it is going to be 0.3 over the market price X int, which is 105. This one times 100 to make it a percentage. So the answer is going to be 3.5%. So this is the specific cost of that, specific cost of a bond, a debenture, 3.5, or you can round it off to make it 4%. But it's better you take it in that form. You always round off to 2 decimal places. So we are going to look at a simulation, and this one is focusing on redeemable debt. So we can write that a 5% bond is currently quoted at shillings 95.84 X int, full stop. It is redeemable. It's redeemable at the end of 3 years at shillings 100, full stop. They are continuing that taking corporation tax at 50% and ignoring the timing lag for tax savings. We shall understand what a timing lag is for tax savings. Calculate the cost of debt. So they want us to calculate the cost of debt when we are ignoring the time things to do with tax savings. So solution, let's first see what we have. We have the par value. The par value as 100. We have the coupon interest rate of 5%. So we need to first get what is the interest. So the interest is going to be, of course, we know the interest, we get the coupon rate times the par value for us to be able to compute that. So it will be 5% times the par value is 100, and this is giving us 5 shillings. So the other aspect is the fact that you can adjust this. Remember, we said it is redeemable, which means IRR, but this is supposed to be 1 minus tax. You're supposed to adjust it for tax. That is the cost of this instrument that we are looking at. But now we need to understand, when we are starting, we always invest at the market price. So that means, since we are investing at the market price, we need to first get the MPS. But this MPS should be X int. They gave us the value as 95.84 shillings. It is X int, so we have no problem with it. Now, they have also given us the redemption value, because we know we are redeeming. But now you need to understand there are issues when you are redeeming at redemption. At redemption, we have issues, because you can redeem at par, you can redeem at a discount, and finally you can redeem at a premium. The examiner will tell you how is going to redeem, or how you are going to redeem this debenture or bond. The other thing is that if the examiner doesn't tell you, if the examiner remains silent, then it is a standard. The standard way is we redeem at par. That is the standard. If the examiner wants you to redeem at discount or at premium, he must give you the redemption value, or he must give you the discount rate that you are going to use. I hope we are at par here. Now let's first have the formula for IRR. When you are computing IRR, it is always small a plus capital A over capital A minus capital B into B minus A. That is always the formula. Well, that's the formula that we are going to be using. It is small a plus the whole of that, where small a is actually the discount rate, that gives a positive NPV, and small b is that discount rate. It is a discount rate that gives a negative. It's that discount rate that gives a negative NPV. Of course, now you'll be able to know what capital A and capital B. Of course, if you go to capital A, that is the positive NPV. Capital B, that's the negative NPV. So we shall be going through some of these. But now, at the same time, allow me to introduce the formula that we are going to use to compute work, weighted average cost of capital. It is VE, because you also need to know when you are computing work, we use, this is the formula, VE, that is value of equity, over value of equity plus value of debt times KE, this is cost of equity, plus value of debt over value of debt plus value of equity. This one is times KD adjusted for tax 1 minus the tax rate. And here we always use the market rate, the market values. Here we always use the market values. That's the formula. So let's go back to what we want to do. I'm going to explain a little bit small as far as IRR is concerned, because we are going to look at it when we go to the investment decision. So when we are doing IRR, we start with the years. We put in a table. We arrange our figures in a table. We start with the years. We start with the years. We start with the years. We put the details. Then we show the cash flows. I'm going to use CF and S to mean cash flows. Then we shall have what we call the discount factor, DCF factor. Then we shall end with the PV, that is present value. So we put it in a table format. But now, what you need to know is the fact that we always invest at market price. So in year 0, we always do the investment in year 0. In year 0, we are investing. We are investing at market price. So here we are taking the MPS, but it's supposed to be X int. We invest at market price, and the figure that we are investing, the market value is 95.84. So the discount rate that we are going to use, since we are computing IRR, we can pick any rate. I'm going to use 4%. 4%. So this is going to be 1.00. We are investing, so it's supposed to be in bracket. So this is 95.84. It's a negative because we are investing. In year 1, what are we going to be earning? We are earning what we call interest. This is the cash flow that is going to be coming in the business. We are paying interest, or they are paying us interest. What is the interest? The interest, we computed it. We computed the interest as 5. So the present value at 4% in the first period is 0.962. In the second year, we are also receiving interest. And the same interest is the one that we are receiving, 5. So the discount factor is 0.925. In the third year, they have told us it is redeemable in the third year. In the third year, we are receiving two issues. We first receive the interest of 5 with a coupon rate with the discount factor of 0.889 in the third year. But still in the third year, we receive what we call the redemption value. This is the redemption value. And this redemption value are telling us we are redeeming at par, which is 100. It will also have the same, which is 0.889. So you multiply this and then you sum them up. So we multiply these values and then we get the present value. Of course, here we are just starting, but this column you can ignore this column. But I'm only putting it there because we are doing it for the first time. So this first one is going to be 88.9. Then we can multiply these other ones. So we are getting 5 times 0.925. It's giving us 4.63. This is 4.63. And of course, this one is 0.889. And this is giving us 4.4. 4.45. Then this other is 5 times 0.962, which is giving us 4.81. So when you add those, so this is the NPV minus the 95.84. It is giving us 1.073. It is a positive NPV. So we have scenarios. It is always a try and error method. But I don't want to go deeper into the computations, but we shall maybe look at it when we go to the other side. But the argument that I want you to get is the fact that since we have gotten this as a positive NPV, now we want to look at which rate are we going to use that is going to help us to get a negative NPV, because we need both the positive and then the negative NPV. So it's the one that we are looking at. So we can draw another table. It will have the years. It will have of course, the details. That one I can even skip, but let's put it since it is the first time, details, the cash flows. Then we are also bringing in the DCF. Then finally the present value. So we are also investing in year 0 at the market price, the same value. So here we are picking a rate. Which rate can we pick that is going to help us obtain a lower NPV? In other words, we get a negative NPV. So when you find that you have computed the first NPV and you have gotten a positive NPV, so what do we do to the rate? Because we need to adjust the rate to make sure that we get a lower value. So we are going to increase the rate. If we take, this is a try and error. If you get it wrong, then you keep on trying. So maybe we can take like 10%. This is 1 point. So this is 95.84. It's a negative since we are investing. So in year one, we are now receiving the interest of 5. Then this is going to be 0.091 because it is 10%. Then in year two, we are also receiving the same interest of 5, which is 0.826. So in year three, we are also receiving the same interest of 5, 0.751. Then in the third year, we are redeeming redemption of 100, which is the same 0.751. So we multiply the cash flow times, so this one is going to be 75.1. So 5 times 0.71. This is going to give you 3.755, or we can take 6. 5 times 0.826. This is giving you 4.13. So 5 times 0.909. This is giving us 4.56. So we want to make sure that we get 3.76 plus the 75.1. So you can see that this one has given us a negative NPV of 8.31. If we round off, 31. So once you have gotten those two NPVs, one is positive, one is negative. This one has given us a negative at 10%. So we take those rates and we substitute into our formula. So we have a 10% that gave us 8.31, a negative. We also have 4% that gave us 1.0. It gave us 1.073. 1.073. So these are the ones that we are substituting in our formula. We said IRR equal to A plus capital A over capital A minus capital B into B minus A. So we said capital A, that's our lower rate. Of course, this is 4%. We can just put them in two decimals. We say this is 0.04 plus 1.073 over 1.073 minus, this one is already minus 8.31 into 10% minus 4%. Of course, this one you are supposed to maintain. Since we put all of them in decimals, even this one we are supposed to maintain. So this one is going to be 0.1 minus the 0.04. And then you put in the calculator everything and you get the final answer. So this one will turn out to be a positive. This one, it will be a positive times 100. So when I multiply by 100, I'll be getting the percentage as 4.69%. That's roughly 5% if I round off. So you will see that this is our IRR. But now this figure that we've gotten, we've not catered for tax. So we are supposed to get it, to adjust it for tax. So IRR that we've got is 4.69%. So we adjust that for tax. So we are going to get 4.69% into 1 minus the tax rate. The tax rate, they are told us it is 50%, which is 0.5. So it is going to be 4.69% times 50%. So you just get the whole of this value and divide by 2. So it is going to be 2.34%. And that's what we shall use. 4.69. So this is the value that we are going to use as our cost of preference share. So, but there is also a scenario whereby you can first compute the first table and then you get the NPV equaling to 0. We also know that the IRR is that rate that makes the NPV, that equates NPV to 0. So if you compute, and I know it is very rare for you to be able to compute, to pick a rate that is going to help you compute and get the NPV as your first NPV to be 0. Because if you get your first NPV to be 0, then you stop there, you pick that rate to be your IRR. So this is the rate that will make sure that we get NPV equaling to 0. Because we have done something like an extrapolation. We have adjusted within the range. We have used different ranges to actually have that rate that will make the NPV equal to 0. So that's the implication. So you can try out as many numbers as you can, but we are going to look at computation of cost of capital, the overall. Because here we have been computing, here we've been computing the specific cost of each item. Since we have done, we want now to look at computation of what we call the worker, which I gave the formula as the VE over VE plus VD times KE plus VD over VD plus VE times KD adjusted for tax. That's the formula that we are going to go with. This is the weighted average cost of capital, or what we abbreviate as work computation. So we have now been able to get we have been able to compute the specific cost of each source that we can be used. So just to link up what we discussed earlier, the issue starts if the company is geared, meaning that a company has debt in its capital structure. So when the company is geared, it means they have both debt and equity in their capital structure. They have two components. They have the component of debt and the component of equity. Therefore, the examiner will give you what we call a balance sheet extract. It will be a balance sheet extract where you will be seeing these different sources of finance that are making up the capital structure of an entity. Now, in this paper, Advanced Financial Management, you have to think, and it's not going to be like the way we did in the financial management on level 2. The examiner will not tell you to compute work. Neither will the examiner tell you to compute marker. This is the marginal, because on level 2 we computed two things, work and mark. The marginal cost, the marginal weighted cost of capital, this is the mark, or work, which is the weighted average cost of capital, work. So here the examiner will not tell you, but he will only tell you to compute the appropriate. What they use here, they use the word appropriate cost of capital. So the examiner will tell you to compute the appropriate cost of capital. And it will depend on the information that you have in the question. So once the information you have is enough for you to compute MAC, you do so. If the information that is available can only enable you to compute weighted average cost of capital, then you go ahead and do that. If it is the information available is only for you to compute the cost of equity, cost of debt, you do so. So the appropriate cost of capital, once a company is geared, is what we call WACC. The appropriate cost of capital. If the company has both debt and equity, the appropriate one is WACC. That is weighted average cost of capital. And we said the formula for computing WACC is VE, that is value of equity, over value of equity plus value of debt, VD, times KE, this is cost of equity, KE, cost of equity, plus value of debt over value of debt plus value of equity. But this time around we multiply by KD. But this KD should be adjusted for tax 1 minus T. It should be always adjusted for tax. So let me rearrange it well. So where VE is the value of equity, VD is the value of debt, KE is the cost of equity, this is KE, of course KD is the cost of debt, and then we have the T, which is the tax rate. But remember here, we said we always use the market values. So here we go by the market values. So you should be knowing how to compute WACC using market values. So here we are going by the market values. But the VE and the VD, this VE and the VD, the value of equity and then the value of debt, must be market values. These ones must be market values. And the examiner may not give you the market values in the question, but this is part of your workings, and you will get the marks for those workings. So we saw these things on how we can compute the value of equity, the value of debt, and others using the market values. We saw how to do the market capitalization. But we have also to repeat them here because there are small issues that are always going to be confusing students. So we need to be able to, we shall do them again. However, in the formula, as you can see in this formula for the WACC, the trouble is the only trouble that you are going to find is getting this KE, cost of equity. So you need to see in the question, how is the cost of equity behaving? In other words, how are we going to be doing the cost of equity? So we agreed that this cost of equity is the one that is going to cause us a problem, because the rest we know how to compute them. But we also agreed that cost of equity can be got using CAPM. This is capital asset pricing model. though I haven't taught you how to use CAPM, but just know that's one of the ways how we can get the cost of equity. However, the examiner is not going to tell you whether you should use CAPM, whether you should use Gordon model or M&M. So it is all about you to find what information that is available. You will know which one you are going to use depending on the information that is available. Finally, we also said that we can use Gordon model and also M&M model or Modiglian and Miller. And I want to look at M&M when we go to capital structure theories. It's a topic that we are going to look at. And we shall see what these people say about all this kind of stuff. However, the examiner can bring to you a standalone number that is all about that Modiglian and Miller, M&M. So it can be a standalone number to explain. It can be to explain M&M, or it can be in terms of computations. Of course, you know, when you're explaining, at least you try to put in, if there is a formula, you try to put it out. But what I want you to understand is that we can also use it to compute cost of equity. Therefore, when as a business or as a company, as long as you find yourself that you are geared, you have both debt and equity, then we say the appropriate cost of capital is basically the work. But now we've seen how we are going to be solving the cost of equity. We want to understand how are we going to be dealing with cost of debt. That is the KD, the cost of debt. This one has no problem. Cost of debt, KD, has no trouble in computing it. If it is a bond debenture, you only find out whether it is redeemable or irredeemable, and it has no complications. But the problem is only on this cost of equity, because the decision is always on the student to know which formula or which method to use. So today I'm going to teach you the Modiglian and Miller, and as I said, we are going to learn it under the capital market theories, and I will teach you the Modiglian and Miller capital structure point of view. And of course, when we are done looking at the capital structure point of view, I will actually conclude with it when we are seeing how we can use it to compute the cost of equity. That's how I think it may actually make sense. Yeah, but the good thing, we have seen the formula for work. We need to know how we compute the market values, because they are the ones that are very useful, because we said VE and VD, they are supposed to be market values when computing work. So let's look at how do we compute each of these market values for both debt and equity. And that's basically what we are going to do. So determination of market values. Now we want to start with our VE, which is the value of the market value of equity. Market value of equity. So we want to look at equity. And when we talk about equity, we are basically referring to we are referring to common stock and retained earnings. Common stock or ordinary shares, and then the retained earnings. Because the retained earnings is also included in the market price of the ordinary shares. And we know that for us to be able to get VE, we get the number of shares times the market price. This is MPS, but this MPS is supposed to be XDiv. XDiv, number of shares times the market value per share, XDiv. But you need to make sure that you find out in the balance sheet whether they have given you what we call the par value. Because if you don't have the par value, then it will be hard for you to get this number of shares. Because we know that number of shares are not always given in the question. But we know that for us to be able to get the number of shares, we know that we always, for us to be able to get that, we get the total share capital. Share capital divided by the par value. Divided by the par value. The par value of each share. So now we are seeing that the breakdown is a little bit huge, because even though the formula for work is looking at two sources where they are looking at debt and the equity, but you need also to read the capital structure carefully, because your capital structure might have things to do with bonds, things to do with preference shares, things to do with the loan notice and others. So you will keep on opening it up to be able to know what has been given. Because remember, we said from the definition of preference shares, we know that that is debt from the legal definition. So even then the formula, because now in the formula we only look at VE, value of equity, and then the value of debt. But remember, the debt component is combined, it has very many aspects. So we also look at it. We are not going to basically say VD. No, we are going to look at value of each share and also its value. So let's now look at number 2. Let's look at the value of preference. Since it is also debt. So the value of preference, let me just call it In this paper, we are going to be focusing on the things to do with the impact of taxation. So want to look at the impact of taxation in the C. How does it impact the computations of work? So we are going to look at the impact of taxation on worker computations. So when we put taxation, when you have things to do with taxation, then we need to make sure that we understand that the timing is very crucial. Because taxes, most of the times we have issues that taxes can be paid in arrears. Taxes can be paid in arrears, or taxes can be paid in the same year. In the same year, cash flows are generated. So if these are two ways, the taxes can be paid in arrears, meaning the tax for this year will be paid in next year. That is paying in arrears. But there is a scenario where taxes can be paid. The taxes for this year are paid that same year. That's what we call paying taxes same year as the cash flows are generated. But paying taxes in arrears is what most of the times happens in most countries. So want to look at the different treatments given the fact that we have those two issues, because we've said that the timing of the cash flows, the timing of the taxes is very important in our computations. Remember, we are going to be having things to do with, we are going to have things to do with the IRR, and we know IRR uses the cash flows. So that's why here we are looking at the timing of the cash flow is very important. I know we shall learn more about the timing of cash flows when we go to the investment decision, but for now, just want you to understand that there are two ways. Taxes can be paid in arrears, or it can be paid in the same year the cash flows are generated. But now, what happens when taxes are paid in arrears? This tries to a little bit confuse students. When taxes are paid in arrears, this one is a little bit confusing for some of the students. These issues of taxation, I would have sorted them under the investment appraisal, because that's where there are many. But here, there is nothing complicated that we are going to look at, because the cash flows are not all that many. Now, if taxes are paid in arrears, it means that you pay the taxes when the year has ended. So what happens is that if you have this year, this is year one. So the taxes for this year, if let's say they are 2 million, if it is paid in arrears, then those taxes are going to be paid in year 2. So we shall have, this is how it is going to look like. You can have the years, up here. Let's put the years here. Year 1, year 2, year 3. So these are the cash flows, or these are the taxes. So what is going to happen is that if this year 1 you had 2 million, and year 2 you had, let's say, 3 million, what is going to happen is that if you are paying in arrears, the implication is that the tax the tax for year 1, which is 2 million, is going to be paid in the second year, so it will be here as 2 million. Here we shall not be having. So the taxes for year 2 will be paid in year 3. So we shall bring the 3 million here. That is the implication. That happens if at all taxes are paid in arrears. But now, if taxes are not paid in arrears, they are paid in that same period when cash flows are generated. So if they are in the same period, what is going to happen is that these taxes for year 1 of 2 million will be paid in year 1. This is 2 million. The one for year 2, which is 3 million, will be paid in year 2. That is 3 million. This one will not have. So that's the kind of discussion that we are going to be talking about. So that's what we are referring to. When taxes are paid in arrears, we expect that it's going to be paid at the end of the year. So once the cash flow of year 1 is not affected, because if you are paying in arrears, it means the one for year 2 is going to just come and sit here as, let's say, 2 million. So the cash flows for year 1, they are not going to be affected. Just like the way this one, the cash flows of year, because this cash flow is going to come, this taxes is going to come as a negative. We are going to be deducting it. So here we shall deduct nothing because it will not be affected. So once the cash flows of year 1 are not affected, then the tax is only affecting the cash flows of year 2 and so on. Now, someone is going to be wondering, if the cash flow for year 1 here, the taxes has gone to year 2, the one for year 2 has gone to year 3, what will happen to the taxes that are supposed to be for year 3? The implication is that whenever you have taxes that are going to be paid in arrears, you add an extra year, which is 4th year. So that the taxes for this year 3, if let's say it was 4 million, it would be going in here as 4 million. Even if the other columns are empty. That is the implication. Which is a little bit different from when cash flows are starting from here. Because if they are starting from here, then you'll be having 2 million here, 3 million here, then 4 million here. We shall not be needing this extra column. So cash flows, taxes being paid in arrears, it calls for us to bring an extra column. I'll explain more when we go to the investment decision. But that's the implication, and I want you to be very careful with it because it's one of the things that confuses students. So if the project was for 3 years, just like the way you are seeing here, we have to add an extra year because the taxes for that last year of the project will be paid in the coming year. So we add that an additional year, and that is the standard. That's how we do it. So this is because for the taxes that would have been paid in year 3 is supposed to be included in year 4. Even though year 4 we don't need it, but that cash flow is supposed to be illustrated that it has gone there. So we can now we are going to look at a practical simulation that is going to help us to understand the different aspects that we have. So we are going to meet in the next video where we are going to be talking about a simulation where we will be taking on a practical simulation to be able to understand what we are going through with this. So, and once we are done with that, we shall, of course, look at the cost of capital for a convertible debt because we've not talked about it. But I wanted you to first understand this, then we'll bring in something to do with convertible debenture or convertible bond or any debt instrument that can be transferred into equity. Something small. It is very similar, but something small that we need to understand from that perspective. And once we are done, we shall go to another topic. So let's now look at a simulation. It's basically about work computation. a UK company can use this. A UK company is financed by 7 million, 1 pound ordinary shares, and 8 million pound, 8% redeemable debenture. The market price, the market values are 1.2 pounds ex-div and 90 pound per 100 pound ex-div, per 100 pound ex-int respectively. Meaning for the debentures, it's the par value is 100, but the market value is 90. The debenture is, the par value is 1 pound, but the market value is 1.2 pounds. They are continuing that a debenture, a dividend of 10 pounds has just been paid, and future dividends are expected to grow by 5%. So the debentures are redeemable at par in 5 years time. 5 years time. Have the required? They are telling us that if taxation is 30%, calculate the weighted average cost of capital. The weighted average cost of capital, or what we call WACC. So that's our question. So let's now try to look at the solution. So we can first give the WACC formula as VE over VE plus VD times KE plus VD over VD plus VE times KD 1 minus T, which is the tax rate. Meaning we are going to adjust for tax. Now, if you look at this question, taxes are not in arrears. Because basically, if you look at the question, it says a UK company. It's a UK company. So it's not in arrears, because most of the times the Ugandan companies, they are the ones that pay in arrears. But since it is an international company, we don't expect them to not to let them pay now, and we expect them that maybe they will pay in the next year. So for those, most of the time before they transfer the profit they have made to their mother countries or to their mother businesses, they are supposed to first pay the tax. So we can assume that the taxes are paid in the same period. But if it was a Ugandan company, or if the question was looking at a Ugandan company, then we would assume that taxes are paid in arrears, because the examiner did not specify. So here we can assume, because most of the times that's what we basically do here in Uganda. So we look at what we basically take into consideration. So now we start by looking at the formula. We have already stated our formula. We now want to compute the cost of equity, because I told you one of the hard thing is is for you to be able to compute the cost of equity, that is KE, by first knowing which formula, which method that you are going to be using. But according to the information they gave to us, we are basically going to use Gordon model, because they were talking about a dividend of 10 pounds has just been declared. It has just been declared, meaning it is a current dividend. They have also given us the growth in dividend. So the question is about dividend that has been paid. So the examiner will never put all the information for all the methods. He will just give you one direction about which method that you are going to follow. But we know that Gordon model, if you are using KE to get, if you are using Gordon model, is D naught into 1 plus G over MPS, but we say this MPS must be X div plus G. So our D naught, of course, our D naught we said we have already seen, D naught is 10 pounds. Then of course our G, the growth rate, they told us it is 5%. Then the market price for this ordinary share, they told us it is 1.2 pound. So we just substitute into the formula, then we get the cost of equity. So it is going to be, because this one is 10 into 1 plus 0.05 over the 1.2, of course, plus the 0.05. So once you have that, you will see that this one is going to be, because this one is going to be 5%, 10.5. 10.5. So it is 10.5 divided by 1.2 plus the 0.05. You will see that it will give us 8.8%. So we can take it to be 9%. Our KE is 9%. Now, we have a debenture. They have given us a debenture, but this debenture is redeemable, which means that we are going to be looking for IRR. But since we have a tax, it's supposed to be adjusted for tax. So we go through the same way. So we can start with years. Of course, here I'm not going to put the one for details. So I'm just going to start with the cash flows. Then I put the discount factor, then the present value. But since we are doing two NPVs, so I'm just going to make it in one table. So DCF, again DCF. This is for the second NPV. DCF, then present value. So we are going to start filling in the values that we have. So we start from year 0. We are investing at market value. The market value was 90. 1.0. Here we pick any rate. So I'm going to use here 10%. I'm going to use 10%. So when I use the 10%, now we are going to use annuity factors. We are not going to go by the other way we went last time. We are pushing up to the 5th year. There are 5 years, so each year we are going to be getting interest of 5.6. Then we look at what is the discount, the annuity factor. 10% 5th year is going to be 3.7 3.791. 3.791. So we have also to redeem at the end of the fifth year. So in the fifth year we are redeeming, but they told us we are redeeming at par, which is 100. So this is a present value because we are receiving this, we are redeeming once. So it is going to be the discount factor 10%, 50 period is 0.621. So multiply, when you multiply this times this is going to give you 62.1. Then you multiply 5.6 times the 3.791, it's going to give you 21.23. So this one is 90. We first compute our first NPV. Our first NPV, of course, we add this plus this, we take off this one. So it is giving us a negative NPV of 6.67. Remember that we assumed that the taxes are going to be in the same year, meaning we don't have any problem with the way we have arranged. But if it was in areas, then it would be a different scenario. So we proceed. Now we go to the second NPV. So we have seen we have gotten a negative NPV. What do we do to the rate? Once we get a negative NPV, then we reduce the rate. So here we are going to take, maybe let's take 5%. We have reduced to 5. When you get a positive NPV, you just increase so that you can be able to get a negative. But here we have a negative, so we have to reduce the rate so that we can be able to get a positive NPV. So this 5%, this is 1.00. Of course, the annuity factor 5% in the fifth year is 4.329. Then of course the present value, now this is a present value factor, 5% in the fifth year, which is 0.781. So when you multiply this 100 times this, it is going to give you 78.1. Then this one is going to give you 24.24. This one is 90, but it's a negative. So we get also the second NPV, which is 12.64. It is a positive. If you choose a lower rate and it doesn't give you a negative, it doesn't give you that positive NPV, then you have to try again because it's a try and error. So this installment that I've used here, the one you are seeing me using here, the interest, we need to first, they gave us the coupon interest. The coupon interest was 8%, but the par value was 100. So the interest or the cash flow was supposed to be 8% times 100, and this is going to give you 8 shillings. No, it's a pound. 8 pound. These were pounds. I want to explain why I took the other one instead of this. So this is 8 pounds. Now, I used the other approach of first adjusting the cash flow for taxes. So I adjusted this cash flow, 8 pounds into 1 minus the tax rate, which was which is 30%, that is 0.3. So this is going to give you 5.6. So this 5.6 is what I used the other side as the cash flow, and I adjusted it for tax. Otherwise, if you never wanted to adjust it for tax, you would go by this 8%. Then the answer you get is the one that you should adjust for the tax. But here I've just adjusted the coupon interest. So that means when I go to the other side, when I get the IRR, I will not adjust it again for tax, because the cash flow was already adjusted for tax. So remember, we said when you are investing, you always invest in year 0, and you always invest at market price. So you look for the market price of the debenture. It's the one that you are going to be using to invest in year 0. We always invest in year 0 because we expect that once we invest in year 0, we expect to be receiving coupon interest in the first year or in year 1. That's why we are investing in year 0. Otherwise, for you to earn something, you must have done the investment. So since here we are just doing the investment at the same time, we have to assume that we must have invested maybe in year 0. So that's the assumption. So we go to the IRR. We go to the IRR. We've said it is A plus capital A over capital A minus capital B into B minus A. You may find that some people may be writing A plus A over A plus B into B minus A. Reason is because this B you are seeing here is always a negative. So once you add this, it becomes the positive, but the formula remains as the other one. So let's now put in the values. The lower rate is 5% plus the 12.64 over 12.64. Of course, this is a minus. It is going to be a plus 6.67 into 10% minus 5%. So once you work out all that, it's going to give you 8.3%. And that's how we'll be able to compute the cost of that debenture. We now need to look at the market values, because we need to know the market value for VE and then the VD. So VD, of course, we said that they have given us 8. The VD is 8 million. That's the book value over the par value. The par value is 100 times what is the market value is 90. Because they told us it is trading at a discount. Actually, the par value is 100, but for it, the market value is at 90, meaning it is currently trading at a discount. So once you do the computation, you find that you will be getting 7.2. These are pounds. The formula is the same. You get the book value of the debt or of the debenture divided by the par value. You multiply by the market price of that debenture or bond. So here the book value was 8 million. The par value was 100. So we go to the VE, that is the cost of equity. The book value was 7 million divided by the par value was 1. times the market. What is the market? The market is 1.2. So this means that we have 8.4 million pounds. So now we need to compute our work. So we compute the work, and we said work, what it was VE, which is 8.4, over VE, which is 8.4, plus, I'm going to first take off these zeros because it will not fit. It might not fit. Let me maybe try to write it in small letters, because if I take off the three zeros, you may get confused because we have some percentages. So this is 8 plus 7.2 times, what is the cost of, we had gotten our cost of equity as 9%, plus the 7.2 over 7.2 plus the 8.4. Of course, times this one we have already taken into consideration the tax, which is 8.3. So we see what answer are we getting from there. Times the 0.09. So this is giving us 0.049 plus, this is 0.038. So once we add that to 0.049, it will give you 0.087. Of course, if you convert it to a percent, it will be 8.7%, and this is going to be your work. So if the cash flows that they have given to you, because sometimes in the question they may give you the cash flows, of which those cash flows may be a little bit post-tax. You may find that when the cash flows they have given to you, they have already adjusted for tax. If they give you post-tax, then there is no need to, of course, post-tax means it is after tax. So if they give you cash flows that are post-tax, then you just don't take into consideration the tax component because we have already adjusted it. So if the examiner doesn't give you the current market price, what will you do for the debentures? And you find maybe there is no data for you to actually be able to compute, because you may find when the data available is not, you can't use it to be able to compute the market value for debentures. So we just we just take the par value to be the marketing value, because it can happen. So that's basically what I wanted to talk about. So in the next video we are going to be looking at the cost of convertible debt. We need to be able to know if at all the debt can be converted into equity. How are we going to be able to get the cost of that kind of instrument? I want us to look at the last bit of our tutorials for this topic, and want to cost of convertible debt. So this is, of course, debt specifically. and it is specifically debentures in the capital structure, debentures or bonds in the capital structure. So you may find that the examiner has given you what we call a convertible debenture or bond in the capital structure. And the examiner will tell you that this debenture is convertible. And when he does tell you, then you just know that it has some implications. And when he doesn't tell you, then of course it is the normal debenture that we know. But now a convertible instrument is that gives you a chance to convert it to either from debt to equity, or it could be from equity to debt. That is what we call the convertible instrument. Convertible instrument or asset is the one that gives you a chance to convert it. So the cost of a convertible debt is computed in the same way. We compute it in the same way, computed in the same way, like the redeemable debt. Redeemable. So the way we compute the redeemable debt is the same way we compute the convertible debt. However, one key thing that differentiates this is the fact that a convertible debt has two issues that you should know. One, it has a redemption value, and at the same time it has what we call a conversion value. It's these two items that distinguishes from the normal debenture to a convertible debenture. Now, what happens if you have those two items? Remember, if a debenture is redeemable, we said we compute IRR. Of course, we adjust it for tax. But now, you need to understand that when you are computing the IRR, in the last year of the project, you always have what we call a redemption value. But this time around, they have given you a redemption value at the same time they have given you a conversion value. The question is, which one of the two are we going to include in our computation? Because this is going to act like a cash outflow. We are redeeming back the money that we gave them. They are giving it to us back. So what happens is that you have to make comparisons. You need to compare these two items. You look at the redemption value and then the conversion value. You check which one has or which one is higher. We take the highest of the two. If the redemption value is higher, we take the redemption value. If the conversion value is higher than the redemption value, then we go with the conversion value. That's the only difference. And the reason that's why we are picking the highest of the two is because when you are converting from debt to equity, of course you look at a situation where you are going to make more money because you're a business. That point where you are going to be making more money is what we should go by, or that we should go with. So if you are converting from debt to equity, it is because you want to make more money. And that's why we choose the highest of the two. So let's now look at the simulation. We get some small simulation so that we can put something in context. Simulation. Of course, this is a convertible debt. 8% and 8% convertible convertible debenture has a current market value of UJEX 106 per 100, full stop. The debenture will be converted, into equity. The debenture will be converted into equity shares in 3 years' time. 3 years' time at the rate of 40 shares per shillings 100 of debentures, full stop. They are continuing that the market price is expected to be shillings 3.5 on the date of conversion, full stop, required, assuming a corporation tax of 33%, what is the cost of capital? What is the cost of capital to the company what is the cost of capital to the company for the convertible debenture? So let's look at the solution. How best can we sort this? So, since the examiner remained silent on the redemption value, because we have not had anything to do with the redemption value, then we just assume that it was redeemed at par. Remember the other things I told you, you can redeem at par, you can redeem at discount, or you can redeem at a premium. But now, since the examiner, I said if the examiner wants you to redeem at discount or premium, he must tell you. If he doesn't tell you, then you shouldn't. Now, we are going to be redeeming at par because we are not told. It is standard, we redeem at par. So the par value, what is the par value of that? The par value is 100. So now, if the redemption value is 100, then we now want to look at the conversion value. Before we do anything, conversion value. So conversion value, how are we going to be able to compute that? They have told us that it is going to be 40 shares times the market price, which is 3.5. So this is going to give us 140 shillings. So we pick which one the highest. Of course, the highest is now the conversion value of 140. So we shall go by this 140. That's what I'm meaning. This is 140, this is 100. So we pick the highest. So having known that, then we know that for us to be able to get the cost of a convertible bond, we said it equals to IRR. We compute it in the same way that like we do for the redeemable debt. So cost of the convertible debenture is equal to IRR. But we say this one, we adjust it for tax, if at all the tax rate has been given to us. But we said IRR, we know the formula. We said IRR equals to A plus capital A over capital A. This is plus capital B into B minus A. This is a minus. When you are writing the formula, this is supposed to be a minus, but when you are making the computation, you will just see that it is coming to be more of a plus sign. So we need now to first compute the interest that we are going to be using. So the interest, of course, the interest, they have given us the coupon, which is 8% times the par value of 100. So this is going to give us 8 shillings. So since it is giving us 8 shillings, then we can use the other method. We can get the net interest, or we can take it the other way. Let me take it and we compute. Of course, these are years. Of course, here we have the cash flows, we have the DCF, we have the present value, we have the DCF, and then the present value. So we start putting in the values. So we are starting from year 0. We are investing at the market value. Of course, the market value for the debenture they told us is 106. We are investing at 106. So first year, in year 1 up to year 3, we are going to be receiving what we call interest. It is 8. I've not adjusted for tax. So in the 3rd year, we are also going to be receiving the redemption value. We are redeeming, but instead of taking the redemption value here, we are taking the conversion value because it is higher, of 140. So what we are going to do now, we need to pick a rate. Let me just take 12%. 12%, this is going to be 1.00. This is going to be 106. Then we get the annuity factor. Annuity factor 12% in the 3rd year is 2.402. Then the present value factor 12% 3rd year is 0.71. Then we compute this times this is going to give you 99.68. Then we compute. Of course, this will give you the NPV, the first NPV. Then this is 8 times the 2.402. That is giving us 19.2. So we add the 99.68. So it is giving us a positive 12.9. This is a positive. So we increase the rate. If we take it maybe to 20%, so this is going to be 1.00. So we look at the present value factor, 10%, 20%. You are taking the annuity factor 3rd year at 20%. Annuity factor 3rd year 20% is 2.106. 2.106. Then we get now the present value factor 3rd year at 20%, which is 0.5779. Then we start multiplying. So this is going to be 0.579 times 140. That is giving us 81.06. Then the 8 times the 2.106 is giving us 16.8 5. Of course, this is 106. So we get our second NPV plus the 81.06 minus the 106 is giving us a negative 8.09. So we take this, then we go to the NPV. We go to computing IRR. We wrote the formula already, so we are going to put in the roll rate, which is 12%, plus our A which is 12.9. This is 12.9 over 12.9 plus 8.09 times 20. Of course, 20% minus 12%. So this is going to be, of course, when you put that in your calculator, so this is going to give you 0.1692. So when you convert it to 100, it is going to give you, that is 16.92%. But remember, we need to adjust this for tax. So what we are going to do, we adjust it for tax. IRR, let me change the color. We adjust it for tax. IRR will be the 16.92% into the tax rate. They told us 33%, 1 minus 33%. So this is going to give you 11.33%, and that's going to be your cost of equity, your cost of convertible debt. So that's basically what we wanted to look at for the cost of a convertible debt. So what we are going to look at in the next video is going to be basically where we are going to be starting our new topic for capital structure theories. We are going to start capital structure and dividend policy, but we want to first look at capital structure theories. So that's what we are going to look at in the next video. Thank you for watching. Let's meet in the next video as we are talking about the capital structure or the dividend policy.